Well done, guys. Okay, Dr. Yusuf, you can take over.
Okay, good afternoon, everyone. Uh, Happy holidays. I'm glad to finally, I guess I'm glad to finally come to the end of the tournament. And that's just because every time I do the score calculation and I'm posting, I'm like, oh my days. So, but I mean, there's still so much to fight for on the table because I can say that anyone can still we it's not like set in stone yet. So it seems like a lot of teams still have a chance. But like I said, this is really about learning as a group of people rather than really the competition. The competition is just a way to facilitate the knowledge acquisition, right? So the main aim of the tournament, as we've always said, is to try to garner some key skills, key critical skills that you will need uh, in the real world. Skills like teamwork, skills like presentation skills, skills that you will need outside of your four walls of your university that isn't really emphasized enough in the university. And that's the sole purpose of the tournament. There are so many skills that you learn from here that you take on to your workplace, your interviews, and a lot of times when you've gone through this kind of rigorous tournament or competition, you tend to build your confidence, so and trust me, you really need this kind of skills when you try to get a job or when you are even in a job. So I'm just glad that everyone has been able to learn from this. And it's like I said, it's not really focused on this is the winner. So the other people that participated in it, they lost. They didn't lose anything. Yes, there's just a prize for the person that tops the table, but I believe every team has been able to learn and they've been able to win something from the tournament. So as we come to the final phase of the tournament, we are going to go through the same process where everyone presents. It goes, team versus team for each round, and at the end of the tournament, we are going to have some prizes as well. So some mentors like Mr. Giwa, they have their personal prizes for individual awards. We have we have a prize for the best presenter, like we usually do. We have obviously top three teams for the tournament. The prizes that will go to them. We also have as sorry, someone people are trying to enter. We also have the first time we're having this prize. It's called the Paradigm Charity Prize. So the prize is sponsored by uh, a non-profit called Paradigm Book Reading Charity in the UK. And for the first time, they are sponsoring this prize. The prize is for the improved, uh, most improved person in the tournament. So from phase one to all the way to phase four, who has improved the most, right? So we would have our picks from the mentors, and we'll also give the opportunity for voting as well. So it's a two factor to make sure that everyone is satisfied with the winner of that prize. So this is something really exciting. And the last prize would be for the team that has the most scores, accumulated scores. So there are points and there are scores, right? So the points, obviously, the people that have the most points will top the table and they'll be the winner of the tournament. But there is also a prize for those that have for the team that comes out with the most accumulated scores. So over the
Outside of those three teams that have scored the first and second and third position. Just
yes,
thought to say that.
so yes, so outside the top three, the team that has the most score over the four phases will still get a prize as well. So a lot to look forward to, a lot of prizes, and a lot to learn from. This is actually my favorite phase. It's just because of the analysis, and it requires a lot of thinking, critical thinking, and analysis, like I said. So I'm really looking forward to your performance, and we can't wait to um, listen to you guys. So well done once again to everyone that's participated so far. Amazing. It takes dedication and grit to be able to do the four phases, to come out and keep that same performance and even try to improve. So well done once again to everyone. You guys are amazing. So yeah, I think we can start if everyone is here. Dr. Ejimoke, are the mentors here?
Yes, please.
Okay, so we can start with Team Valor if everything is set. We have Team Valor here, right?
Yes, sir.
Yes, sir.
All right. Amazing, amazing. Do you guys want to share a screen? Hopefully, we'll finish early today so that Joy can have a rest at the end of the day.
In an industry where only the bold endure and legacy is constantly tested by competition and change, today's presentation demands courage. Courage to examine how history, strategy, and resilience truly shape survival. Good day, mentors, mentees, and everyone present. Representing Nadoki Akitola University as Team Valor, I am Fadia Esther, joined by Olakwinsi Fidelis, our team lead, Oladende Mayowa, and Ajao Tejumola. True to our name, we boldly open the chapter on a legacy forged in the year 1884 by visionary pioneers George Patterson and George Zokonis, whose modest trading enterprise evolved into one of the most enduring forces in fast-moving consumer goods (FMCG) industry, PZ Curzon. From its early venture into the global trade to its deep-rooted presence in Nigeria, established in the year 1899 and incorporated as PZ Curzon Nigeria PLC in the year 1948. It transformed simple consumer goods into a household symbol of trust, innovation, and reliability, standing shoulder to shoulder with giants like Unilever Nigeria and Nestle Nigeria. Globally, Pizza Cuisine spans Africa, Europe, Asia Pacific, and Australia, with subsidiaries like PZ Wilma Nigeria Limited and HPZ Limited, combining local insights with international reach to dominate personal care, home care, and food products. For over a century, PZ Cushion has thrived not by size, but through vision, leadership, and bold innovation. Its brands, Cousin Baby, Imperial Leather, Money Fresh, among others, are woven into daily life, proving that trust and relevance are earned, not inherited. While Unilever wields global scale and Nestle dominates nutrition, PZ Cousin leverage local insights, agility, and relentless creativity to remain competitive. Built on strategic foresight, leadership-driven growth, and relentless adaptation, PZ Cousin show how heritage and innovation collide, shaping not just the present, but a future where only the courageous, the strategic, and resilient survive and thrive. As we peel back the layer of PZ Cousin remarkably journey, everyone, the battlefield of FMCG industry comes into view, dominated by titans like Unilever and Nestle. Yet, teaming with emerging challengers to navigate this fierce arena and uncover how PZ Cuisine holds its ground, I'll hand over to Oladende Emmanuel, who will take us deep into the heart of the competition, revealing the strategies, challenges, and maneuver that determine and define the survivor in a market where only the bold thrive. Over to you, Oladende Emmanuel.
Thank you, Esther. Sorry, I was having a network issue. So I will continue from here. To understand the competitive environment of PZ Cousins Nigeria, we would apply the Michael Porter's 5 forces framework, which helps us identify who holds power, where competitive pressure comes from, and how profitability is shaped. Overall, the model reveals a highly competitive, price-sensitive, and structurally demanding FMCG market. To set the context, imagine walking into a neighborhood store in Lagos or Ibadan to buy soap. On the shelf, you see Premier Soap, Lux, Dettol, and several cheaper unbranded alternatives. This simple experience already reflects the intensity of the competition in Nigerian's FMCG sector. Now, let's walk through each of these forces. The first, competitive rivalry is very high. Many firms sell similar products, forcing companies into price cuts, promotions, and heavy advertising. For example, during Christmas or Easter, firms simultaneously offer promotions like buy two get one free to win customers' attention. Second, the bargaining power of buyers is very high. Nigerian prices rise. Once prices rise, customers quickly switch to cheaper brands. Third, the threat of substitute is also high. During economic hardship, households often replace branded soap with traditional black soap, which performs the same function at lower cost. Fourth, supplier power on imported input. So naira depreciation raises cost and squeezes profit margin. Then finally, while strong brands enjoy protection, small local producers easily enter low cost market segments. PZ Cousins operates in an environment of intense firepower, high substitution, and notable supplier pressures. Success therefore depends on not just on brand strength but on cost efficiency, innovation, and strategic differentiation. Now that we have mapped out the forces shaping this competitive environment, I will hand over to my teammate Esther, who will explain how PZ Cousins is strategically responding to these challenges. Esther, over to you.
Thank you, Maiwa, for that insightful breakdown of present causes competitive analysis. Now, let's take a step further and explore how present causes has strategically positioned itself, not just to survive, but to outperform its biggest competitors. In the last 5 years, while industry like giants like Univella, Cricket, and P&G were playing defensive or retreating from tough markets, present causes was making bold steps, focus move, winning market shares, building brand power, staying closer to consumer. This is a story of strategy, not size. How smart decision has placed present position in a position of strength. Now let's unpack exactly how they have done it. Firstly, while global giants like Univella were retreating from challenging markets like Nigeria, present position have made a bold choice to double down on Africa. They streamlined their portfolio by sending non-con assets, doubled their efforts behind core brands like Imperial Leather, Guzon Baby. Today, an impressive 80% of their Nigeria sales has come to the market leading 1 to 2 brands. That's clearly a statement of dominance in a tough market. Secondly, in the UK hygiene battle against heavyweight brands like Dettol and Safeguard, Peace and Kuzan did not just compete on price or distribution, they went deeper. With Imagine KX with retailable and emotional life handful campaign. This is a strategy. Triple KX size compared to its nearest competitor, making this a true category of their leader. Thirdly, recognizing the power of trusted baby care brands, Peace Kuzan made a game-changing acquisition in 2022, Child Farm, the UK top baby and child personal care brand. This is directly challenges giants like P&J, Pampers, and Johnson, adding a natural trusted alternative to their portfolio, expanding their global reach. Fourthly, beyond big moves, Peace Kuzan are focused on portfolio simplification, shedding more core business to shaping their focus on markets and categories where they can win a clear sign of strategic discipline. Finally, across 5 years, this episode have proved that today's competitive landscape, smart focus, local reference, and broad innovation, Trump more side, they have shown choosing the right battles and executing the precision is not how to grow strong but stay relevant. And with this strategic foundation in place, I will now hand over to Fidelis to take us through the financial performance, trade analysis, and SWOT analysis that highlights how this move position this episode for their future success. Over to you, Fidelis.
Thank you very much, Tejumola. The purpose of this financial analysis is to determine how healthy the company is and also to know the state in which the company is. Now, looking back to 5 fiscal years ago, starting from 2020, as the snapshot of the financial statement is being projected on the screen, I would like you to follow me very closely. Starting from the fiscal year 2020, PZ Cussons had a revenue of about 85 billion naira, and after the tax has been deducted, he had a profit of about 6 billion naira, which shows that this company is actually starting off on the good foot, on the right foot. It's a healthy company. Moving over to 2021, there was an increase in both the revenue and even the profit after tax. We have an increase from 85 billion naira to 92 billion naira, and an increase in the profit after tax from 6 billion naira to 7.5 billion naira. This increase continued even onto the year 2022, where we had a revenue of 110 billion naira and a profit after tax of 9 billion naira. Then came 2023, and this increase, there was a sustained increase from 2020, from the fiscal year 2020 to the fiscal year 2023, recording a revenue of 135 billion naira and a profit after tax of 11 billion naira. Now, in the year 2024, there was a huge crisis that befell PZ Cussons, and this crisis was as a result of the naira devaluation, which affected the foreign exchange of the company. So this led to an immense loss of close to 90 billion naira in the business. This was a major setback for the business, and over the years after that setback, the company has embarked on a way to actually recover from that loss, and we see that the company is actually thriving when it comes to that recovery process. In 2025, the revenue even increased higher from 150 billion naira to 212.6 billion naira, and as a result of that, there is a recovery from the profit after tax that it made loss in 2024, and now it increased to it made a profit of 10 billion naira after tax. Now, moving over to the trend analysis, we see that the company tried as much as possible to upscale its revenue. So starting from 85 billion naira up to this point where it has over 212.6 billion naira as its overall revenue, and it also increased in its profit after tax. Now, the profitability trend, moving over to the profitability trend, which examines the trend analysis, which shows the crisis and how much the crisis affected the company. So from 2020, 2021, 2022, 2023, the company was scaling its business. There was profit, and the profit was increasing gradually. But came 2024, where the foreign exchange loss came in, and the naira depreciation deeply affected the company, where they lost over $100 billion, over 100 billion naira. But in the year 2025, the company is trying to as much as possible to upscale back to its normal mode. So the overall trend analysis shows that from the year 2020, there was a moderate revenue growth. From 2021 to 2022, there was also growth in the revenue. 2023 shows an immense growth in the revenue. 2024 also showed an immense growth, although there was huge loss when it comes to profitability. 2025, the fiscal year 2025, shows a strong revenue growth, even though there was loss the previous year. So that year was mainly a major recovery year for them, and they were able to return to scale back to their profit. So I will hand over back to okay, now on talking about the market capitalization and investor sentiment. The investor confidence was reaffirmed as the remarkable growth in market capitalization from 21 billion naira in 2020 to an estimated 186 billion naira in 2025. This signals a strong note of confidence from investors. So even after the loss, investors are still vouching very much for PZ Cussons. So from 2020, where the market capitalization was 21 billion naira, now 2025 it is 186 billion naira. This upward trend reflects improved financial health, strategic execution, and a position outlook for future earnings despite previous challenges. I'll be handing over now to Maiwa to take us through the key performance indicators.
Thank you, Fidelis. I will be taking us through the SWOT analysis. Now, we'll be checking the strengths of PZ Cousins. The strengths include diverse product portfolio in the sense that they add Imperial Leather, Kerex, Cousins Baby, Aya Tamaku, and so on. They also have the strength of strong global presence across Africa, and also they were committed to sustainability and innovation. Their weaknesses include exposure to challenging emerging markets, operational complexity requiring simplification, and limited scale compared to larger FMCG competitors like Unilever and Nestle Nigeria. The opportunities they had in the market include growing demand in emerging markets, expansion potential through digital and e-commerce channel, leveraging sustainability for eco-conscious consumers, strategic partnerships and product innovation, and lastly, the threats that the previous competitive changing affecting cost. Who will give us the conclusion?
Thank you, Oladende Emmanuel. To wrap it up, PZ Cuson Nigeria stand at a decisive turning point by reducing foreign exchange exposure, strengthening equity, improving marginal quality, and localizing its supply chain. The company can move beyond short-term profits recovery towards durable long-term value creation. Successful execution of this strategy will enhance financial resilience, restore investor confidence, and position PZ Cuson Nigeria to compete effectively in a volatile macroeconomic environment while delivering sustainable growth for stakeholders. Thank you, everyone.
Thank you very much, Tim Valo. Well done for that good presentation. Good job. Just checking, do we have the next generation here? Do we by chance have next generation on the call? All right, that's fine. Okay, so I'm just going to allow the mentors to give Tim Valo their feedback. But based of my own feedback, I think the only thing I would say is I like the subtle color of your slide. It's good, but then I feel like some of the slides add so much words in them, and in many cases it kind of distracted me from what you were saying, and I just actually started reading the words on the slide, and that's one of the things you want to work against or guide against, so that your audience are not distracted from what you're actually presenting and just reading from the slide. So it's important to have that at the back of your mind. That being said, I would have the mentors give Tim Valo feedback. Yeah, Tijani Lawal, you have your hands raised.
Okay. Hello, good afternoon. Sorry, can you hear
Yes,
me?
I can hear you. Yeah, good afternoon.
Okay, I'm sorry, please. I don't know if I am permitted to also give comments.
Oh yeah, yeah, you can.
All right, thank you so much. Uh, Apparently, this is my first time coming on for this year's Daytopia competition, and it's. I just want to say, the tempo is still the same way. It makes sense. Everything, intriguing presentation from these guys that I listened to. They had a very nice one. But I think I noted one or few things. First was after the first presenter. She started well with a very high note, which I do not expect a pause to come in along the line. I do not know what happened there, but I want to implore the team, just for the sake of next time, if you need to prepare, I want to advise that you should have mastered every forms of transition that you guys want to work with. So once the first presenter finishes, it doesn't take a very long moment of pause before the second presenter comes on board. I understand there might be situations beyond your control, but just try to make sure you get everything within your control. Secondly, I want to talk about your slides as well too, even though Dr. Adijumoke has talked about them. I also started from here, and I still feel you guys have a long way to go when it comes to the quality of slides that I've seen here. You guys could do better, all right? The Daytopia standard is present your information with infographics, pictures, but too much text on a slide diverts your listeners' attention, just like you did to Dr. Adejumoke. And also, talking about your financials, I think that was even where I was more interested in. Talking about your financials, you guys had a very decent one. I like how you were able to break down the numbers, give us the drivers of every performance from 2020 till 2024. And I also like the fact that you're able to give us your expected or your estimated, revenue and their profit after tax for 2025. It shows how well you guys are really thinking in that regard. However, where I seem to have problem with was where after giving us a breakdown of their financials, you still went ahead again to do something your team called a trend analysis. Now, when it comes to you wanting to give us a trend analysis, there I was actually expecting to see, okay, maybe you want to give us a ratio comparison of the company between itself, like how it's been performing for the last 5 years till date, or you want to give us a sort of industry comparison between PZ Cousins and other players in the industry, and just so that we can better understand Cousins, position in the industry financially, not just still you coming back again to give us a trend analysis that's still a reflection of the revenue and the profit after tax stuff that you told us about in the past. So for me, it makes it look like you are still recycling the same thing that you said earlier, but then in another different weddings entirely. So please, when next you need to go around your financials, just do it this way, not still coming up to give us the same thing again. Then I think that's all for now. But then overall, you guys had a very nice presentation. Good job to the team. I look forward to seeing you guys give us more or give us something better than this next time. Thank you so much.
Thank you so much, Tijani. If you gave a very detailed feedback. Dr. Yusuf, you have your hands raised. Thank you so much, Tijani.
Thank you so much. I think, first of all, I want to say well done to the team. Well done to the feedback given by Dr. Jumoke and Mentor Titani. So thank you so much, guys. Well done. What I enjoyed was the butterfly forces, the transition. I think, like Mentor Tijani said, I think it was I'm guessing it's probably because of the network, because you had some good transitions and then sometimes it was delayed. So I'm guessing that was due to the network. But when you do, I'm going to emphasize on what Tijan said. When you do um, when you try to do the financial analysis of a company, there are a couple of things you need to consider. First of all, it's not only revenue and profit that you need to look at to do the analysis. So, and it's also better for you to use ratios I'm not sure if any economics or accounting students are in the team, but this is probably just a learning curve. So you need to use a couple of ratios. So you need to check for their liquidity, that is how much money, how solvent they are they about to run out of cash? So that's liquidity. You need to check their profitability, which you did, but you didn't do it in the right way. The right way is that the numbers in revenue and profit are not how we actually get to understand the profitability of a company. You need to use ratios like ROA, ROE, like return on assets or return on equity, to really, or even return on investment, to really understand what those numbers mean. Yes, they can say revenue 110 billion, they can say profit of 10, but we need to also know, in comparison to a very close competitor, what does that mean? Right. So you need to, yes, you were saying that there was a naira devaluation which really impacted their 2024 profitability, but are you 100% certain that was the only thing? Because from your presentation, I'm not convinced that just revenue, just the naira devaluation will come to a 90 billion loss for a company like that, right? Are you sure it was just that, or there were other factors? The only way you can know and you can prove to us is by comparing it with other close competitors. If we see similar things with other close competitors, or also, this is a business analysis, right? But you can also link it to research or proof or evidence that, okay, this is what happened across the industry. We didn't get to see that enough, but it was a good try. I like the SWOT analysis, the portal five forces, like I said. It's just something to consider next time, right? It's not just about revenue and profits, but you can look at liquidity, you can look at so many other efficiency, so many other, and it's better for you to use ratios so that you can properly analyze and then compare. That comparison is very key because you are just saying the numbers. You need to compare it with a very close competitor. The slide, I think that Jumoke mentioned it was a bit tiny as well. So rather than putting a lot of words, try to use graphics or infographics. But well done. It was a good attempt. Well done to the team.
Thank you very much. Thank you very much, Dr. Yusuf. All right. I do hope that Team Valor were able to take those feedbacks on board. Again, this is something that can help you going forward. So well done. Okay. Um, since we do not have Team Next Generation here, we're going to move to the next team, to the next set of presenters. As we all know, this particular set of presentation would say a lot about the scoreboard, and all mentors have been informed and told we are going to pay attention to every details. We're going to evaluate you on everything, because again, you guys are set of presenter that, again, whatever happens during this round sets the tone of the board. Right. That being said, I wish the two teams the best of luck. Excuse me. Right. So we have team UI Alpha and team Daytopia, and they are presenting on Okomo oil. I hope I called that right. We're going to start with team UI Alpha, and then we would have team Daytopia present immediately after them, and then we would have their feedbacks together. Do we have team UI Alpha here?
Good afternoon, ma. Yeah, we are here.
Good afternoon. Well done. Well done. All right. So once you start talking, your time will start.
Good afternoon, everybody. Please confirm you can hear me. Akim, I don't know. Okay, I was waiting for the slides.
We can hear you.
All right, ma'am. Thank you very much. Okay. Do you think navigating Nigeria's economy is tough? Yes, you're right. Nigeria's economic landscape is a battlefield shaped by rising inflation, currency pressure, and unpredictable policies. Yet, some companies don't just weather the storm, they thrive. Okomu Oil Palm PLC is one of them. Built on disciplined operations, strong market positioning, and a clear focus on sustainability, Okomu has turned challenges into consistent profits. Today, we will show how Okomo has performed over the years and how it performs now, but also how it is shaping itself for future growth and long-term resilience. Helping you to analyze this company today is a team of experts from Alpha Securities & Co., an investment advisory firm. My name is Praise Adewumi Obisheson, the lead analyst at Alpha, and with me are Kehinde Leshi, the industry analyst, Akim Adepoju, the financial analyst, and Jacob Chidi, ESG and compliance analyst. Together, we'll be presenting an independent and objective assessment of Okomo Oil Palm PLC. First, let us explain what the business does. Okomo Oil Palm PLC is a leading Nigeria agribusiness established in 1979, headquartered at Edo State with core operations including oil palm and rubber cultivation and processing. Okomo's business is built around a simple but efficient value chain. It starts on the plantation, where oil palm and rubber trees are cultivated. Fresh fruit bunches are then harvested from the palm fields and taken directly to palm oil mills, where they are sterilized, pressed, and refined into crude palm oil. At the same time, rubber cup lumps collected from the rubber fields are processed into rubber cake for export. By controlling both farming and processing, Okomo captures value across the entire production cycle. Also, Okomo's operations are structured into three segments. The first being the palm plantation segment, which as of November 2024 covers 19,044 hectares. This segment supplies fresh fruit bunches for the palm oil production. The rubber plantation segment covers 7,335 hectares and supports the company's export-oriented rubber business. The last segment, which is the processing segment, converts these agricultural outputs into marketable products and also provides palm oil processing services to external parties. Okomo sells crude palm oil and its branded red palm oil called Banga exclusively within Nigeria through a structured distributor network. Rubber products are sold mainly to export markets, providing foreign exchange earnings. This results in a clear revenue split. Palm oil revenue is domestic, while rubber revenue is international. Importantly, the customer base is diversified, with no single customer accounting for more than 10% of total revenue, according to the company's Q1 report of 2025. Having described what the business does, let us now explore the industry that shapes the activities of our subject company. Let's start with the global outlook. Malaysia and Indonesia currently account for over 80% of global output, and as confirmed in the 2025 Grand Review research, the market is currently valued at about $75.5 billion in 2025 and is expected to exceed $110 billion by 2035, supported by food consumption, industrial use, and biofuel demand. Crude palm oil is trading at around $1,040 per ton as of December 2025, with expectations of a continued price increase. This price trend is primarily driven by rising global demand and tightening supply conditions. On the demand side, a key structural driver is the global biofuel push, particularly in Indonesia. Government policies are diverting palm oil from export markets into domestic energy use, increasing overall demand pressure. In addition, food and industrial demand remains resilient, supported by the recovery in global travel and food services. Palm oil's high yield per hectare and cost efficiency continue to make it the preferred oil in price-sensitive markets, reinforcing demand growth. However, supply growth has struggled to keep pace. Production in Indonesia and Malaysia has slowed due to aging plantations and limited land availability. This is according to research by Rajendra Jadhav, published on the Reuters website. Beyond these physical supply limits, regulation is adding further pressure. The European Union Deforestation Regulation, effective from 2025, requires full traceability and deforestation-free production, increasing compliance costs and favoring large, well-managed producers. Now, to analyzing the industry from Nigeria's perspective, Nigeria is one of Africa's major palm oil producers and currently ranks as the third largest producer on the continent, contributing 4.6% of Africa's total palm oil output, behind Cote d'Ivoire at 82.4% and Liberia at 9.1%, according to a 2024 SIPH report. Palm oil is a staple in Nigeria and its demand continues to rise due to population growth and urban consumption. Also, there is a highly fragmented production. The industry is dominated by local farmers, accounting for 80% of the country's output. It is also important to note that there is a domestic supply gap. Nigeria currently consumes 1.8 mmT of palm oil yearly, but only about 1.4 mmT are being produced within the country. That is, we import roughly 0.4 mmT every year. Despite this, the outlook is supportive. Government policies are increasingly favoring large integrated producers like Okomu to help close the supply gap and reduce reliance on imports. Looking ahead, we conducted a SWOT analysis of Okomu Oil Palm PLC. To save time, we're presenting a brief summary. The company is well positioned thanks to its integrated operations, dual product lines of palm oil and rubber, and opportunities from supply gaps in the market. At the same time, it faces challenges from the environmental impacts of its production processes and vulnerability to climate change. We also applied the PESO framework to see how external factors influence Okomo's operations. In short, the company has taken a strong stance on political, social, legal, and technological fronts while remaining watchful regarding economic pressures and environmental risks. At this point, I'll have Akim take it up from here.
Thank you so much for that, Adewumi. Having done a SWOT and PESTU analysis, now let's examine the competitive advantages the company has. After our research, we found out that analysts commonly benchmark Okomu against Cresco PLC, a fellow large-scale and vertically integrated Nigerian agro-industrial player, SAPH, a leading rubber exporter in West Africa, and the Golden Agri Businesses, a global giant used to evaluate operational efficiency and yield standard. While these peers operate at different skills and focus areas, Okomu stands out by using a unique strength to get an edge in the market. These advantages can be seen through 4 pillars that defines the competitive positioning. The first one, which is the dual product revenue stream. Okomu is one of the African's few companies that produce both large-scale palm oil and rubber for export. Most competitors like Presco PLC produce oil, and large rubber exporters like SAPH have a single revenue stream. This makes help Okomu to reduce risk from price swing in either commodity. Pillar 2, vertical integration and superior infrastructure. Okomu manages every step of its production from plantation to its branded Banga palm oil. Okomu plants, harvests, refines, produces, and sells. As confirmed in the 2024 NIFOR data report, competitors like Presco PLC and smallholders operate on a smaller scale and fragmented system. On to Pillar 3, technical expertise. Through its partnership with the Stockfin Group, Okomu benefits from international best practices in plantation management, advanced farming techniques, and research. Stockfinco provides exclusive support for pest control and yield optimization. This gives Okomu an advantage over local industrial players and smallholders firms. Pillar 4. Okomu has RSPO certifications across all plantations, follows the EU deforestation regulation certifications, and according to a 2025 regulatory update, these certifications allows Okomu premium export market to sell to premium export market where many competitors, including Presco PLC and informal producers, cannot operate due to non-compliance. That will establish Okomu's strong competitive advantages. Let's move to examine this strategic positioning that has translated into financial performance. Over the last 5 years, the company has demonstrated remarkable growth despite the challenges of the economic environment and fluctuations in global commodity prices. The company's revenue has surged from 23.4 billion naira in 2020 to 128.2 billion naira in 2024, a massive 456% increase over 4 years. Surprisingly, the first 9 months of 2025 revenue has already hit 173.9 billion naira, surpassing the full year 2024 figure. We looked into the cause of this and found out that the crude palm oil prices jumped about 35% in 2024, while rubber prices did an over 100% increase in price. And the main reason is rising global demand and naira devaluation. On top of that, increased their output from around 60,000 tons in 2023 to about 68 in 2024. The company's profits also tell a similar story. Their net profits rose from 7.6 billion in 2021 to about 39.96 billion in 2024, and in 9 months of profits already reached 60.33 billion. To compare revenue and profit, this means that for every 100 naira the company is in sales, it keeps about 31 to 35 naira as profit after all costs and tax. Gross margin stays above 80% last 5 years, and it is around 64% for the first 3 quarters of this year due to higher energy and labor costs. Compared to peers, Okomu stands out. PLC, which has almost the same growth margin as Okomu, sees lower returns compared to Okomu. Presco is the only best fit to compare to Okomu, as both operate within the same macroeconomic and political environment. For the last fiscal year, Okomu return on equity and return on assets are far higher than Presco's. In simple terms, this means Okomu is more efficient in turning shareholders' money into net income. The company trades at a price-to-book ratio of 16.74 or of 16.74x, meaning investors are willing to pay far more for each naira of Okomu net asset than they have for Presco, which trades at 7.17x. In simple terms, this shows stronger market confidence in Okomu management quality, efficiency, and future financial performance. Audience, at this point, I'll be taking my break and I will hand over to our ESG and compliance analyst from here, Leshi.
Thank you so much, Akim. Now, beyond financial numbers, it's also important to examine how Okomu manages environmental, social, and governance factors, which increasingly influence long-term performance and investor confidence. On the environmental side, Okomu has taken clear steps to protect its operations and surrounding ecosystems. According to its company's 2024 investors report, all its plantations, including Extension 2, are RSPO certified, and it complies with the EU deforestation regulation. In 2024, Okomu completed the reforestation of 50 hectares of land. These practices ensure that the company maintains access to international markets while also reducing its environmental footprint. In terms of social responsibility, Okomu invested 308.4 million naira in CSR projects across 29 local communities, building and renovating classrooms, town halls, and boreholes. Its workforce is also relatively mature and stable, with 63.4% of all workers aged 29 to 50. Employee welfare also remains a top priority. 203.4 million naira was spent on health and safety, and 106.4 of these millions was spent on skills development. Our staff also received a 50% increase in 2024, alongside industry standard pension schemes. Likewise, governance at Okomu is also structured and transparent. The board includes executive and independent directors. The next slide, please. As shown on the attached slide, the board is diverse and composed of experts from agriculture, law, corporate strategy, finance, economics, and research fields. Now, let's move on to the assessment of performance and outlook. With these ESG foundations in place, let's now assess what independent and professional analysts say about the company's financial performance projections to see how these foundations translate into future performance. Analysts from Cardinal Stone and Chapel Hill agree that Okomu's diversification and operational efficiency are key competitive advantages. By generating revenue from both palm oil and rubber, the company benefits from a dual revenue stream that reduces earnings volatility. As regards revenue, analysts at Chapel Hill remain bullish on Okomu. They project that the company's revenue will grow by 62.5% in the fiscal year of 2026. Production of crude palm oil is expected to increase steadily, maintaining Okomu's leading domestic position. Also, Okomu's competitor, Presco, although operating on a larger scale, is projected to grow revenue by 52.4% over that same period. Likewise, Cardinal Stone analysts take a more conservative view, forecasting revenue to also rise in 2026 to a 23.4% increase, while they recognize strong earning potential. Moving on to their view on margin, Chapel Hill analysts expect EBITDA margins to expand to 50.4% in 2026, where Cardinal Stone projects EBITDA margins to increase from 51% in 2025 and 53.5% in 2026. Both company analysts note that over the years, Okomu's cost of production are growing slower than the revenue. Now, both analyst groups note that Okomu generates strong cash and carries very little debt. As of the third quarter of 2025, the company is in net cash position with a net debt EBITDA of minus 0.4%, meaning it has more cash than debt and enough flexibility to fund new investments if needed. Free cash flow is expected to remain positive, which supports steady dividend payments and smooth operations. This stands in contrast to Presco, which faces higher risks from recent expansion projects and increased financing needs. In terms of valuation, Chapel Hill Denham maintains a BUI rating with a 12-month target price of 1,321 naira, suggesting a 20.5% upside from the current market price of 1,096 naira. Cardinal Stone, on the other hand, assigns a hold rating with a target price of 1,083 naira, reflecting steady growth expectations. To summarize, all these means that both company analysts agree that Okomu's financial strength and operational efficiency make it a premium pick in the Nigerian agro-allied sector. At this point, I'll be moving on to my colleague Jacob to do its business risks. Thank you.
Thank you very much, Lechi. So, while the financial projections are strong, it is natural at this to consider the key risks that could affect Okomu's future performance. The first is the operational risk, which the security threat. Security is one of the things that threatens plantation areas in Okomu. In February 2022, Okomu experienced 2 attacks by militants that destroyed equipment and damaged 20 hectares of rubber plantations. Tragically, 1 worker was killed, highlighting how violence can directly interrupt operations and reduce output. To mitigate a future risk like this, Okomu has strengthened the security protocols by partnering with the military and local security agencies. Secondly, climate and environmental risk. Weather extremes are a constant threat. Heavy rainfall over several days can flood plantations, washing away young palm seedlings or damaging mature palms. In early 2023, localized floods in Edo State delayed harvest across 150 hectares of palm plantations, reducing yield by approximately 3,200 metric tons. Conversely, prolonged dry spells or heat waves can stress palms, lowering fruit quality and oil extraction rates. Moving on to the third risk, which is also a regulatory risk. Okomu operates under strict regulations, including environmental laws, taxation, and government policies. Non-compliance could halt operations or result in fines. For example, in 2018, officials from the Federal Inland Revenue Service temporarily sealed Okomu's Edo State office over a disputed tax debt of 8.1 billion naira, and this disrupted administrative operation. For the legal risk, the company is exposed to claims and lawsuits from employees, suppliers, and other stakeholders. The outcomes are uncertain and can harm both finances and reputation. For instance, disputes over land leases or contract terms could escalate into costly legal proceedings. To address regulatory and legal challenges, the company conducts regular audits, maintains close engagement with authorities, and leverages both in-house and external legal counsel. And lastly, the market and commodity risk. Okomu's revenue depends heavily on palm oil and rubber prices, which can fluctuate globally. A sudden drop in international rubber prices or domestic palm oil rates could reduce earnings. Additionally, if the naira strengthens, earnings from rubber exports in foreign currency may decrease, while devaluation raises the cost of imported fertilizers and spare parts. As mitigant, Okomu's dual product revenue model provides a natural edge against price and currency fluctuations. Now to the recommendation. While current mitigation strategies cover most areas, further measures could strengthen resilience. Specifically, the company should consider financial hedging instruments to protect against naira volatility and global commodity price swings. Additionally, expanding partnership with local security firms and community stakeholders can further safeguard assets against operational disruptions. In conclusion, Okomu Oil Palm Company PLC has demonstrated strong operational and financial performance, supported by its dual product model, efficient operations, and ESG commitment. However, it faces challenges including exposure to regulatory changes, climate risk, and security threats, as well as reliance on commodity prices and foreign exchange. While this risk could affect profitability, the company's governance, technical expertise, and integrated operations provide a solid foundation to manage them. Overall, Okomu remains a key player in Nigeria's agro-industrial sector, balancing growth opportunities with ongoing operational and market risk. Once again, we're analysts from Alpha Consult and Co. Thank you.
Thank you very much. Thank you. I know we said no feedback now, but I have just a comment to give. I don't know how you guys decided to put people or decide who takes what, but I think it really worked well for the team. Whoever decided to allocate sections to you guys did a good job, because Adewumi started very strong, gave us that emotional roller coaster into introducing us to the company itself, and followed by let me try and remember his name now. Adekwaju's coolness, brings that cool breeze into it. And then it's like, okay, don't get too comfortable. We have Leshi, that's Olawumi, if I'm right, brought in another adrenaline rush at the middle of the way. And then you guys had Jacob kind of finishing it in a cool way as well, which is fantastic. I think that you guys played well to the strength of the members of the team, so which I personally loved. So thank you guys. It was a good one. All right, so I'm going to allow Team Daytopia give their own presentation, and I would have the mentors give a feedback to each team at the end of the day. Again, because I want us to be as transparent as possible with this set of presentations in particular. Okay, Daytopia, are you ready?
Yes, we are, ma'am.
All right. So you can start by sharing your slides and then.
Nigeria is one of Africa's largest consumer of palm oil, yet we still depend heavily on the imports to meet our domestic demands. In an economy facing inflationary pressure, foreign exchange constraints, and climate uncertainty, sustaining profitability in the agri-business space is no easy task at all. However, one company has consistently operated with discipline, skill, and long-term focus, and that is Okomu Oil Palm Company PLC. Today, our analysis is beyond describing Okomu Oil. We'll be explaining why its business model works, how it competes in the Nigeria agribusiness space, and why this matters for its future performance. Good afternoon, mentors and my fellow Daytopians. I am Barnabas Oyolola, and here with me are Pete Shobie, Evidence Folorunsho, and Joy Adewin, and together we are the team Daytopia. Let's begin by seeing how Okomu Oil has fared over the years. Right from the 1950s, when Nigeria was the world's largest producer and exporter of palm oil, accounting for over 40% of the global oil market, down to 1976, where the federal government initiative took turn to rehabilitate the palm and rubber production in Nigeria of over 15,000 hectares in Edo State, to 1990, where the privatization of this particular project took place, making Scoffin the majority shareholder and coming to sole management. In 2008, the commissioning of the 2.5 trillion hectares rubber factory took place. And between 2015 and 2020, Okomu Oil had gotten in international certification and badges to improve our operations and effectiveness. In 2021, it was known to be ranked among the top 10 companies with the largest turnover quoted on the Nigeria Stock Exchange and the largest private sector employer in Edo State. Now, what then has driven Okomu's operation over the years? And that is its vision and mission statement, which is to become Nigeria's foremost agribusiness, driving innovation in sustainable cultivational practices, while maximizing the use of its resources, and also to achieve maximum performance, contributing to the growth of its major stakeholders. It has also stayed committed to developing local communities, our employees, and environmental sustainability. Now, let's take a look at an overview of Okomu Oil PLC. Okomu Oil operates primarily in Edo State, managing extensive plantation assets and processing facilities, with 3 main operational estates with over 19,000 hectares planted, making it one of the largest oil palm operators in Nigeria. It operates 2 major business segments, the oil palm and the rubber segment, with the oil palm segment contributing majority to its revenue and profits. Its main products include the crude palm oil, the refined palm oil, the palm kernel, and the natural rubber. Okomu's business model is centered on vertical integration. This has reduced our dependence on external suppliers and exposure to supply chain disruptions. This structure has also allowed it to manage cost effectively, maintain consistent product quality, and protect our margins. All this has positioned Okomu Oil as a long-term player in the Nigeria agribusiness sector. With all this industry context established, we'll now examine how Okomu Oil PLC has performed financially and strategically within this environment. Over to you.
Thank you very much, Barnabas. Now I'll be looking at Okomu products portfolio through the BCG matrix. The BCG matrix allows us to see how where Okomu Oil's products stand compared to its competitors. Through this matrix, we're able to categorize its products into 4 different quadrants: question mark, the star, dog, and the cash cow. Firstly, look at the local farmer partnership. This stands as the question mark because the partnership with local rubber farmers grant it a potential to have massive growth, to fill milling capacity, but actually it requires significant technology transfers to meet quality standards. Over to the star. We identify processed rubber as Okomu's star because it serves as a critical foreign exchange hedge and also because its export value increases during naira devaluations. Over to the dog. We see that Okomu's assets can be considered as a dog because of its regional insecurity and the illegal logging, which makes them a drain on Okomu Oil's resources. And finally, the cash cow was identified as the crude palm oil. This is because it has inelastic domestic demand and a $20 billion value chain potential. This provides Okomu Oil the steady liquidity to actually fund its operations. Moving over, we look at the factors that affect Okomu's businesses using the pestle analysis. Firstly, in political space, we see that government protectionism has benefited Okomu through the 2019 ban on refined palm oil imports and the 2025 NAPOT, which is aimed at standardizing this sector. Secondly, the economic space. The domestic deficit of 1.2 million metric tons and the rising inflation and high cost of imported fertilizer presents both opportunities and threats to the company. And socially, the company faces persistent labor shortages and severe security risk in Edo State, like the militant attacks that has resulted in the loss of its labor personnel. On the technological front, we see that the company is bridging the national grid gap with its own turbines. However, it remains vulnerable to high cost of imported spare parts. And then environmentally, we see that the climate issues are a threat to the rubber production of Okomu oil, and the company also has to comply with strict environmental regulations. And finally, legally, Okomu navigates complex land tenure disputes and historical litigations, such as the landmark Okomu oil versus Ishiari case, which continues to define its labor relations today. Under the SWOT, using the SWOT analysis, we were able to identify internal strengths and weaknesses of Okomu oil and its external opportunities and threats. Internally, Okomu's strength lies in its vertical integration and its project hedging. Its ability to sell both oil and rubber protects the business from a crash in either market. However, its weaknesses include a shortage of skilled manpower and high operating costs driven by fuel scarcity and expensive imported inputs. When we look at the external side, its opportunities are rather vast, especially the 1.2 million metric ton supply gap in Nigeria and its access to government initiatives like the CBN Oil Palm Development Fund. On the other hand, the threats are very serious. The worsening regional insecurity directly impacts the field productivity, and the rise of synthetic rubber substitutes could challenge the natural rubber demand in the long term. To understand how Okomu is fueling their expansion and rewarding their investors from this growth, Evidence will now present the breakdown of their financial performance.
Our financial analysis shows that Okomu Oil recorded consistent profit growth between 2020 and 2024. This growth was largely driven by sustained increases in demand for crude palm oil as domestic consumption rose steadily over the period. The most striking development occurred between 2023 and 2024, which was driven by the high inflation environment in Nigeria. Okomu was able to absorb the pressure of high inflation by strategically adjusting product prices, rubber prices, increasing by about 170% and crude palm oil prices by 100%, allowing profitability to expand significantly despite rising costs. The liquidity ratios, current, quick, and cash shows a clear downward trend from 2020 to 2023, hitting their lowest levels in 2023 before beginning to recover in 2024. What does this mean for Okomu Oil? This decline does not signal operational weakness. Rather, it reflects deliberate investment decisions between 2020 and 2023. Okomu committed substantial capital to this extension 2 project, which is expected to double crude palm oil production to 80,000 tons by 2025. During this period, cash was tied up in biological assets, property, plant, and equipment, using short-term liquidity. In addition, the top naira devaluation in 2023 from 444 naira to 899 naira per dollar significantly increased currency debt obligations, further compressing Okomu's ability to meet short-term commitments. However, in 2024, the extension 2 project became fully operational, improving internal cash generation and marking the beginning of a recovery of Okomu's liquidity position. Between 2020 and 2024, Okomu Oil and Pesco Oil recorded consistent year-on-year revenue growth, a particularly sharp acceleration between 2023 and 2024. Following the COVID-19 disruptions, 2021 marked a period of moderate recovery for both firms, driven by gradual economic normalization and improved palm oil production, during which Pesco's revenue outpaced Okomu's revenue due to its larger output scale. The most significant shift occurred in 2024 when revenue surged for both companies, largely as a result of substantial increases in price of key products such as crude palm oil and rubber. This effect was further amplified by the depreciation of Naira, which boosted Naira-denominated value of export revenues, particularly for rubber. From an efficiency perspective, Okomu stands out. Its asset turnover shows a strong and consistent upward perspective. Its asset turnover shows a consistent upward trend, rising from about 0.45 in 2020 to 1.2 in 2024, indicating that the company has become increasingly effective at generating revenue from its asset base. Over the period from 2019 to 2020, the analysis shows that Okomu Oil and Pesco Oil increased leverage to support growth and expansion. However, while Pesco relied more heavily on debt to finance asset expansion, like the purchase of a 52% equity stake of Ghana Oil Farm Development Company Limited, Okomu maintained a more conservative capital structure, even in the funding of asset expansion. Despite rising leverage, both firms showed their ability to service debt. Pesco recorded a notable recovery in interest coverage due to strong and high growth in net profit, which was driven by significant increase in price of palm oil and the rising domestic consumption of palm oil. The decline in interest coverage of Okomu Oil was due to the company taking on more debt to finance their extension 2 project since 2021. Overall, the analysis showed that Okomu Oil demonstrates operational efficiency with rising profitability and a balanced capital structure, reflecting the overall robustness of its financial performance. Finally, I'll be taking us through the ESG analysis of Okomu Oil.
I will be looking at how Okomu Oil manages its environmental, social, and governance factors, and more importantly, how these factors support its financial performance. Because when we talk about ESG, what we are really talking about is how a company makes money without damaging people or the environment, and how it bridges short-term production with long-term sustainability. So how does this framework show in the business? Okomu understands something very simple but very important. One weak decision can lead to accidents, community conflicts, shutdowns, and even reputational damage. So while ESG can exist without frameworks, Okomu deliberately operates within frameworks because it is a quality control for their operations. And this matters especially to investors. Frameworks allow people like the mentors and my fellow Daytopians to compare Okomu's performance with similar companies and decide whether to buy, hold, or sell. These efforts are aligned with international standards, including quality and environmental management systems and the International Labour Organization principles, the United Nations Sustainable Development Goals, and of course, the almighty Roundtable on Sustainable Palm Oil, RSPO, is a big deal in the palm oil industry. The RSPO certification tells us that Okomu's production processes meet externally audited sustainability benchmarks. On the social side, employee welfare is protected under regulations
approved by the Federal Ministry of Labor with a zero tolerance approach to child and forced labor. Corporate social responsibility is also taken very seriously because in 2024 alone, 254 million naira was spent on borehole rehabilitation, road maintenance, healthcare facilities, and quality education. So this shows us that ESG isn't just a theory, it is ESG in practice. This is where governance really ties it all together. On governance, Okomu's practices aligns with the Nigerian Code of Corporate Governance. The board structure has relevant experiences across law, business, economics, business administration is particularly important here. There is strong non-executive representation, independent oversight, and a clear separation of roles between the chairman and the managing director. The board includes 5 independent non-executive directors, which strengthens transparency and accountability. Gender diversity is still limited, but there are 2 women on the board, including Mrs. Isabel Shabali from Burkina Faso and Mrs. Vivian Shobo from Nigeria. Using the ESG scorecard provided as a link in the reference section, we observed that Presco currently scores higher on ESG performance than Okomu Oil. However, Okomu's decision to release a dedicated sustainability report signals a clear commitment to improving its environmental, social, and governance outcomes over time. So, to wrap everything up, Okomu Oil Palm operates in an industry with strong structural demand, supported by a business model built on asset control, scale, and operational discipline. Yes, challenges remain climate risk, regulatory pressure, and cost volatility. But Okomu's vertically integrated structure places it in a stronger position than many of its peers to manage those risks. Okomu Oil is not just surviving Nigeria's economic volatility, it is structured to perform within it. And that is what makes it a resilient agribusiness and a compelling long-term player, because ESG ultimately determines whether a company can operate responsibly today and still exist tomorrow. Thank you.
Oh, sorry, is that the end?
Yes, ma'am.
All right. I think it would have been better to have a concluding slide, a final slide that shows that you've finished. Yeah, that would be. I know you concluded, but yeah, because the slide was still on governance team, made me think that there was still more to come. So it would have been nice to have a concluding slide, maybe a slide that says conclusion with your reference listing there or something. It would have been nice. Okay, so again, because my field is not business, I would not give you feedback about business, but I would just give my feedbacks based on your confidence, your slides, and general presentation skills. Those are the kind of feedbacks you will get from me. And one thing I see is that, I don't know if he was, I don't know, but Barnabas, I could sense some hesitancies in your presentation at the beginning, which again, I don't know, maybe is agitation, maybe is, I don't know what it is, but it's not good for a start of a presentation. I feel like you could have done better, although Emisi picked up the pace, but then the slow pace that Barnabas started with kind of like threw your audience off a little bit, which is something that you should work on as well. Understanding that your first presenter needs to be strong in a way that it keys your reader in. If the first presenter is not strong, every other person will struggle, and which, although Emisi tried to bring us back in, but it would have been better if you started strong at the beginning. We also lost the energy with evidence. Evidence presentation was a slow burner. We could hardly hear what he was saying. I don't know, maybe it's network, but again, these are things that would, affect your scores at the end of the day. So it's important that you make sure that everybody understands the task, and then you guys practice and keep practicing so that it helps at the end of the week. I'm not going to see anything with regards to the slides not showing at some point, because I want to think it's maybe network issues or something. But then again, once you see that your slide is not up, it's important that you quickly find something to do so that again you don't lose your audience along the way. Aside that, I would call on Shokwe to mentor Shokwe to give some feedback.
Yeah, hi, Dr. Adejimoke. Can you hear me, please?
Yes, we can.
Yeah. I think so this is for the two teams, right? I mean, you're going into like feedback sessions for the two teams.
Yes.
Okay, cool. I want to ask if it's better to, because I probably have you said I think it covered everything with regards to feedback. So I have more questions than feedback. So is it better to do it now or after everyone's feedback?
No, you can start.
Okay, okay, cool. Yeah, so I mean, I've covered Okomu in my past life, so I think I'm kind of familiar with the numbers. So I think just to save time, I mean, I have like a lot of questions, but to save time, I'll do a question to each team, right? So for the first team, that's Team UI, what now? Sorry, I can't remember the name, but I remember your slide very well. Sorry. So for the first team, I think just for very little feedback, I think Olaomi was really good. The energy was exciting. The slides were amazing. I mean, take it from me, your slides were actually amazing. So now my question is like a micro kind of question, right? I mean, every analyst that covers Okomo versus Okomo would like definitely has Presco in his mouth or is in his or her mouth, right? Now you compared in your financial analysis Okomo versus Presco. You were talking about valuation, right? And you used the price to book ratio. Now, my first question is, why did you use the price to book ratio compared to the price to earnings ratio, or I mean, any other valuation ratios or valuation methodologies? And the second question is on what is the significance of the numbers, right? Because I mean, the main point of my question is to understand if you actually understand what you're saying, right? So Okomu has higher price to book ratio, Presco has lower price to book ratio. Is Okomu better, or what's the significance? And I mean, let me just give context to what I'm actually trying to ask. From a growth versus value company perspective, right? So why did it price to book ratio, number one, and number two is what's the significance of those numbers that you have on your slides? That's number one for the first team. For the second team, which is team Daytopia, I believe, it is on risks, right? So I mean, I think you guys decided came in and you expected us to believe that all is well, right? I mean, you mentioned it at the end, but I mean, you kind of painted Okomo as this beautiful ESG company in green and orange, and you kind of like you didn't walk us through the risks, right? Which is a very important part for a company like Okomo, which operates in FMCG. Now, can you please walk us through the impacts of FX volatility and commodity price swings, right? I literally picked these 2 points from the first team's presentation to ask you, right? So FX volatility in Nigeria and globally. What's your view? What's your medium-term view? And also on commodity price swings. So what's your medium-term view and what's the impact on the common? Yeah, I'm sorry for the length of the questions, but yeah, I'm just very curious.
That's fine. Okay, let's start with UI Alpha. So did you get the question?
Yes, we got a question.
Okay, so let's start with you addressing the question.
All right, so thank you very much for that. So you asked for the significance of the number because we compared the price to book ratio of Okomo to Presco. So for one thing is we were not the one that calculated it. So we, as part of analysis, we are not supposed to do valuation. Yeah, we only made reference to the valuation done by analysts at Cardistone and Chapo, and we made reference to them when we were discussing these valuation numbers. So for price to book ratio, we said we got that for Cresco, it is 7.17x, and for Okomu, it is 16.74x. So basically, what price to book ratio actually means in this essence is more like it shows investors' confidence. So it's kind of it kind of tells how much market or how much investors are willing to pay for every 1 naira of the physical assets that the company owns. So, and the formula for calculating that is market price per share, like the amount they are selling each share of the company in the market, divided by the book value per share of the company. And it shows, for example, now we got that of Okomu is higher than Presco. So that means investors are willing to pay more for Okomu's share than Presco's. Did I answer your question, sir?
I mean, yes, but I mean, the main question was why price to book ratio compared to other valuation methodologies. Well, I think I'm fine with that answer. Thank you.
Okay, thank you very much. Did you want to say something, Jacob?
Yes, this is actually Akim. I'm using Jacob's phone.
Okay.
So like I want to mention something. So he was saying why price to book. So I wanted to mention that we were not the one that actually calculated it using price to book. That was the valuation method that was used by analysts at Cardistone and Chapel. We were not supposed to calculate. We were not supposed to do valuation.
Okay.
Dr. Jimmy,
Yes,
can I chip in?
yes.
Yes. So Jacob, just to help you, when you looked at the Cardinal Stone report or whatever report you used, was it just price to book analysis you saw in their report, or did you see other valuation methodology of the report?
All right, thank you very much, sir. So in the valuation, we saw a lot of different valuation methodology. We saw DCF.
So why did you pick price to book?
Yeah.
So basically, we don't want to go into details discussing too much of valuation method, because as part of what we're required to do for this competition, we're not required to do valuation. We're just to deal with this story book.
You have so many, but you chose one.
Yeah, it's the justification, the rationale behind it.
You don't have to say.
Yeah.
Nobody's saying you have to compute it. You're just saying you have so many methods, but you decided to pick on why did you pick it as well.
All right, so this is Akim. Let me answer that. So because I was actually the one that brought it from the valuation report. So one thing is the basis, to be truthful, the basis for choosing that one is because of comparison. It was easier to actually compare that. Oh, if the price to book value of this is this and this is this, we can easily compare and say, oh, this one is kind of better than the other. Than using DCF, I didn't think we had to use something from DCF. That would have been the intrinsic value, because there was not any like metric like book price to book value when you use DCF valuation. So the resulting the results from DCF would be the intrinsic value, and to compare in that sense might not be
so basically you chose a valuation methodology that will support your analysis of the company.
Sorry, I didn't get that, sir.
So you chose the valuation method that will support your opinion on the company to make them look good and better than Presco.
No, that was not it, sir.
No, it's actually fine because you have different methodology. There's no, like, they're all good, but just to say this is right.
No, that was not it.
It's fine.
It's good.
It's not like the bad methodology.
No, it's not bad.
You understand? It's not a bad methodology.
Yeah.
So we're not saying price to book is bad. No, it's just to say why. I mean, the Cardinal Stone and any analyst, they do all of this valuation because they are all relevant, but you just know why you're using.
So I think thank you, Metogiwa. Thank you, Metogiwa. So I think, I mean, just very simple, right? The reason why those guys are using price to book is because of the nature of the company, right? So price to earnings versus price to book. Okomu is a manufacturing company, and the base, right, the denominator in this case, it's better to use like net assets, right, which is like the denominator of this price to book ratio. So I think in just simple terms, right, I think the first thing I think about when I think of valuation methodologies compared to like a growth company like Google or Amazon, or let me look for one in Nigeria. I think like very growth companies, right? So I think it's better to use price to book than price to earnings for manufacturing companies, because the denominator is more like that's what we're looking at in valuation, right? So I think that was my point. So I mean, just like check better. I mean, yeah.
Thank you very much.
I hope that
So,
helps.
Adequaju, it's you don't have to defend your justification. So if you say that I'm choosing this because it's even as little as it's convenient for me, that's enough. Nobody can query you for you saying that I understand using this better than the other one, or this is more convenient, or this better helps me to defend my stance. It's okay. They just want to be sure that you understand the concept behind what you're saying. That's all what it's all about. But well done. Good job for being able to defend your work. Team Daytopia, did you get the question? Do you want to address the questions that was being posed to you?
Yes, ma'am. So, okay, first I want to say that it's not about the first comment you made about the risk. So we're not trying to pose Okomo as a very strong company. That's why we had done a pestle and a SWOT analysis to identify the risks for the business. But I do agree that we could have given a particular slide to actually talk about its risk in particular. Although we thought that we believe that talking about the pestle and the SWOT could actually cover the risk of the business. And I'll answer the question on its FX volatility. So the major product of Okomo that is being affected or susceptible to FX is the rubber. So we find that rubber is primarily an export crop and is priced in other currencies. So the risk for that is that when the naira devalues, Okomo's revenue would increase in terms of the naira, and on in terms of also on in terms of cost. So that's on in terms of revenue. In terms of revenue, the only product that is easily affected by FX volatility is rubber. And in terms of cost, because Okomo is heavily reliant on imported machinery, fertilizer, and chemicals, it can increase its cost of production. So when the naira weakens, its cost of inputs actually skyrockets. But because it is able to, we identify that its ability to hedge between those, because of its ability to manufacture those two products, it's able to hedge against its risk. So none of the business does not crash because it's producing two different things, and it's able to hedge against that risk of foreign exchange volatility. And in terms of commodity pricing, I had mentioned that because of the 2019 import ban, Okomu has the opportunity and the benefit of selling majorly to the Nigerian markets, and in most times the local Nigerian price of palm oil is usually higher than the other foreign products, and this protects it from foreign competition. And because of the already huge demand in Nigeria, Okomu is able to adjust its local prices to reflect the cost of living and protect itself from rising inflation. I hope that answers the question.
Okay, and just to add on the commodity price risks, the international price set for palm oil is also a major determinant in Okumu setting their prices and in terms of their export of their commodities. So that kind of affects how they peg their prices and how it helps them in pegging their prices also.
Yeah, thank you for your answer. I mean, just one feedback, right? You sound smarter with numbers. I think that's just my one line. So I mean, everything you're saying to an executive doesn't make a lot of I mean, everything you're saying to someone that actually wants to hear you doesn't add a lot of context when you don't use numbers. For example, I mean, even if you don't know the numbers, right? If I'm asking for FX volatility, one of the first things you're talking about is what's the current climate, right? For most especially for you have mentors that are not like essentially in Nigeria that actually want to learn. To be honest, I think one thing to undergraduate or anything is like try to teach people, right? And you do so well in life. Like teach very senior people and just watch how you skyrocket. So like just like add some context, right? Show that you know the numbers, but you can't know the numbers without checking the numbers, right? So for example, at the start of your answer, you could have told me, oh, the USD Nigerian USD NGN exchange rate has done, even if you don't know the number, just give me some context. Say it has appreciated, the Nigerian naira has appreciated by 5% year to date, or at the start of the year, it was hovering around 1,400 and something, and today it's hovering around 1,500 and something. Just give me some context, right? And that gives me, okay, is it doing well or is it doing bad? And is this good for Komu or not? So that's not my number one feedback. Then number two, I don't think you essentially answered the question on the medium. And again, that's why I was quite careful with what I was asking, right? So you essentially just went around my question, right? I hope this does not this does not go into the points, right? So you essentially just went around my question without answering the question itself, which was what is your medium term outlook, right? And that was the essential question. So I started to like talk about like give context to what's the current political situation, who is the current central bank governor, what's he doing, are his policies helping, what's because that is exactly what investors want to hear, like at the end of the day. Are his policies helping or not? Are we gonna get to 900 naira to a dollar in 2 years? And how is that important for Komu? Or how is the company actually hedging? I need to talk about hedging, but yeah, but good. I mean, this kind of that just give context, right? And that's why, like, I just encourage everyone to have a macro perspective every time. Like, just have a macro view of the world, have a macro view of Nigeria, have a macro view of the world, and it helps in your conversations. But yeah, thank you. I mean, very good answers from both teams, and I'm sorry for being chaotic and bringing those kind of questions. Thank you.
No, thank you very much, Dr. It's something that is good, and they take those feedbacks and then start considering and see how they can integrate this into future projects as well. So thank you very much. Dr. Yusuf, you have your answers.
Yes, thank you very much to the two teams. Amazing presentation. Both slides were really good, and thank you for the mentors I've already spoken. I was just going to add a couple of things I noted. Honestly, it's really good. I love the present. The first thing I said about the first team that presented was you need to use ratios. You need to compare with competitors for us to really get an understanding of those numbers. It's not enough to just provide numbers. For what does that mean? You need to be able to explain to us what it means. And to see that immediately, the next two teams presenting, they were able to do that. I mean, it's really good. So well done to Team UI Alpha and Team Daytopia. I love the transition, obviously. Good start from UI Alpha. Daytopia start wasn't that great, but eventually they built up the confidence, which was great. I love the sword. I love the quarters five forces. I wanted to say for UI Alpha, it felt like I think the timing as well. I think you were a bit past your time. I think maybe 2 minutes or so. But the timing, I think because you had a lot of things to cover, you breezed through a lot of slides. So I was with when you moved into the SWOTs, I don't even think it's meant up to 1 minute. You just quickly moved in, and you breezed through the portal five forces, even though it was there. But I think maybe next time try as much as possible to see how you can adjust that. So for instance, you had a slide on risk. I think risk, yeah. I think that could be merged with SWOT, so that you can spend more time with small. So the threat side of SWOT, you could easily put some risk there that will affect the company going forward. just so you can spend more time with important parts of your presentation. Also, there was an error with I think the date you put there. This has nothing to do with your grade, but just next time when you have presentations, make sure that you put 20th of December, which was last week. So make sure that you are in you, you are in today's date, not in the past. But well done to you guys. I also loved Daytopia's presentation, but I think the BCG parts, the BCG matrix, I love the explanation before you even started it. But I don't think the BCG matrix was, maybe it wasn't well done, or maybe it wasn't just particularly necessary. Maybe that time could have been spent on other other analysis. I'm not quite sure, because I realized BCG matrix is mainly for the products within a company, when they are trying to see which products they want to dispose, or which product is best. So they want to analyze the products. And Okomo doesn't really, it's not the right, it wasn't the right fit for this kind of company, because they mainly have just the rubber and the oil. So you were now struggling. You were now putting partnership in BCG nature. I'm like, partnership is not a product, right? So maybe next time when you want to, it would have been perfect for a company like PZ Cousins, like the first team that presented, because they have a variety of products, right? Of key products. So it would have been nice to see which one is the cash cow, which one is this and that. But for Komu, I think you adding partnership into that matrix wasn't really right for me. Just something. So make sure that whichever framework or whichever analysis you're using, make sure that it fits perfectly with what you're trying. Not just use it, but try to make sure that it fits perfectly. But well done to you guys.
Well done, guys. Very good job. The fact that you guys were able to come up with this even during the holidays is commendable. So well done, well done, well done. All right. So do we have team next generation here? Are you guys ready now?
Yes, ma'am. Good afternoon.
Good afternoon. All right. So earlier we had team Valo present. However, the next generation's phone went off. I don't know. I said they had light issues. So, but then they've been able to get their phone up now, and they are ready to present. For mentors that have sent in their grades for Valor, we just need to judge next generation, and then we would add the scores up together. All right, you can project your slides now.
Okay. But before we continue, please, I want to formally apologize to everyone. Sorry about the delay. Can you all see my screen?
Yeah, sorry, Lima, before you please start talking, I forgot. I wanted to really commend Adekoju Akim. Very good job. I actually forgot. I wanted to say that. Very good job. You are a wonderful team leader. I do see the hard work you put into your team, getting them prepared, getting them ready, and how you don't just do that, but you support them all through the presentation. Also a very active member as well on the leaders board. So well done, well done. And also well done to Barnabas as well. It's not an easy job to be the team leader of any team. It's not. I know that you guys are doing a lot of work. So well done. You guys are stars. Well done. Yeah, Alima, you can start.
Is my okay, you can see my screen, right?
Yeah, but make sure it's on full.
So we'll be starting our screen. Okay.
It's not yet on presentation mode. Still very tiny.
Is it on presentation mode now?
It's tiny.
Oh.
Maybe rotate your phone screen or something.
It's still tiny. Can you see it now?
Yes, it's still time. Did I help with presenting your slides for you?
Okay. No. Let me send it to your WhatsApp. Oh, sorry. Sure, ma'am. Let me send it to your WhatsApp now.
Yeah, if you turn on the
Yeah,
auto rotate mode, you should. Yeah.
I think you just need to rotate your camera.
Yeah. Alima, if you're able to rotate your camera, it should come up well.
But if it's easier
Oh,
for you, then let's.
okay. I'm actually using another phone for it because we don't have access to a laptop. Let me reconnect it again. Or should I just send it to you?
Yeah.
Yeah, you can send it.
Okay. Shima, I just sent it. Can you guys hear me clearly?
We can hear you.
Yeah, give me a minute. Let me just
Please,
download
let
it.
me.
Just a minute. One minute, please. Oh, God. Okay. Right. All right. When you guys are ready, let me know.
Okay, well, we'll start now. Founded in 1884, PZ Cousins, formerly known as Patterson Zucconis, was born, a time when West African societies operated largely on traditional economic and social systems. In short, society produced what it consumed. But after the foundation and expansion of PZ Cousins, society now consumed what corporations produced. This is a core societal shift, showing that PZ Cousins didn't just sell products, it helped industrialize everyday life. Good day, mentors, mentees, and everyone present here today. I, Halima Yusuf, along with my teammates Oyeye Mary, Patrick Philip, and Ibrahim Israel of Team NextGen, present to you a company analysis on PZ Cousins. Patrick, can you take us on an overview of the business description?
All right, thank you very much, Halima. Dating back to 140 years, PZ Cousins enjoys a rich heritage. Its story is one of a strong growth built on family values that have guided generations as the company has expanded around the world to do the right things. Over those years, the company has grown to become an international consumer goods group that champions the well-being of people, families, and communities everywhere, and is home to some of the world's best loved and most trusted brands. PZ began in Sierra Leone, West Africa in 1884 when founders George Patterson and George Zucconis began trading commodities with the UK. Nearly a century later, in 1975, the firm acquired the equally industrious Cousin Group, creating the PZ Cousins we know today. PZ Cousins PLC is the parent company. It's the major British multinational manufacturer and distributor of personal healthcare products, household goods, and consumer products. With over 2,500 employees, the company is headquartered in Manchester, England, and is publicly traded on the London Stock Exchange. It has a long history of doing business across Africa. Europe, Asia Pacific, and other markets, with Nigerian being one of its largest and most important markets. PZ Cousins also operates in Ghana and Kenya and has growing distribution reach across West and East Africa.
Thank you, Philip. Now that we understand the business, Mary, can you tell us about the brand?
Thank you very much, Halima. Now let's talk about the brand. In general, there are two main parts of the brand portfolio, the must-win brands and the portfolio brands. Must-win brands have leading positions in priority markets and are the focus for investment, while the portfolio brand each have a specifically designed role to play within the portfolio. The company's core brands are divided into three categories: hygiene, baby, and beauty. PZ Cousins Nigeria PLC is a subsidiary company. It is the largest operating unit in Africa and publicly traded on the Nigeria Exchange. Founded in 1899, it has been part of Nigeria life for over a century, generating a significant share of African revenue and historically often ranked as one of the top FMCG players in its categories. It operates in two main segments: home and personal care, which is inclusive of Imperial Leather, Cousins Baby, KRS, Premier, Joy, Money Fresh, Zip, Canoe, among others, and durable electronical appliances, which is inclusive of Hair Temalco. These brands are widely distributed across Nigeria's retail outlets, markets, and supermarkets, and are household names in personal and home care. Historical PZ Cousins had brands in the food space, though many have been diversified to focus on core segments: Nunu Milk, Olympic, Course, Mama Joy Oil, and Devon Kings. They are formerly active in edible oils and dairy before divestment to companies like Freshland Compania Wamco.
As we can see, the brand of Cousins is very wide. Now, Israel will take us on the ESG of PZ Cousins.
Thank you, Halima. Committed to shaping positive change, PZ Cousins' sustainability strategy is anchored in its corporate purpose: for everyone, for life, for good. This purpose underpins the company environmental, social, and governance framework that guides how sustainability consideration are integrated into its business operation and stakeholder engagement. Environmental for life. We address all environmental impacts with our purpose in mind. From an environmental perspective, PZ Cousins demonstrates responsibility through systematic management of its environmental impact. Under its Better for All framework, the company monitors and seeks to reduce energy, water consumption, minimize waste generation, and promote responsible packaging practices. These efforts are completed by a community-based environmental initiative, including clean-up activities and sustainability awareness campaign, which reflect to a commit preserving natural resources and improving environmental quality. S for everyone, social. We are committed to providing high quality and safe products to our consumers and customers. The social dimension of PZ Cousins ESG approach focuses on people both within the organization and in wider community. The company places emphasis on employee health, safety, and development while ensuring that products meet high standard of quality and consumer safety. In addition, PZ Cousins engages with host communities through health, hygiene, and environmental programs, working collaboratively with stakeholders to support social well-being and sustainability living practices. Governance for good leadership. Our leadership team provides entrepreneurial leadership of the company with a framework of prudent and effective governance. Effective governance underpins the credibility of PZ Cousins' sustainability commitments. ESG considerations are embedded into corporate decision making through structured oversight, mutuality assessment, and performance monitoring. By aligning with recognized global standards, including the principle of the United Nations Global Compact, which is the largest corporate sustainability initiative in the world, and maintaining strong ethical and compliance framework, the company promotes transparency, accountability, and responsible business products. PZ Cousins' ESG approach goes beyond ticking boxes. It's woven into the company's DNA and emphasized through a formal framework known as Better for All, supported by real community action, operational commitment, and global governance standards.
Thank you, Israel. As we can see, PZ Cousins is really committed to shaping positive change, just like its purpose for everyone, for good, for life. Now, let's look at the risks faced by this company. PZ Cousins Nigeria faces several investment risks that have historically influenced earning stability and shareholder return. First, the currency risk. It is of top concern. The company depends heavily on imported raw materials and packaging. Naira depreciation and limited access to foreign exchange have significantly increased costs, directly reducing net income and dividends. This risk is classified as high probability and high impact. Second, the cost risk. From inflation in raw materials, energy and logistics also carry high probability and high impacts. Weak consumer purchasing power limits the company's ability to pass costs to customers, compressing margins and lowering profitability. Third, market and competitive risk. It is of high probability but medium impact. Intense competition from both multinationals and local FMCG players pressure pricing and sales volumes, although strong brand equity has partially mitigated losses. Next, we look at the credit risk, which includes delayed payments or defaults from distributors, and liquidity risk due to short-term borrowing and medium probability and medium impact. These can constrain cash flow and increase finance costs, moderately affecting shareholder return. Next, we look at the political and regulatory risk. This also falls in the medium category, as import policies, tariffs, and foreign exchange regulations can disrupt operations intermittently. Finally, we are looking at the reputational or brand risk, which is low probability but medium impact, since any product's quality or social concern could affect long-term sales and customer trust. In summary, the risk matrix clearly highlights that currency risk and cost risks are the most critical for earnings and shareholder returns, followed by medium-level risk like competition, credit, liquidity, and regulatory exposure. Now, Phil will take us on an overview of the FMCG industry.
The FMCG sector is a fast-paced and competitive industry driven by a large growing population. It encompasses essential products that are purchased frequently and consumed rapidly. The FMCG market is highly competitive with both multinational corporations and local manufacturers vying for market share. Key players include PZ Cousins, Unilever, Nestle, amongst others.
Now that we understand the industry, we will now be analyzing the financials of PZ Cussons based on its biggest competition in the industry, Nestle and Unilever. But before that, let's take a look at Cussons' revenue trend.
From 2020 to 2022, PZ Cousins reported revenue showed mild fluctuation, small growth in 2021, followed by a slight contraction in 2022, reflecting a combination of uneven demand and early macro pressure entering the post-pandemic economy. However, the most dramatic change occurs from 2023 to 2024, where revenue dropped from £656.3 million to £527.9 million. This 19.6% reported drop is primarily due to the sharp devaluation of the Nigerian naira, which was around 70% weaker in 2023-2024 period compared to the prior year and significantly reduced the selling value of sales generated in Nigeria, which historically accounts for a large portion of group revenue. On a like-for-like basis, revenue actually grew modestly, indicating demand remains resilient even though the reported top line fell due to currency translation effects.
Based on the graph we can see on our screens, we can note that the volatility in revenue growth across the FMCG industry from 2020 to 2024 was driven by global structural shocks rather than company-specific failures. The period represents one of the most disruptive circles in modern FMCG history. During the COVID-19 shock in 2020 to 2021, FMCG demand didn't fall uniformly, rather, it shifted. It boosted home care, food staples, and hygiene products, but reduced out-of-home consumption with premium and discretionary category. Nestle benefited strongly due to food staples and exhibited steadier growth. Unilever had mixed exposure and showed moderate volatility, while PZ Cussons suffered due to its category concentration, therefore showing higher sensitivity. But during the post-pandemic cost inflation in 2021 to 2023, global input costs surged and companies raised prices aggressively to protect margins. This created high revenue growth in some years, followed by slower growth as customers traded down. Nestle showed strong pricing power and absorbed inflation better. Unilever balanced but faced volume elasticity. However, PZ Cussons' revenue performance has been heavily influenced by the sudden and steep devaluation of Nigerian naira, particularly in 2023 to 2024. The naira declined sharply, which forced the group to revalue USD denominated liability and recognize large foreign exchange losses, driving the 2024 decline. The devaluation led to a reported 19.6% drop in group revenue, even though underlying operations still posted modest like-for-like growth and price increases. The company noted that price increases drove local currency revenue growth but couldn't offset the FX translation losses. This explains the sharp decline in 2024, despite relatively higher reported sales in local markets. PZ Cussons' negative growth in 2020, 2022, and 2024 largely reflects currency depreciation and FX translation impacts, not necessarily operational declines. The 2023 jump shows price adjustments before the full devaluation hits. Mary and Israel will now take us on a look of the profit margins of PZ Cussons.
The gross profit margin spiked from 12.8% in 2020 to near 39% levels in 2021-2023, before declining sharply to 24.8% in 2024. Two main factors explain this pattern. First, margin expansion in 2021-2023. Early improvement was driven by price mix enhancement and cost pass-through strategies in key markets, which help protect margins despite inflationary cost pressure. Prices increased outpaced raw materials inflation to some extent, lifting gross margin towards 38 to 39%. Secondly, margin compressed in 2024. The notable contraction in 2024 is largely due to currency devaluation effects and inflation. Although for like-to-like revenue grew, The sterling report impact of naira weakness reduced the revenue based on dominated in the group functional currency. At the same time, input costs remained elevated and fixed costs did not decline proportionately, leaving less room for margin protection and resulting in overall gross margin compression. Thus, the high margins in prior year reflected normalized pricing strategies, while in 2024 margin slump reflects transition drag and persistent cost pressure.
Similar cases is seen in the net profit margin. The net profit margin figures show negative in 2020, minus 10.7%, positive growth from 2021 to 2023. A sharp negative swing in 2024, given at minus 13.6%. This can be explained. The 2020 negative margin is a residual impact of COVID-19 disruption and early cost pressure, where prices increased were insignificant to cover elevated operating costs. As for the 2021 to 2023 positive margin, the group benefited from aggressive pricing strategies, relatively stable currencies, and improved operating leverage, where revenue growth and pricing help absorb rising costs so that profit to cover into positive territory. But in 2024, net loss was recorded due to massive foreign exchange losses from Nigeria, which were a non-operational drag that overwhelmed underlying profitability. The group recorded large FX revaluation losses due to naira devaluation, which hit the bottom line significantly and led to an unfair tax loss margin of minus 13.6%. Even though revenue on a local currency basis grew modestly, the sterling transition losses and high cost of sales drove a net loss. This sharp swing explains why the 2024 net profit margin turned deeply negative despite ongoing operation and pricing efforts. But despite it, PZ Cussons still has a strong competitive edge and growing plan.
Thank you, Mary. PZ Cussons still has a strong competitive edge. PZ Cussons' competitive edge lies in its strong heritage brand, deep local market knowledge, and established routes to market capabilities in priority regions. The company's growth strategy focuses on deepening penetration in core markets, strengthening brand equity, and expanding into adjacent categories. And its unique selling point lies in its ability to combine trusted, everyday consumer brands with strong local relevance in emerging markets. Mary, can you take us on an overview of the SWOT analysis?
PZ Cussons PLC SWOT overview. According to the SWOT analysis, we can see that PZ Cussons benefits from a portfolio of trusted heritage brands and a strong focus of personal and home care, supported by established distribution network across the UK, Nigeria, and selected emerging markets. However, its smaller scale relative to global FMCG, PS, and high exposure to currency volatility, particularly in Africa, constrained margin and earning stability. Looking ahead, growing demand for hygiene and wellness products, rising population, and expanding digital channels present clear growth opportunities, especially in emerging markets where the company already has strong brand relevance. These opportunities are balanced against intense competition from multinational FMCG players, ongoing supply chain and regulatory pressures, and the need to adapt to increasingly sustainability driving customer preferences.
Thank you, Mary. So in conclusion, PZ Cussons PLC remains resilient in a volatile FMCG environment, leveraging its heritage brand, strong distribution, and local market knowledge. Overall, PZ Cussons is well-placed to navigate short-term challenges while capitalizing on sustainable growth opportunities. This is a company analysis of Team NextGen on PZ Cussons. For everyone, for life, for good. Thank you.
Thank you very much, Team Next Gen. Thank you very, very much. I think my only comment would be this: you are the first team that I've seen that had this much, that have paid much attention to their end credit. That's your reference list, and I like it. Maybe because I'm into academy, and one of the things that we encourage most is that we have students have good citations and reference lists. So I like that. But feedback on your actual business analysis would be given by other mentors. So do we have any mentors that want to give Team Next Generation feedback? Yes, Dr. Yusuf.
Thank you very much, Team Next Gen. I want to say well done with the confidence, with the energy. I enjoyed the energy from the start to the end. So I want to say well done. Well, I have I think let me first of all talk about the presentation, and then I'll ask two questions. So the first one I wanted to mention was um, whenever try as much as possible. I know part of the preparations would include you rehearsing, so try as much as possible to um, practice the difficult words that you probably are struggling with, or if you are struggling with it, you probably it's best for you to change those words. It's just because when you go out there, you want to make sure that you're not struggling to pronounce something, or you're not struggling to like I think someone was struggling with divestment, someone was struggling with what was the second one that I put down? There was another one that saw another team member was struggling with. So try as much as possible. If you've during your rehearsal, if you see that, oh well, this word looks like I'm going to struggle in the main presentation, just there are a lot of other words that you can replace them with. So try as much as possible to look into that. I love the transition. I love the structure as well, the way you are passing it from one person to the other. I love the fact that you used ratios and you compared it with Nestle. A bit, you were a bit above the time, and I think I can relate it back to the time spent on ESG. I think having 3 slides on ESG, I don't think is, I don't know. You could have like put a concise one slide to just talk about the way other teams have done about the ESG part, but you spend an extended time on ESG, which made you go above the time, like be about 3 minutes or so. So try as much as also in your graphs. Anything that is redundant, anything that does not add any value to your slide, just try as much as possible to remove it. I can see part of your slide. I was seeing column one, column two, and then PZ cousins. So that column one and column two, if they are not there, or if there are not any companies you are trying to compare, I'm sure the graph was to compare other companies. But if column one and column two, if they have no companies to compare, then you have to remove it so that it will only show PZ. So we just seeing column one, column two, it's not really nice. Okay, but aside that, I think the delivery was good. The confidence, the contact as well was really good. Um, what I wanted to say is I'm not sure you. I think you spent time uh on the profit margin, but I just felt I wanted to see a bit more in the financial side, maybe a bit more analysis. Something was just missing. I think before you went to the SWOT, something was missing with the analysis. But I mean, well done to you guys. I wanted to ask the question I wanted to ask was why did you put credit and liquidity risk in medium risk? Um, yeah, that was my question. Why did you put credit and liquidity? I just want to know exactly um why you've put them there. Also, in your graphs, make sure that if you are using naira, put naira there. You didn't really specify if you are using naira or dollars, so make sure next time you put them there. So why can you tell me why you've put in the risk matrix? Why have you put that under medium? Was there any reason why you've put that under medium instead of maybe low or high?
Okay, well, it is medium because, as you can see, the revenue of PZ Cousins is actually fluctuating. So It's on medium because they are a large brand, they are a strong brand, they are old brands, they have been around for long. So they are not really, we can't really say that they are going to liquidate so easily. And you can see that their market is actually large, but at the same time we can see that it's not really being profitable all the time. It's actually, they're actually incurring losses most of the time. I think out of the 5 years they inquired loss, not I think, yes, they inquired loss 3 years out of 5 years that we analyze. So that's why we put it on medium, because although they have a large brand and a strong company, they are facing losses. That's why we put them on medium.
Okay, what is credit risk and what is liquidity risk?
Yeah, I didn't get that.
I just want to know if you understand what is credit risk and what is liquidity risk. Those two risks, what can you explain what they are to me?
Okay, so the liquidity risk is the risk that the company faces of liquidating. That is the likelihood of them to like liquidate. That means like stop producing, stop working. The credit risk, okay, it is the risk that they face, the likelihood of them to like not be able to like not, how do I put this in words? Um, not being able to pay, not being able to like pay their debts. That's their credit risk. Not being able to generate enough money for the company.
Okay. Okay. All right. Thank you. I just wanted to make sure you understand those risks and why you've put them in medium. Because probably if you provided some numbers with regards to the liquidity risk, maybe using liquidity ratio, something like that, to say, okay, because of this ratio, maybe the ratio is 0 point something, and that is why you've put it as medium because of this ratio. That would have been a better justification for putting it at medium or high or low, or if you've used some sort of metrics. So it's just when you want to do things like this, you need to back it up properly to make sure that to let your audience know that you understand what you're doing, and you that is why you've done what you've done. But thank you for answering. Well done to you guys.
Thank you. I've noted that.
Well done, well done, well done. I'm just gonna stop sharing. Right. Okay. Well done, Alima and our team. Well done, Team Next Generation. Like you guys know, there's no doubt in your confidence. Your team has got great confidence level. Your organization and structure has always been top notch right from the beginning. So, and I don't think you did any less in this particular presentation. So well done. Good job. All right. So we're going to move to the next set of presenters for the competition. We are behind schedule, but we are trying to move. That's why we try to start early today so that we can move as fast as possible. All right. So the next team that is presenting is Team Zenith and Apex. Also, please, mentors, this is a team that we need to look out for. The max or the final decision for this next two set of presenters will determine again who goes third, second, or third. So these are high contenders currently on the board. So please do pay attention to all details, enunciation, the analysis, their confidence, their delivery, the structure, the transition, everything we need to pay attention to, because that would be what would determine the final scores at the end of the day. Are you guys ready for us?
Yes, ma'am, we're ready.
Excellent. All right. So we'll start with Team Zenith, and they are carrying out a company analysis on Unilever. You guys can project your slides, and then once you start presenting, we'll start your timer.
From the streets of Lagos to village markets, into homes where not-seasoned jollof rice simmers, to kids smiling with Pepsodent bright teeth, and friends sharing a cold Lipton iced tea on a sunny afternoon. That is Unilever Nigeria, woven into everyday moments. I am Wati Oluwasemilore, bringing elegance and fragrance. And with me, I would call David, adding flavor and depth, Fadimoya Yodeji, spreading smoothness and nourishment, and our group leader, Adeshina Oluwasolafumi, combining our zest, richness, and allure. Now, let us dive into Unilever Nigeria's story as Shola takes us on a tour of its landscape.
Unilever Nigeria, a leader in the fast-moving consumer goods industry, a company that has operated in Nigeria for over a century. In 2023, Unilever Nigeria deliberately stepped away from some of their most familiar products. Today, the company focuses on four major categories. First, oral care. This includes Close-Up and Pepsodent. Close-Up dominates the toothpaste market, while Pepsodent focuses on oral health and children dental care. Next is skincare. Brands like Vaseline and Pears. Vaseline remains the #1 petroleum jelly in Nigeria. Pears focuses on baby care.
Sorry, additional. Sorry, I'm sorry to stop you. Sorry. I don't want you to lose marks because of this. I think one of your devices is on mute. So mute one and unmute the other one.
There is only one device.
Because well, we're getting some form of feedback. I'm not sure why that is. And I already want you guys to have the best experience of presenting. Okay, let's see if it continues. Yeah, I think it's better now. Yes, it's better now. So you start all over again. Start over. Yeah.
Thank you, Mom. Thank you so much.
From the streets of Lagos to village markets, into homes where not-seasoned jollof rice simmers, to kids smiling with Pepsodent bright teeth, and friends sharing a cold iced tea on a sunny afternoon. That is Unilever Nigeria, woven into everyday moments. I am Wati Oluwasemilore, bringing elegance and fragrance. And with me, I would call David, adding flavor and depth, Fadimoya Yodeji, spreading smoothness and nourishment, and our group leader, Adeshina Oluwasolafumi, combining our zest, richness, and allure. Now, let us dive into Unilever Nigeria's story as Shola takes us on a tour of its landscape.
Unilever Nigeria, a leader in the fast-moving consumer goods industry, a company that has operated in Nigeria for over a century. In 2023, Unilever Nigeria deliberately stepped away from some of their most familiar products. Today, the company focuses on four major categories. First, oral care. This includes Close-Up and Pepsodent. Close-Up dominates the toothpaste market, while Pepsodent focuses on oral health and children's dental care. Next is skincare. Brands like Vaseline and Pears. Vaseline remains the #1 petroleum jelly in Nigeria. Pears focuses on baby care. Then we have deodorants, led by Rexona. And finally, nutrition, Knorr, Royco, and Annapurna. Knorr promotes better nutrition. Royco competes strongly against in the seasoning markets, and Annapurna was introduced as an affordable option for price-sensitive consumers. That is the Unilever Nigeria story today. And this shift is deeply rooted in Unilever Nigeria's business model. So let's break that down. First, who are the consumers? Unilever Nigeria serves everyday Nigerians, but more importantly, they actively target price-sensitive consumers. That is why they introduce smaller pack sizes for their toothpaste and affordable brands like Annapurna. Because when purchasing power drops, do people stop buying food and toothpaste? Of course not. They simply buy cheaper options. Moving on to distribution, their products reach Nigerians through a wide network of key distributors, wholesalers, and retailers. Next, what value does Unilever Nigeria offer? Their value proposition is simple: affordable products, trusted quality, and brands with purpose. Now, let's talk about how they operate behind the scenes. Unilever Nigeria's key activity revolve around manufacturing, marketing, and distribution of consumer goods. But recently, they've added something even more important: local sourcing. Over 50% of their raw materials are now sourced locally. This reduces dependence on foreign exchange, exposure to forex volatility, and supports Nigerian farmers. Now, let's talk money. How does Unilever Nigeria make revenue? The answer is simple: selling products. The company generates the vast majority of its revenue from the domestic sales of manufactured products. Most of their revenue comes from nutrition products, contributing about 62% of their total revenue. Oral and skincare follow closely behind. What about cost? Their biggest cost is raw materials. That is why exiting low-margin products was critical. It reduced pressure on cost and improved profitability, and the results speak for themselves. Spot analysis. Strengths. Unilever Nigeria demonstrated strong revenue growth in 2024, driven by a focused portfolio of high-growth categories. Their domestic market dominance is clear. About 97% of revenue came from Nigeria. Local sourcing initiatives also strengthen supply resilience and reduce foreign exchange exposure. Weaknesses. However, the domestic dominance is a double-edged sword. With 97% of revenue from Nigeria, the business is heavily dependent on one market. This exposes the company to local economic challenges, especially declining consumer purchasing power. So if purchasing power drops, Unilever feels it, and they have to adapt quickly. Opportunities. There is increased demand for affordable nutrition products. Smaller package sizes appeal to price-sensitive consumers. Growing youth and urban population presents opportunities for more demand. Put simply, local relevance is a growth opportunity. Threats. Unilever Nigeria operates in a challenging environment. Inflation and currency instability could continue to erode consumer spending power. Competition from cheaper brands remains active, and Shemilore will now paint us a full picture of the industry analysis.
Let us dive into the Potter's 5 analysis. Competitive rivalry is high due to strong competitors, low product differentiation, and similar cost structures in the FMCG industry. This squeezes margins and forces continuous marketing investments. Moving on, buyers hold significant power due to numerous alternatives, easy switching, and price sensitivity of Nigerians. Unilever must justify pricing through quality, branding, and promotions. Next up, suppliers have moderate power due to multiple sources, Unilever's global reach, and in Nigeria's economic instability. Managing relationships is key. Shifting focus, new entrants face moderate barriers due to skill, loyalty, and distribution. Unilever Nigeria's strength protects its turf. Lastly, substitutes pose a moderate high threat from local brands and private labels. Unilever must reinforce its brand value. Transitioning to the personal analysis, political factors. Regulatory changes impact operations, instability raises costs. Local sourcing and compliance are priorities. Tax policies, trade tariffs, and governance affect operations. In addition, economic factors. Naira volatility and inflation challenging pricing, but Nigeria's youth presents growth. Economic instability affects pricing, focus on value for money products. Also, the social factors. Young population drives demand, but requires tailored product and affordability. Furthermore, technological factors. Digital transformation boosts reach and efficiency. E-commerce growth in Nigeria, data-driven marketing and supply chain. On the legal front, NAFDAC regulations and taxes add complexity. Can Unilever Nigeria navigate this? Compliance is non-negotiable. Lastly, environmental factors. Sustainability is critical in Nigeria. Can Unilever Nigeria lead the charge? Reducing environmental footprints, sustainable sourcing initiatives. What then are the strategies to give Unilever Nigeria the edge? Leveraging iconic brands and innovation, adapting to local taste and economic realities, and investing in digital and sustainable practice. But how does it stack up against the competition? Over to you, Ayodeji, to take us through it.
Thank you, Shemilore. Building on that industry outlook, let's drill down into the competitive landscape where Unilever Nigeria position is defined by distinct structural divergences from its key rivals. First, we look at Nestle Nigeria. While Nestle retains volume leadership in the bouillon seasoning category, financial disclosures highlight a critical vulnerability. They carried significant foreign currency denominated debts during the 2023-2024 volatility period. According to their 2024 annual reports, this exposure triggered revaluation losses over 100 billion naira, pushing them into a negative equity position. Next, looking at P&G. Following P&G's strategic exit from local manufacturing by transitioning Oral-B to an import-only model, they now fully exposed to import duties and port delays. This hands Unilever a tangible gross margin advantage. Finally, Promasidor. Unlike the listed peers, Promasidor is a private entity. with aggressive market behavior in the bottom of the pyramid segment with hunger. Unilever has effectively mitigated this threat by deploying value-engine variants like Anapuna to match price per gram proposition without eroding premium brand equity. To illustrate how this resilience translates into performance, David will now take you through the financial details.
Unilever Nigeria's financial performance was assessed across profitability, liquidity, and solvency metrics to provide a holistic view of its earnings quality, short-term liquidity position, and long-term financial risk. Starting with profitability, Unilever, just like every company in Nigeria, has faced pressure on its margins in recent years due to factors like FX volatility and rising costs. However, despite all this, Unilever has consistently delivered relatively better margins than its peers. Their gross margins increased to 38.73% in 2024 from 37% in 2023 due to better cost optimization. Their net margins have been better when compared to peers in the industry like Nestle, Cadbury, and PZ. They have also maintained positive return on assets and return on equity, each result reaching 10.7% and 17.8% respectively in fiscal year 2024. In terms of liquidity, Unilever has maintained strong liquidity. Its quick ratio over the past 5 years has stayed above 1.5x. Comparing its current ratio with peers, Unilever's ratio almost always doubles that of the industry average. The reason behind this is that Unilever has low reliance on short-term borrowings and relies more on trade payables. Also, Unilever holds larger cash balances compared to its peers. This signals less aggressive balance sheet optimization, although it acts as a buffer in the event of distress. Now, over to solvency. As stated earlier, Unilever maintains a low debt exposure with zero to negligible loan and borrowings on their balance sheets in 2020 through 2022. In 2023, the company took on a loan to support its sustainability partnership with recyclers, which is reflected as non-current borrowings. While this slightly increases reported debts, the loan is outcome-based and modest in size, so it does not materially affect Unilever's strong solvency position. Now, let's take a more recent look at Unilever's recent performance in 2025. Results in 2025 so far has been significantly positive when compared to the similar period in 2024. Revenue has grown at an average of 50% quarter on quarter. Based on the results, we forecast revenue to grow as much as 51% year on year in 2025, putting into consideration stronger demand in Q4 due to the festive period. Drivers of the performance in 2025 include a more stable macroeconomic environment with easing inflation and FX stability, as well as portfolio optimization with focus on higher margin product categories and improved supply chain management. This led to stronger domestic demand, which contributes over 95% to total revenue. Now, let's take a look at the ESG analysis.
Thank you, David. In the volatile landscape of the Nigerian fast-moving consumer goods sector, stability is rare, but sustainability is even rarer. In analysis, we analyze Unilever Nigeria not against global standards, but against the harsh realities of the local operating environment. We utilize a localized industry benchmark using the Morgan Stanley Capital International Framework and Carroll's Pyramid to evaluate their performance. The benchmarks were informed by public information available from various news outlets, as well as the company's annual reports regarding the fast-moving consumer goods sector and ESG sustainability in Nigeria. The verdict is clear. With a weighted score of 7.4 out of 10, Unilever earned a double A leader rating. Now, let's break down the ESG scorecard. First, the environment. While the industry average is a weak 3.5 due to the single-use plastic crisis, Unilever scores a leader level 9. Why? Because in late 2024, they achieved plastic neutrality through their partnership with recyclers. They now collect more plastic waste than they produce. Next, the social pillar. The industry struggles with transactional community relation. Unilever, however, scores a 9 for transformational impact. Their Shakti program has empowered 13,000 rural women as micro-distributors, increasing household incomes while solving Unilever's own logistics challenges. Furthermore, the product safety score is driven by the DFQT Plus system, which allows digital real-time verification of food fortification, far exceeding the NAFTA requirements. Finally, governance. Here we see a more nuanced picture. Unilever scores a gold standard 9 for board independence. However, we assigned a laggard score of 4 for ownership and control. This is due to a 2% technical service fee paid to the parent company. While this reduces the local dividends, our analysis shows that it is necessary trade-off to assess this global research and development that keeps the company resilient. Now, onto the Carroll's Pyramid. At the base, economic responsibility. Unilever proved that profit protection requires courage, and in 2023, they made the difficult decision to exit the home care and skin cleansing market to stop market and margin dilution. The result, a 44% surge in revenue in 2024. They secured this business survival. Level 2, legal responsibility. They are a model corporate citizen, paying over 7.5 billion in taxes in 2024 and maintaining strict compliance with the Nigerian Code of Corporate Governance. Level 3, ethical responsibility. They go beyond the law. Why not legally require to police their suppliers? Their responsible partner policy actively audits their supply chain against child labor. They also enforce a living wage policy that pays above the national minimum wage, effectively buying labor peace in a strike-prone sector. At the top, we have philanthropic responsibility. This isn't just charity, it's nation building. Their Future X program is upskilling 700,000 Nigerian youths, directly addressing the country's unemployment crisis. It is clear, Unilever Nigeria is an outlier, a sustainability leader. At this point, Shemilore will now take you through the outlook for Unilever.
Before diving into our outlook for Unilever, it is important to review the company's stock performance over the last 5 years. Between 2020 and 2022, the stock experienced significant declines due to factors such as the pandemic, rising inflation, and the interest rate environment. Recovery picked up strongly in 2024, with the stock rising 77% during the year, driven by strong revenue growth and renewed investor confidence in the company's fundamentals. Year to date, the stock has gained 89.47%, rising from 38 naira in January 2025 to 72 naira in December 2025. This strong performance reflects continued optimism around revenue growth, improved profitability, and stability in earnings. So, what's the outlook for the company stock? David will be taking you through that next.
Based on our projections, we issue a old recommendation as the outlook for Unilever Nigeria indicates potential for continued steady growth with a target share price around 79 naira, implying a 9.7% upside from current levels. We project a steady rise in the company's revenue over the next 5 years, growing at a CAGR of 18%, supported by expectations of stronger consumer demand. In arriving at this target, we applied a scenario-based DCF analysis complemented by a comparable company analysis. The football flip chart here illustrates well positioned to sustain steady operational growth in the coming years, with its financial performance and strategic initiatives underpinning a positive outlook for the company. While the outlook is positive, there are 3 major risks that could impact Unilever's performance. First, macroeconomic and currency volatility could affect input costs. Second, intense competition from both local and international FMCG players may limit pricing power. Third, supply chain and operational disruptions, including rising energy and logistics costs, could put pressures on margins. These factors should be monitored closely as the company executes its growth strategy.
Now, this brings us to the end of our business analysis and the Daytopia University competition. We hope you have enjoyed our seasoned and well-structured presentation as much as we enjoyed putting it together. Thank you for listening.
Thank you very much. Well done. Additional, well done. Ah, God, you have, I think some team leaders are very lucky. You have a fantastic team. Your team members are good. They supported the success of your team, and I just want to, I don't know who is going to be the overall winner for the best presenter, but again, just my own mentions. David, good presenter. I think it's Oluwashemilore as well. I think so. Well done. Good job. But I personally just want to say a good job to Additional. Again, it's not easy. When I see a team leader that has been able to lead their team through all this, I just like to appreciate them. So well done, guys. We won't give you feedback now. We're going to allow the next team to present, and then we'll give you guys an overall presentation at the end of the day. So thank you. All right, Team Apex, are you ready? Okay, you can project your team, your slides.
All right, ma'am. I'll share our slides now.
All right.
Think about your morning routine. The soap you use, even the tea you drink. Every day, Nigerians make choices between quality, price, and convenience. These millions of decisions drive the fast-moving consumer goods sector. I'm Adewale Iyolua, and I'm here with Adebanjo Samuel, Adebola Deborah, and Adebayo Finfolua. Together, we are Apex Consulting, presenting a comparative company analysis on Unilever Nigeria PLC. Fast-moving consumer goods are everyday essentials that sell quickly, they are consumed regularly, and often have low margins. In Nigeria, the FMCG sector is vital because it touches nearly every household and drives daily consumption and activity. With this context, I'll hand over to Samuel to give an overview of Unilever Nigeria PLC.
Thank you, Deborah. Building on the fast-moving consumer goods context, let's take a closer look at Unilever Nigeria PLC, one of the longest established manufacturers in the country, operating continuously since 1923. Unilever Nigeria became a public limited liability company listed on the Nigerian exchange under the ticker Unilever in 1973. Unilever Overseas Holdings (BV) holds about 76% of the shares, while public investors hold roughly 20%, with the remainder in nominee accounts. The company's core businesses spans nutrition, beauty and well-being, and personal care, providing household staples used by millions of Nigerians every day. Local manufacturing facilities in Oregun, Lagos, and Agbara, Ogun State ensure nationwide supply, while the company's purpose to make sustainable living commonplace and brighten everyday life guides its strategy, supported by values like integrity, respect, responsibility, and pioneering. In short, Unilever Nigeria combines deep roots, trusted brands, and a clear purpose to meet everyday consumer needs. With that, I'll hand over to Iyolua, who will take us through Unilever's product portfolio and revenue contribution.
Thank you, Samuel. Unilever Nigeria's products are structured into three main categories. Nutrition, which includes household staples like Lipton, Knorr, and Blue Band. It consistently contributes the largest share of revenue, about 62% in 2024. These are essentials that Nigerian households rely on every day, making this segment very stable. Personal care covers products like Pepsodent, Close-Up, and Rexona, and this accounts for roughly 29% of revenue. These are daily use items, and then they are slightly more sensitive to price than staples, but their demand is still steady. Finally, beauty and well-being, including Vaseline, Dove, and Lux, makes up about 9% of revenue. These are discretionary products that are often purchased after household essentials, which explains the smaller share. Over the period of 2020 to 2024, Unilever Nigeria's total revenue grew from 52 billion to about 149.5 billion, showing how they balance essential staples with smaller, high-value items to meet their consumer needs. I will now hand over to Finfolua to walk us through Unilever's strategic market and positioning.
Thank you, Iyolua. Over the last 5 years, Nigeria faced significant economic challenges, including high inflation and currency depreciation, which made essentials more expensive. In response, Unilever Nigeria adopted a multi-tiered strategy. For low-income households in rural and peri-urban areas, the company introduced smaller pack sizes and sachets like Omo, detergent, close-up toothpaste, keeping products affordable. At the same time, premium brands like Dove and Sunsilk continue to meet the needs of middle and upper-income urban consumers. This approach balanced affordability with quality, maintaining relevance across income groups, and also distribution covers both urban centers like Lagos and Abuja and rural markets through supermarkets, local shops, and informal channels, ensuring accessibility. Overall, this strategy reinforces Unilever's position as a trusted multi-segment, fast-moving consumer good player, combining deep market reach with strong brand presence. Debbie, I will hand over to you to walk us through the marketing, distribution, and growth strategy. Thank you.
Thank you. To understand how Unilever Nigeria thrives, especially during tough times in the FMCG sector, the question is simple. How do these products actually reach everyday Nigerians? Between 2020 to 2025, Nigeria faced high inflation, a weaker naira, and more price-conscious consumers. In this environment, availability mattered as much as advertising. Unilever's solution was a structured distributor-led system. Regional distributors purchase in bulk and deliver to open markets, neighborhood kiosks, supermarkets, and modern retail outlets. The country is divided into geopolitical zones to ensure coverage across urban and rural areas. This approach allowed the company to reach Nigerians wherever they shop. Marketing execution mirrored this reality. Campaigns tied directly to how people live, cook, and shop. For example, Knorr was built around Nigerian cooking habits, and Pepsodent promoted oral care in schools, connecting products with everyday routines. Strategically, Unilever's purpose-led Unilever Compass framework guided its decisions. From 2020 to 2025, the company focused on portfolio rationalization, prioritizing nutrition and personal care, improving cost efficiency, expanding markets through stronger distribution, and strengthening local sourcing. Digitalized operations and resilient retail models helps reduce risk, protect margins, and adapt to foreign exchange and post-COVID pressures. From 2023 to 2025, this approach shifted Unilever from survival mode to focused, purpose-led growth, reflected in revenue expansion, margin recovery, and sustained profitability, showing that for Unilever, doing good and doing well are the same strategy. Iolua, walk us through the structural context of FMCG industry. Thank you.
Thank you, Deborah. Now, before we assess Unilever's performance, it's important to understand the environment it operates in. The Nigerian FMCG sector is low margin and high volume, covering everyday essentials. These items are purchased frequently, but the intense price competition keeps the margins tight. Structurally, the value chain, as you can see from the slide, faces pressure at every step. Many raw materials are imported, exposing manufacturers to foreign exchange volatility. Reliance on informal retail channel, it also limits scale efficiencies. Now, what sets companies apart in this sector is how efficiently they navigate this environment that is full of rising costs, foreign exchange pressures, and margin compression. With this context in mind, I will hand over to Samuel, who will walk us through how Unilever compares to its peers.
Now that we've seen how Unilever works internally, let's look at the competition. Unilever operates in a highly competitive, fast-moving consumer goods market alongside both multinational and strong local players. As you can see on the slide, key competitors include Nestle Nigeria, PZ Cousins, Cadbury Nigeria, and the Dangote Group's consumer goods businesses, each focusing on different product categories. In this landscape, Unilever stands out by operating across food, home care, and personal care simultaneously, supported by a broad brand portfolio and extensive distribution. In this challenging market, with low margins and price pressures, Unilever doesn't compete only on price. Its strength comes from scale, trusted brands, and smart management of its product mix. Deborah, over to you to walk us through the unique selling proposition.
Now that we've seen the competitive landscape, let's focus on what makes Unilever Nigeria stand out. Unilever is a diversified FMCG player across food, home care, and personal care, with trusted brands like Omo, Knorr, Close Up, Lipton, and Lux. Distribution is a major strength. The company divides Nigeria into zones, appointing distributors in each region. These distributors supply sub-distributors, who then supply retailers, ensuring products reach both urban stores and local kiosks. For local manufacturing and sourcing, over 50% of raw materials come from Nigeria, including partnerships with over 10,000 farmers for key inputs. This reduces foreign exchange risk, maintains supply, and supports local communities. Innovation keeps Unilever adaptable. The products are continuously refined and pack sizes adjusted to meet Nigerian consumer needs. Together, these pillars, trusted brands, wide distribution, local manufacturing, and sourcing, and adaptive innovation gives Unilever a unique edge, combining scale with local relevance. Iyolua, take us through the SWOT analysis.
Thank you, Deborah. Let's quickly look at Unilever's SWOT analysis. The strengths: the company has trusted brands, strong market leadership. Some of its weaknesses include relying on imported chemicals and packagings. The opportunities: Nigeria's growing population and middle class, combined with further local sourcing. This offers strong growth potential. And as for the strengths, we have the foreign exchange volatility and the rising FMCG competition. Now, Shalom, I'll hand over to you to explain Unilever's position in the market.
Now that we've seen what gives Unilever Nigeria its unique edge, let's look at the strategic choices that turn this strength into market resilience. At first, I would like us to look at efficiency versus expansion. The company prioritized operational stability, exiting low margin categories like home care and skin cleansing to protect margins amid inflation and FX volatility. For premium versus mass market, Unilever focused on fewer, stronger brands aligned with the global power brand strategy, prioritizing long-term value over share volume. For the dividends versus the reinvestment, they were carefully balanced. Shareholders' returns increased from 0.50 kobo per share in 2022 to 1.25 kobo analyzed in 2025, while reinvesting local sourcing, cost optimization, and operational restructuring. On global strategy versus the local adaptation, Unilever preserved global brand standards while tailoring its Nigerian operations through portfolio rationalization, operational redesign, and expanded local sourcing. These deliberate choices collectively shape its market positioning. Unilever maintains strong brand presence and consumer trust across multiple categories, giving it resilience despite inflation and the foreign exchange pressures. A position we can describe as strong but challenged in the Nigeria's fast-moving consumer goods landscape. I will now hand over to E for the environment, social, and government snapshots. Thank you.
Thank you, Shalom. From an ESG perspective, Unilever Nigeria integrates sustainability directly into its core operations, guided by its 2030 sustainability commitments on environmental stewardship. Unilever Nigeria partners with recyclers to reduce plastic waste, helping to collect more than 13,000 tons of plastic for recycling, exceeding what it sells in Nigeria. On the social front, the company sources over 50% of its raw materials locally, strengthening rural economies, and its Shakti Women's Empowerment Program has engaged over 13,000 women nationwide. On governance, Unilever Nigeria operates under a strong governance framework in compliance with the Nigerian Code of Corporate Governance. As at 31st December 2024, the board comprised of 9 directors, including 6 independent non-executive directors and 2 executive directors, ensuring oversight and accountability. This board was 44% female and 56 male, with diverse leadership providing balanced decision-making. Together, this ESG approach shows that Unilever Nigeria not only drives environmental and social value, but it upholds strong governance practices. With that context, I will hand over to Samuel to take us through the financial performance overview.
Now that we've seen how Unilever Nigeria positions itself for growth, the question is simple. Is this strategy working financially? Starting with revenue, the company grew steadily from 52 billion naira in 2020 to 144 billion naira in 2024, nearly 3 times higher. This shows that focusing on key brands and meeting consumer needs and meeting consumer paid off, even with inflation and currency pressures. Operating profit tells an even more insightful story. After a loss of 5.6 billion naira in 2020 due to rising input costs, currency pressures, and COVID-19 disruptions, the company steadily regained profitability, peaking at 20.2 billion naira in 2023. The dip to a 2 billion naira loss in 2024 reflects short-term macroeconomic pressures and portfolio rationalization when Unilever exited low-margin home care and skin cleansing to focus on nutrition and personal care. But recovery is evident in first quarter of 2025 with 8.3 billion naira. Net profit margins tell a similar story, moving from roughly minus 7% in 2020 to around 15.5% in 2024. On the chart, the blue line shows net profit, the red line shows the margin, so you can see the improvement clearly. Finally, looking at one-year price performance, Unilever consistently outperformed the all-share index benchmark with a notable spike in February 2024, signaling strong investor confidence. Today, market capitalization stands at 413 billion naira, with the share price around 72 naira. In short, Unilever Nigeria have moved from survival to strong, sustainable profitability, showing that focused execution and portfolio discipline really work. I'll now hand over to Debbie to take us through fast-moving consumer goods benchmarking and see how the company compares with its peers.
Thank you, Samuel. Looking at the market and financial performance chart, we can see that Unilever sits in the middle in terms of revenue, about 200 billion, while its market capitalization is healthy at roughly 413.6 billion naira. This positions it clearly above Cadbury and PZ Cussons, which are either making loss or showing minimal profits, but slightly behind Nestle, which maintains the highest market cap and consistent profitability, and Dangote Sugar, which has very high revenue but struggles with cash conversion. Cash flow tells a deeper story. In 2024, Unilever generated positive operating and free cash flow. That is significant. It's not just selling more, it's turning those sales into real usable cash. Compared to Dangote Sugar, which brings in high revenue but struggles to convert it into cash efficiently. Looking at valuation, a price per earning of roughly 11.5x and dividend yield of 1.39% shows profitability with returns to shareholders, even as it continues to invest in growth, though there's room to improve towards the multiples seen as Nestle. Taken together, Unilever is not merely surviving, it's strategically strengthening its position. It's outperforming weaker peers, closing the gap with leaders like Nestle, and proving that disciplined execution and portfolio focus can deliver both stability and growth in Nigeria's challenging FMCG market. I'll now hand over to E to take us through the gross margin decomposition and peer comparison. Thank you.
Thank you, Deborah. Let's start with the gross margins. From 2020 to the third quarter of 2025, Unilever Nigeria has shown remarkable resilience, while competitors like Dangote Sugar and Cadbury experienced severe margin compression due to the fuel subsidy removal, naira devaluation, and rising raw material costs in 2023 to 2024. Unilever's gross margin grew from 21% in 2020 to 41% in the third quarter of 2025, nearly doubling in 5 years. Breaking down the margin drivers, we can see how Unilever achieved this. In 2021, the cost discipline and improved sales execution boosted margins. In 2022, localization further increased profitability. The net profit margins tell the same story. While competitors struggled, some dipping below 50%, Unilever consistently expanded its net margin. Overall, these results show that Unilever is not just surviving in a volatile, fast-moving consumer good environment, but it is outperforming its weaker competitors by combining strong margins with strategic resilience. The company has positioned itself ahead of most peers in Nigeria's challenging FMCG landscape. Over to you, Shalom, to explain the financial resilience.
Thank you, E. Now, I'll be looking at financial resilience across the case. This slide answers a very simple question, which is FMCG companies are actually financially strong, not just profitable on paper. Let's start with balance sheet strength. Unilever stands out because it performs well across all three areas at the same time: liquidity, cash, and returns. On liquidity specifically, Unilever's current ratio is the strongest among peers at 83%, which means it can comfortably meet short-term obligations without financial strain. It holds the strongest cash reserves among peers at about 63%, which means it has real buffers to keep operating when conditions tighten. Compare that to Cadbury, which sits around 11%, and you can already see the difference in flexibility. Now, return on equity is where this slide can look confusing at first glance. PZ Cushing's shows a very high return on equity of about 148%, but that's not pure strength. This figure is inflated because the company was recovering from negative equity in 2024. In simple terms, the base was weak, so the percentage looked large, but the balance sheet is still fragile. The real risk shows up clearly in the debt to equity chart. Cadbury's leverage is extremely high at over 1,800%, which signals balance sheet stress and severely limit future growth. Dangote Sugar is also heavily leveraged, but Unilever is different. Its debt to equity sits as much more conservative, 77%, showing disciplined financial management, profitable but not over leveraged. So the key takeaway is this: while some peers show extreme numbers that marks underlying weakness, Unilever shows balance, strong liquidity, solid cash reserves, controlled debt, and sustainable returns. That balance is what makes it the most financially resilient, fast-moving consumer goods player among its peers. I will now hand over to Samuel to present the bull case. Now, Samuel, please, can you do that for us?
Thank you, Shalom. Looking at the good drivers on this slide, first, market leadership and brand power. Unilever has over 40 years of consumer trust and strong brands, giving pricing power even in challenging times. Next, balance sheet strength. The company maintains solid financial metrics, continue paying dividends, and retains capacity to acquire competitors if opportunities arrive. Then, Nigeria's macro recovery, stabilizing inflation and a stronger naira improve consumer purchasing power while sourcing 41% of raw materials locally. And this protects margins. Finally, long-term demand opportunity. With a population of 220 million growing 2.5% annually, Unilever gains roughly 5.5 million new potential consumers each year. Over to Deborah to present the bear case.
Thank you, Samuel. Now, looking at the risks on this slide, volume pressure means total sales could be limited if consumer demand softens, affecting revenue. Foreign exchange vulnerability is there because some key inputs like chemicals and packaging are still imported, so currency fluctuations can increase costs. Rising competitive threats indicate stronger, more aggressive competitors, putting pressure on Unilever's market share. Finally, a fragile macro recovery shows that the economy is not yet fully stable, which could impact consumer spending and overall performance. These risks, clearly visible, are real and could affect Unilever's results. Over to you, E.
Our recommendation is clear. Buy. Based on everything we have seen, Unilever Nigeria combines market leadership and Nigeria's long-term consumption growth, which together outweigh the short-term FX and volume pressures. In conclusion, Unilever Nigeria has shown strong resilience through trusted brands, disciplined strategy, and efficient operations. Combined with its ESG commitments, the company is well positioned to create sustainable value for the consumers, investors, and the wider economy. Thank you.
Thank you very much. Thank you very much. Okay. So I'm just going to start by saying this. This both presenters or teams rather Can you guys hear me? Okay. Well done. Good presentation. Good presentation to both teams. What I just wanted to say again, this is based on my own feedback. We know Team Zenith for their good slide, their details in terms of their intentionality in terms of their slide. But personally, I think Team Apex did fantastically well with their slides this time around. I feel like they did very, very well. I like talking slides. I like slides that are very engaging, and I personally think that Team Apex had a good slide in terms of engagement. Their slides were very engaging. Who is the team leader, please, for Team Apex? Is it Deborah?
Yeah, Deborah Iwulo.
All right. Okay. Well done. Well done. You did a good job with the slides. Good job. Good job.
Thank you, Mom.
Also, I can't lie, both teams had good confidence level. Like God, like the confidence, it's like you guys came and like, I will not grill. Like I feel like if again, this is based on my own comment, I feel like the scores might be very, very close because in my own head, I'm just trying to think of what one team did better and the other team did not do better. So confidence level was 100% from both teams. I cannot even lie. And the details in your analysis was good as well from both teams. So well done. I'm going to call on other mentors to give you feedback on your analysis and the details inside it. But from my own understanding, I think that both teams did a good job. Okay.
All right. Can I go for it?
Yes, please. Yeah, I was going to call on
I think you have said it all with what the two teams have done. It's very, very hard to say what one team or the other has done more than the rest. Everything that is expected in a comprehensive company analysis was given. The business model was really, really well explained, especially by the first team. The financial performance, top notch from both teams. The market analysis is very, very good. Looking at the competitive landscape, what you guys did there, very, very good. We could see how the first team talked about briefly about the competitive landscape, but the second team took it to the next level, which was very, very good. So one way, one team is doing 90%, the other is doing 80%. The other time, it was interchanged, but overall, it was a very, very good presentation. I like your projection, and I think the first team did a better projection than the second team, but that doesn't take it away from all the good things that the second team had. So well done, guys. I really cannot find much fault in what you guys have presented. I just want to say both teams really went for it, and it was a good one to listen to. Well done.
Yeah, it was a very, very good one. And I'm impressed. I'm impressed because none of you were laid back. Like both teams came here and like, if I'm going to get that position, I am going to get that position. And I am, as in, I am impressed. I am impressed. Dr. Yusuf, do you have any feedback for the team? Oh, okay. Before Dr. Yusuf, since Mentor Giwa is here, all right.
Hello, Dr. Jimmy, can you hear me?
Yes, we can hear you.
Oh, good, good, good. So I have to say that the level of presentation here was impeccable. I didn't really expect that these guys would do this kind of the in-depth analysis that it did. I think from they covered all the relevant aspects of a company analysis that you should expect from a top-notch presentation. So I have to commend both of them, the two teams, on the analysis that they do. The first thing that presented, I joined after they started, but from what I heard towards the end, I thought it was a very solid conclusion to the presentation. While for the second team, there was the part they were, so when they started doing the industry analysis, they started talking about the different players in the industry and the financial performance they had was just for, I wasn't clear which is one feedback that they can take away from these comments. When they had a slide where they spoke about financial performance for different companies, Unilever and the other companies, but the financial performance did not show for what period. So you just have a slide showing revenue, net income, and margins, but you didn't have the period for it. Because I was going to say that if you want to do a financial analysis, you should do it for um, a couple of periods, whether like 5 years, 3 years, or whatever. But the slide did not even show what period you were showing the financial performance for. However, in the next slide, you guys now did a broad explanation of the financial performance for the industry, which didn't make me complain again because in the next slide, you guys spoke about the financial performance for these companies within the industry. And then I like the fact that you spoke about the drivers and you had them in different boxes for 2021 to 2024, which was very, very good. So well done to you guys.
Thank you very much. Thank you so much. Dr. Yusuf, any final comments?
Yes. Well, mentors have already said that you guys did. I don't need to emphasize on that again. So I mean I was just sitting here really enjoying the presentation. I wasn't even writing down as much because you guys really did well. Amazing presentation from both Team Zenith and Team Apex. Really strong presenters, confident as well. Good slides from both Team Zenith and Team Apex. However, one thing I wanted to good transition as well. One thing I wanted to mention as well is try as much as possible. I think I've mentioned it before in some of the graphs of Team Apex. You left column 2, I think there, which was redundant. So make sure that you just remove all those things. If there is no column 2, don't leave it as column 2. Try to remove it one way or the other. if you're not comparing it with another company. So it's just one thing to mention. Also, Apex did a lot of good analysis, the industry analysis. It would be really nice if you use a framework to do it. So you did the explanation really well. You explained it, but you could have used Spotify forces or any other one to properly like structure that explanation, just as Zenith did, which would have been a plus. I'm not sure you guys used a framework, but you guys explained the same thing, right? But it's just that it's nice if you use a framework. But I love the fact that you guys put sources in your slides, and which is really good. I was able to follow. But I think there was one more thing I put down, but if I'm not remembering right now, it's good. I mean, it means that your slides were really good. Your presentation was really good. So well done to both teams. Amazing, amazing presentation. I really enjoyed it as well. Team Zenith, I think I kind of enjoyed Team Zenith's analysis just because they went into I love when you go deeper into the liquidity, into operational efficiency, um, which I noticed as well. So I mean, but well done to both teams. Amazing, amazing work.
Thank you very much. Okay, quickly because again, well done, guys. We're moving to the next team now. We are far behind. So next team is presenting or the next set of presenters will be presenting on GT Bank, and we have Team Crest and Team Momentum walking us through their analysis of GT Bank. Do we have Team Crest here?
Yes, ma'am, we're here.
Excellent. And Team Momentum, are you here? Team Momentum, are you guys here? Do you have anyone from Team Momentum here? That's OAU Momentum. Okay. All right. So we'll start with Team Crest. If Team Momentum, we don't have them, would then decide on what we want to do with regards to that side of presentation. All right, Team Crest, you can start projecting your slides now.
Why orange? Well, GT Bank says orange indicates a person who is sociable and loves to be in the company of others. A person who has loads of energy, is exciting and fun to be with. Orange relates to a person who has great practical hands-on skills. Today, we'll be analyzing Guarantee Trust Bank, also known as GT Bank, a leading international financial institution headquartered in the heart of Lagos State, Nigeria. GT Bank is one of 5 leading Tier 1 banks in Nigeria, collectively known as FUGAS. That's First Bank, UBA, my favorite for now at least. GT Bank, of course, Access, and Zenith Bank. Together, they represent the largest and most influential bankers in the Nigerian financial market, leading in lending, deficit, and profitability, and often driving market trends and attracting significant investments. Because they control a large share of customer deposits, they have been classified as systemically important banks, are insured by the NDIC, and closely monitored by the CBN, and let's be honest, also the millions of customers that patronize them. Today, Quest Analytics will be joining the ranks to evaluate and provide an in-depth analysis of GT Bank. I'm Team Follower, Team Lead and Design Director. Together, Radiat, Tini, and Cousin will walk you through our analysis. Guarantee Trust Bank PLC was incorporated in 1990 as a limited liability company and commenced operations in February 1991, providing commercial and banking services in Nigeria.
In September 1990, GT Bank became a publicly listed company of the Nigerian Stock Exchange. That same year, it received the NSE President's Merit Award and honor to go on and between 2000 and 2009, reinforcing its standing as a leading Nigerian bank. In 2002, it was granted a universal banking license, allowing it to operate across multiple financial service segments. In 2005, the bank introduced its now iconic orange badge identity, improved digital and brand services, and an aggressive expansion strategy targeting individuals, SMEs, and large corporations alike. In 2007, being the first Nigeria financial institution to issue a $350 million Eurobond and a $750 million global depository receipt offer. The listing of this house on the London Stock Exchange made GTBank the first Nigeria company and African bank to be listed on the London Stock Exchange main market. GTBank expansion into East Africa began in 2016 Senior Bank Group, which has operated in Kenya for over 25 years, with subsidiaries in Rwanda and Uganda. This acquisition positioned the bank as the first Nigerian bank with African subsidiaries. In 2017, Guarantee Trust launched GT World, Nigeria's first fully biometric mobile banking app, a flagship platform that enables over 90% of banking services to perform digitally. As part of their customer experience approach, GTBank began the annual African Finance Fashion Weekend, an initiative aimed at offering customers and new commercial opportunities and empowering them with the expertise, network, and resources to realize the full potential of their businesses. This has been a part of their extensive corporate social responsibility or CSR efforts. In 2021, GTBank transitioned into a holding company structure, forming Guarantee Trust Holding Company PLC. This structural change was designed to enable the group to expand beyond traditional banking into complementary financial services such as payments, pensions, and asset management while maintaining strong banking operations. GTCO now operates as a multinational financial service group and GTBank as a subsidiary of the group. GTBank Nigeria remains the parent company of all the other banking operations, boasting 275 service locations comprising 237 full branches, 33 electronic branches, 14 cash centers, and 18 business offices. Of the 62.54 billion naira invested in GTBank subsidiaries across East Africa, West Africa, and Europe, 40% of that total investment was put into developing the West African branches in Ghana, Cote d'Ivoire, Liberia, and Sierra Leone and Gambia. 43% was used to develop its East African subsidiaries in Kenya, Uganda, Rwanda, and Tanzania, while the remaining 15% was invested in GTBank's sole European subsidiary in the United Kingdom. The bank operation cycle.
The bank's operation style, staff conduct, and service delivery models are built on 8 core principles. These are simplicity, professionalism, service, friendliness, excellence, trustworthiness, social responsibility, and innovation. These principles are known as the Orange Rules, which reflects the bank's vibrant orange corporate color. I guess you can say GT takes the meaning behind this corporate color quite seriously. The bank also offers a wide range of bespoke financial products and services through 6 distinct operating business segments: the corporate banking segment, commercial banking, business banking, SME banking, retail banking, and public sector segment, which offers banking services to the government. Corporate banking sector is the largest contributor to the bank's loans and advance portfolio at 87.3%, while the retail segment, leveraging on the digital infrastructure and resources, generates 1.9% of the bank deposit liability. All business segments are profitable, with the corporate and retail segments contributing 86.2% of the bank's bottom line. These segments are managed by a set of competent industry professionals with decades of banking and financial experience. Segun Agbade is the current CEO of GTCO and, by extension, GTBank since 2021. Miriam Shidiebele Olusoya has served on board as managing director, with Agnes Olatokunbo Martins serving as the board chairperson. GTBank has been the recipient of numerous awards for superior financial performance, customer service delivery, and corporate social responsibility efforts. In 2023 alone, GTBank was recognized as the best bank in Africa and best bank in Nigeria by the Euro Money magazine, and as the best banking group and best retail bank in Nigeria by World Finance magazine, taking home 8 of 12 honors for banks at the forefront of driving the digitalization of financial services.
Now let's dive into the performance of this bank. GT Bank still accounts for a significant portion of the group's profits.
Significant portion of the group's profits, assets, and financial performance. According to data published by the London Stock Exchange, GT Bank contributed up to 84% of profits before tax in 2024. In the first quarter of 2025, the group reported profits before tax of 300.4 billion.
due to a robust and well-structured balance sheet. The group growth across all aspects. By the end of the first quarter, assets closed at 15.9 trillion. By the end of the quarter of 2025, profit grew by almost 300% to reach 900.8 billion naira. Similarly, total assets increased to 16.7 trillion naira through this consistent strong profit margin and asset growth. This brings confidence to investors. Last 5 years by over from 1 into 28 naira just this month. Is a key banking and financial stability measure that shows how strong a bank is financially and how well it can absorb it without collapse. PN has set the minimum 16% significant impact.
But the higher the CAR a bank has, the more stable it's perceived to be. GT Bank has consistently operated well above the minimum CAR and closed at 30.88% by the end of the third quarter of 2025. That's well above the 16% set by the CBN. As an institution offering financial services, individuals, companies, people are at the core of its operations. And it appears GT Bank has been able to combine the rigid demands of profitability with the softer edge of smooth user experience. Augusto & Co., a leading research and credit rating agency, declares that GT Bank emerged as the best digital bank in Nigeria with a user experience score of 74.2 in 2020. Augusto & Co. also reaffirmed the bank's AAA risk rating for 4 consecutive years. GT Bank is one of only 2 banks in Nigeria with such a rating.
Despite its status as a multinational financial institution, GT Bank faces a host of operational challenges. These issues can be broadly grouped into internal and external challenges. The internal challenges are 1. Frequent disruption on the GT World app on technology and business news platforms such as Telcabal, Nairametrics, and the Cable. 2. Slow response time, unresolved failed transactions, high rates of bank charges, and difficulty reaching support after app-related issue have crippled customer service. 3. Rising operating expenses in Nigeria banks, which are partly driven by technology investments that do not immediately translate into efficiency gains. 4. Overdependence of the parent company. GTCO has derived 84% of its earnings from traditional banking operations. The external issues are reports from Nairametrics and Business Day consistently highlight how Nigerian economic instability rates affect bank profitability, asset quality, and capital adequacy. FX volatility increases the cost of foreign obligations, complicates planning, and raises credit risk challenges that are largely outside GTCO direct control. The second one, because the banking sector is heavily regulated, policy changes are frequent. These regulatory shifts increase compliance costs and reduce strategic flexibility, especially for institutions investing heavily in digital infrastructure. 3. Tech Abas and Business Day reports that fintech companies such as OPay and MoneyPoint are winning customers by offering faster onboarding, simpler interface, and more reliable digital experience. This puts GTCO in a tight competitive space, squeezed between agile fintech and well-capitalized traditional rivals. The last one. According to industry reports cited by PwC and Nairametrics, financial institutions face increasing risk cyber threats. This makes cybersecurity not just a technical issue, but a strategic necessity.
One of the most critical solutions for GTCO is shifting engineering focus from continuous feature launches to platform stability sprints. Insight from product strategy firms like Thin Slices shows that frequent feature releases on unstable platforms often increases outages, bugs, customer complaints. Stability sprints, on the other hand, prioritize system reliability and performance optimization. A strong example of stability sprints is JP Morgan Chase, a prominent investment bank. JP Morgan deliberately slowed new feature releases on its mobile app to focus on infrastructure modernization and system resilience. The result? Improved uptime, fewer transaction failures, and higher customer satisfaction scores. Within Africa, Standard Bank will publicly emphasize product platform stability during its digital transformation. This approach helps stabilize its mobile channels across multiple African markets. For GTCO, adopting stability sprints will directly reduce GT app failures, rebuild customer trust, and create a reliable foundation for future innovation. Another key solution is simplifying bank charges and communicating them more transparently. Customer complaints in the banking sector often go beyond failed transactions to include confusion over unexplained fees and delayed reversals. And a relevant example of this is the Monzo Bank in the UK. According to the Harvard Business Review, Monzo gained rapid customers by clearly explaining the fees in their app. They sent real-time notifications, and they also eliminated hidden charges. For GTCO, transparent pricing communication would reduce friction, lower complaint volumes, and improve brand perception, especially during service disruption.
Innovation is necessary, but research constantly shows that innovation without financial discipline weakens long-term performance. According to PwC and McKinsey, banks that evaluate technology investments using clear ROI metrics achieve higher efficiency and stronger shareholder value than those pursuing innovation for branding alone. A strong example is Development Bank of Singapore, frequently cited by Harvard Business Review as one of the world's most digitally matured banks. DBS Bank adopted an ROI-led approach to innovation, prioritizing projects that either reduced operation costs or generated new revenue streams. This helped DBS achieve one of the lowest cost-to-income ratios among global banks. For GTCO, ROI-led tech spending would control operating expenses while ensuring that innovation directly supports profitability and customer experience. GTCO's structure as an holding company creates opportunities beyond traditional banking, but scaling non-bank subsidiaries must be done gradually and strategically. For GTCO, gradually scaling of subsidiaries such as payments, asset management, and digital finance would reduce dependence on core banking revenue while preserving capital discipline.
From our presentation, it has been revealed that GT Bank demonstrates strong financial performance and effective regulatory compliance, positioning it as a resilient and reliable institution for shareholders. Its stocks remain highly liquid with notable market activity, reflecting investor confidence, while digital innovations such as the GT World app and service delivery enhance customer convenience and satisfaction. Despite competitive pressures from tier one players such as the Fugas banks we mentioned earlier and fintech firms such as OPay and MoneyPoint, GT Bank's robust capital base, strategic discipline, and active market presence suggest it is well equipped to maintain growth, meet regulatory expectations, and continue delivering value to stakeholders. GTB thus exemplifies its motto and remains proudly African, truly international. Thank you.
Thank you very much. Well done. Good job. Okay. So I don't know, for me, I am not so much a fan of your slide. I'm not saying it's not good, but I just feel like it could be better. Again, this is just from my hand. I personally enjoyed Foluwa's presentation. I think she has good enunciation and a very good way of speaking. Yeah, a good presentation, speaking skills. She has good speaking skills. I think that's the right word. But generally, well done to the team. Can I ask the mentors to give them feedback? So let's give this. Right, before we give them feedback, actually, let me ask, do we have team, what's the other team? Momentum here. Is team Momentum here? All right, that's fine. All right, so can I have the mentors give Team Crest's feedback? All right, Mentor Giwa here.
Okay. Thank you, Dr. June. So in general, the team had a good presentation, good content. Um, in terms of describing the operations of the company, which were very good. But the major thing that's required for this presentation is to do a thorough company analysis. And when you got to the performance analysis part, I think that was substandard in my opinion, because there were a lot of things we could talk about in terms of describing the banks and the industry's performance, but I didn't really see that. So for the industry performance was missing. I didn't see any clear analysis, comparing GT with other banks. Because how do you analyze if a company is doing well or not if you don't compare it to something? And that's why you have to do peer analysis. I didn't see peer analysis. Then, even if you were to do an analysis of GT Bank itself as a standalone company, you need to do some trend analysis. The only thing I saw that was the performance metric in your slide was about capital adequacy ratio, which is a very important ratio for the banks. But the capital adequacy ratio, you need to show the trend in capital adequacy ratio if it is growing or declining or if it's stable. I can't tell from your presentation because you just put the CER for 1 year and say it's 30% and it's above CBA regulations. Yes, but what is the trend like? What was it last year and 2 and 3 years before? And what is it now? In the banking industry in the last 1 year, the CBN has even come to tell the banks to recapitalize. So what was the effect of this recapitalization on the banks? Did they help? How have they been able to raise their capital to meet up with CBN regulation? And what exactly is the impact and what do you expect to see going forward? So the only performance metric we use to compare, the only thing that looked like performance metric was CR, but you could have done other things like the ROI, ROE, and the likes, cost to income ratio and things like that. They are key ratios that you use in analyzing performance of the bank. So your performance analysis was not up to the standard that I would expect. I would expect to see, trend analysis, talk about more performance metrics, and then do peer comparison for the industry. So those are my comments. Hopefully, you guys can improve on this for.
Thank you
Hello?
very much. Thank you.
Oh, okay.
Thank you
Yeah.
very much, sir. We thank you. Thank you.
Fanny follower, you're saying something.
Oh, I was saying that we noted those. Thank you very much, sir.
Oh, okay. All right. Well done. Well done. Any final comments from the mentors? Okay. All right. Thank you very much, Team Crest. Well done. Well done. Okay. So I called Team Zenith and Apex back because, again, like I said, there are two set of presentations that are very, very important to the final scores. The first one was Daytopia and Team, what's the name? Forgot. UI Alpha. And then the next set of presentations or presenters that really matters, not that the other ones don't matter, but that makes that we need to really focus on is Team Zenith and Team Apex. I'm sorry, I sound very funny, right? Right. So one of the mentors have got feedback for you, and that's why I've called you guys back. So that again, to ensure transparency in how we've graded your marks as well. Dr. Yusuf, do you want to pass across the information?
Oh, no. So thank you, Dr. Ejimo. So I remember I was trying to remember something that I noted down. So what I wanted to mention, just for a future reference, is to I think it was to Team Apex. Whenever I forgot when I was doing it, so I just thought I should add it to it, although it's still going to reflect in your feedback. So when you did your analysis, you used good comparisons like Unilever. For Unilever, like PZ, you used what else did you use? Can you pass me that book, please? Yeah, so you used PZ, but you also used the Dangote sugar, which I found like was inaccurate. So just make sure next time when you are doing the comparison, make sure that it's a close competitor that you're using, because if you have only two close competitors, that's fine. You don't have to add the third one that would now affect the entire comparison that you're trying to make. The Daytopia sugar, they only do refined sugar, and they don't even have a diversified portfolio compared to Unilever. So I didn't really understand why you added Daytopia. Why am I saying Daytopia sugar? Maybe we should go into sugar. Dangote sugar. It's just something to it's just something to make sure that you note. So whenever you're doing a comparison, make sure you are only using close competitors that are within the same industry. So the risk level is the same, and then we can compare the profitability and other things you want to compare since they have the same kind of profile class. Which I also noticed with the profitability part, you used an index, ASI, or all share index, to do the profitability comparison. You compare the ASI to Unilever under the profitability aspect, but it's a good one to use a benchmark. However, you need to understand that a benchmark is a benchmark, right? It's not particularly a fair comparison because of the fact that it has diversified companies. So different risk level, a lot of different things, right? It's just an aggregate. So it's only good when you're probably comparing their share performance. So that doesn't come under profitability. That would probably come maybe in your slide with investment or investor confidence, something like that. Not when you're trying to do profitability. So you should have just used a close competitor for that one to explain what you're trying to say. So that's what I wanted to just note. And the reason why I've just said, let me quickly say it, is just because so everyone can learn from it rather than still giving you the feedback. We'll still give you the feedback, but everyone can learn from it to make sure that they're comparing correctly and fairly. Thank you. No problem.
Thank you very much.
Okay, thank you very much, Dr. Yusuf. I think we've noted your feedback and we really, really appreciate. However, I think the reason why we mentioned Dangote Sugar was just because of its position as another FMCG giant. But yes, we've noted your feedback. Thank you. Thank you very much, sir.
Okay, thank you very much to both teams, and thank you to Team Crest. Apparently, it seems like we don't have Team Momentum on the call. So if they still do not show up by the end of the end of the meeting, it will mean that 3 points would go to Team Crest. I guess it's their lucky day. All right, so we're going to the next team. We're almost there, to be honest, and I'm super excited about that. We're going to the next team, which is team. This set of presenters will be presenting on Owando, and then the teams that would be doing great justice to this would be Elevator and Vanguard. Do we have Team Elevator here? Team Elevator, do we have them here? Team Vanguard, do we have them here?
Yes, ma'am.
All right, we'll start with Team Vanguard. When they are done with their presentation, we'll check in with Elevator if we have Team Elevator on the call. All right, Team Vanguard, you can present your slides and start the presentation.
Right, bad presentation.
Team Vanguard. Team Vanguard, are you guys there?
Yes, ma'am. Why you, ma'am? I'm trying to present and share our screen.
Oh, okay, that's fine. That's fine.
We are currently on it, ma.
Right. Distinguished mentors, fellow Daytopians, good afternoon, everyone. So I'm Zach Abdullah Ibrahim, and with me are Salahuddin Arafat and particularly. Today we'll be presenting an analysis on Wando PLC.
Sorry, I did tell you I don't know. I can't hear you well.
Can you hear me now, ma?
Yeah, much better now. Much better.
All right, so distinguished mentors, fellow Daytopians, good afternoon, everyone. Today, we're making a presentation on Wando PLC, a leading company in oil sector. Because in the course of our presentation, we cover Wando business model, transformative acquisition that was done by them, and financial performance from 2020 up to 2025. Now, Wando's history spans as nearly as 70 years ago. So it started in 1960 as Exxon West Africa, a subsidiary of Exxon Production United. When Nigeria's unionization in 1976 became unit petrol, in the year 2000, it petrol merged with Nigeria PLC and rebranded as Wando. This created a stronger integrated energy company from the from the year 2001 to 2014. Wando expanded across the upstream, midstream, and downstream energy services. 2020 and 2024, companies faced some headwinds. Not 2024, everything changed because Wando acquired the Nigerian oil concession from Eni in that year, and is a deal that doubles their reserve, expanded production, and positioned Wando as Nigeria's leading energy player. So now, Wando is an integrated energy company, working across the full value chain, consisting of upstream exploration, the midstream gas and pipeline, and the downstream fuel trading, as well as clean energy. Now, this integration is key because where crude prices weaken, Wando aims from that, trading, and power. So that is why and it is differentiated from single focus competitors we are going to move during the course of this program. Now, this is the management team for the Wando PLC. As you can see, this diversity metric standouts. New workforce shows Wando's commitment to gender inclusion. 99% Nigerian workforce shows or reflects local talent and skill development. 100% the Nigerian management is like all of them there, local leadership and decision making. So that we can see that Wando is still rooted in Nigeria. So in navigating social regulation, community relations, and energy transition. So at the heart of Wando is a clear mission and vision. And what's their mission? Their mission is to be a premier company driven by excellence, professionalism, quality standards, and operational discipline in everything Wando does. Now, what's their mission? Their vision rather to be leading integrated energy solution provider. And you can exactly what that means in the first statement surrounding it. Now, in the other part of the diagram, about the upstream for the exploration and production. So Wando explores and produces crude oil and gas because this is the business that generates revenue. To see the offshore platform image, that's where production usually takes place. However, also the midstream and gas infrastructure. How to operate gas plants, pipelines, and power generation. Storage plants in the image represent the midstream infrastructure and moves and process oil and gas. So the downstream marketing. Wando sells refined petroleum products to consumers, food fuel stations, and lubricants It's not like a direct consumer engagement. It's also about clean energy. Countries investing in renewables and electric vehicles for future energy transition. So, it's why it made you present this forward-looking commitment. Together, this commitment makes one integrated, and that's the ambition. So, one segment is kind of weak, another is strong. That is resilience and strategic positioning that Wando is offering.
Now, in 2024, in August 2024, Oando took a pivotal step. The company paid $783 million to buy Nigerian Egypt oil company from Eni, and here is why it matters. First, Oando needed to strengthen its upstream operations because before now, Oando held only 20% of the joint venture in OMLS 60 to 63. After the deal, Oando's stake jumped to 40% and it became the operator, meaning Oando now calls the shot on production strategy, cost control, and capital spending on those blocks. Secondly, it positively impacted their profits. There was 164% increase in profits. Specifically, the profit was increased from 76 billion to 210 billion in the first 9 months of 2025. All these were largely driven by Nao contribution and higher production volumes. Thirdly, there was an increase in production. Oando reduced its dependence on imported fuel and increased domestic oil and gas production. This shows that the deal wasn't just about buying barrels, it was about taking operational control and reaping the financial rewards of this control.
Now, let's walk through Oando's revenue from 2020 up to 2025, which is up to date now. Now, in 2020, the COVID-19 pandemic crashed global oil demand because we have the lockdown, we have the travel restriction, and the industrial slowdown. So all of this collapsed the petroleum product demand. So as a result of this, Oando revenue fell sharply to 477 billion naira. But the management didn't just sit idle doing nothing. Instead, they focused on cost management and operational efficiency by doing what? By cutting down the non-essential spending, rising upstream and trading operations. So in 2021, as global demand recovered, Oando rebounded strongly. So their revenue jumped to 803 billion naira, which is twice the amount we have in 2020. This shows the management disciplined response to crisis which happened in 2020. In 2022, we have the explosive growth. Now, so a significant incident happened in 2022 because we had invasion of Ukraine by Russia. So this crisis tightened the global oil market, spiked prices. Kind of revenue quadrupled from 2020, reaching 1.99 trillion. This period demonstrated two critical things. The first one is Oando's high sensitivity to oil price, and the second is the ability to increase production aggressively when market conditions allowed for it. In 2023, we have the moderation of the revenue to about 2.5 trillion naira. So the growth at 2023 is kind of slow, but it still remains healthy at about 43%. Orlando maintains production by leveraging its integrated business model. The integrated business model, which is the upstream, midstream, and downstream, they are all working together. As a result of this, it improved efficiency for them in supply chain and refinery. Importantly, this 2023 was a strategic year for them because they were preparing to acquire a specific industry. So as a result of this, they were trying to strengthen their portfolio ahead of that strategic move. In 2024, that was when they made that strategic move by acquiring the Nigerian Egypt Oil Corporation company. So revenue for them surged to about 4.09 trillion. This is a 44 to 45% increase versus what we had in 2023. And what about this? Two things. The first one, the company they acquired, I using upstream assets from me, started contributing immediately to the revenue of Oando. Secondly, the commodity price remained favorable in the market, which helped Oando capture stronger margin. In this perspective, Oando added roughly 500 billion naira in annualized revenue rate. This deal was immediately active. This deal helped to boost the revenue of the company at the end of 2024. In 2025, the revenue softened to about 3.44 trillion naira. Why? Weaker trading volumes, lower oil price, and tight margin. But one thing we must note in 2025 is that we should not mistake high revenue for weakness. No, their performance was stable. Now, state was running well. The profits are still healthy because Orlando is still integrated, and as a result of their integration, when crude is weak, they earn from gas and trading. So that's what happened in 2025. But when trading slows, they rely on steady upstream production. So that diversification is the real story. Orlando's response has been disciplined, cost control, smart trading, better supply chain. That's what we call resilience in action, and it has been displayed by Orlando through their revenue trend.
Now, to do a SWOT analysis of the company, let's look at the strengths of Oando. The company is involved in almost every major stage of the energy value chain, the upstream segment, the midstream segment, and even the downstream segment. It is also characterized by high profits. Following NAOC's acquisition, we can see that their profits increased from 79 billion to 210 billion. Now, the weaknesses of Oando's company. The first thing is that the downstream segment, which is specifically the trading division, has become weakened due to a decline in importation of PMS as a result of Dangote's refinery, which has limited Nigerians' importation of fuel from other countries. Now, what are the opportunities available for Oando's company? The first opportunity is clean energy and gas expansion. According to Business News Nigeria, over 1 million Nigerians have gained access to clean energy. This upsurge in demand of natural gas and solar creates an opportunity for Oando due to its integration of Oando Clean Energy Limited, which is OCEL. Another opportunity for Oando is regional expansion. According to Daily Trust, Oando has over 500 retail outlets, but it has sold out 380 of it to NNPC. Now, this with the increase in profit that they are currently experiencing, the company can look into establishing a new retail outlet in different states which they have currently exited. Now, what are the threats available to Oando's company? What are the threats they are likely to face? The first of the threat they are likely to face is security issues like vandalism and theft. And another one is major changes in markets and major changes in commodity price, and even the regulations of the government can also affect the company's production and also its sales in terms of profit and even in terms of revenue generation.
My teammates have already established Oando's growth over the years, but we can't be certain about a company's growth without a comparison with its competitors. This slide illustrates Oando on one side and its competitors, Seplat Energy and Total Energies, on the other side. Now let's look at the actual scoreboard. In 2020, all three companies recorded relatively low revenues caused by the global oil price crash triggered by COVID-19 lockdowns. By 2021, the world reopened. As shown on the graph, revenues for all three companies rose significantly between 2021 and 2022. The recovery was driven by easing of COVID-19 restrictions worldwide. Each company benefited in different ways. Ohando leveraged its integrated energy model. Seplat maintained stable production. Total Energies expanded fuel distribution, but Seplat's revenue diminished between 2022 to 2023. By 2023, the three companies saw strong revenue growth, which was triggered by different business models. Ohando improved efficiency and boosted crude trading. Seplat kept production steady and optimized assets. Total Energies capitalized on Nigeria's fuel supply gap to increase sales. By 2024, Ohando integrated NAOC assets, boosting upstream production and revenue. Seplat acquired MPNU assets, sharply increasing output and revenue, while Total Energies leveraged fuel price liberalization for strong downstream sales growth. In 2025, revenues moderated for Ohando due to reduced fuel importation, and Total Energies revenue declined because of price distortions, while Seplat showed strong revenue momentum due to expanded asset base. Between 2022 to 2025, Ohando grew aggressively through acquisitions. Seplat expanded production as an upstream specialist, and Total Energies delivered resilient downstream-driven performance shaped by Nigerians' fuel markets. Ohando isn't just competing against Seplat and Total Energies. They are fighting an invisible competitor that doesn't play by the rules. Ohando is fighting for its life against sabotage and thefts. In 2021,
In 2021, Orlando saw a 40% year-over-year decline in total production. In 2022, a 22.7% decline in production occurred, which led to massive 81.2 billion loss after tax. In 2024, a 5% production decline occurred, and in 2025, 3 sabotage attacks on Orlando pipelines in Bayelsa State was recorded. All of this shows that vandalism and thefts caused massive losses for Orlando.
Now, Orlando's CSR, Orlando's corporate social responsibilities. Now, when we say Orlando's corporate social responsibility, it means how the society benefits from Orlando. And Orlando has tried in this aspect. First of it is Orlando Scholarship. Orlando offers scholarship for Nigerian undergraduates through their joint venture with NNPC. In addition to this, Orlando also established an initiative called Adopt a School Initiative. It has successfully adopted 88 schools across 23 states, thereby contributing to the reconstructions and renovation of the schools. Specifically, in Lagos State, it has established 3 power digital learning centers, and it has trained over 100 teachers in core pedagogical skills and lots more. Also, it also launched the COW project, which is Clean Our World project. This project is targeted at promoting environmental education for pupils in target schools and even in host communities by teaching them plastic recycling and waste management. In addition to this, Orlando also uses the Learnovate strategy by investing in foundational learning quality of literacy and numeracy skills across target schools. Now, we have shown it that Orlando reflects a company that continues to adapt, one that is not only focused on its growth, but also committed to contributing positively to the society. In the next slide, we've provided our references. Thank you for listening.
Thank you very much. Thank you. I don't know, it's such a shame that at the beginning, what's his name now? Let me look for his name. Oh, is it? Yeah, Adedayo Amzat. I could tell that this presenter knew what they were saying. They've got content, they've got stuff, but then we couldn't hear most of their presentation. It would be clear at some point, it would go unclear at some point. It was, and I feel like it just affected everything. Again, this is in my own opinion, just affected everything else. Although we had other presenters that came in and did their thing, which was good. But again, this is something, I don't know, maybe it's something that we didn't even know. I don't know. I don't even know how to present against this. But it's just for you to have that at the back of your mind. All right. I liked your slides. Generally, it was good. So well done and good presentations overall. Mentor Julius, do you want to give our team some feedback?
Dr. Jubi, unfortunately, the feedback is not forthcoming because most of the things that would have set the mood of the feedback, we didn't get that.
Yeah.
The audio was a nightmare. I couldn't really pick anything. The SWOT analysis was decent, but you could have applied it to the context of Orlando. How does it actually strengthen or weaken them based on the SWOT analysis? You did a bit of strength. You talked about the insecurity of the pipeline and all that, but you didn't actually put figures as to how many pipeline incidents has happened in the last few years that you're looking at. So most of the things could have been better, but just like Dr. Jimmy had said, I couldn't flow with the presentation because there are a lot of audio impairment with I don't know, at the beginning, and it made me not really invested in the presentation. So you guys should please take note of that because some of the mentors were writing in the chat box that you need to improve on the audio, you need to do that. But well done, guys. The slides were very good. Well done on that. They were good slides. But I just don't know. The vibe was killed at the beginning with that audio thinking. Mentor Giwa would like to say something. I will just stop there. Thank you.
Yeah, before Mentor Giwa, who would give us the overall feedback. Mentor Celestine, you have your hands raised.
Okay. Good afternoon or evening, depending on where you are listening from. So mine was just like a quick question. Um, Great presentation. I think most of the comment has been made regarding what just happened. My question is regarding the competitors. So I think there was Total, there were like two others. So I just want to ask, on what basis were these companies selected? Because I know for sure there are other company in the same business line with Wando. So is there any justification for selecting just this one?
All right, sir. The basis for the selection is because just like Oando, Total Energies and Seplat, they also focus on upstream, mainstream, and downstream. That is, they focus on production, they also focus on trading, and they also focus on importation and then refining these oils for sale.
All right, thank you very much. Mentor Celestine, did they answer your question? Do you have any other question for them?
No, it's fine. You can go on. Thank you.
Thank you very much. All right, Mentor Giwa.
Okay, thank you, Dr. Jimmy. So the question the mentors are selecting, that's where it's part of what I wanted to ask, but I don't think that feedback is uh, satisfactory because when I saw the peer analysis and I saw Seplat and Total, so I was wondering why we used just those two. Because when you even look at the revenue chart that you guys presented, you see the far discrepancy between the revenue of Total from the others, which already shows a mismatch between the companies that you used in doing the analysis. Revenue for Total for Wandy was already like double what Total and Seplat were doing. So that already tells you that there's a mismatch in the company that you have used to analyze. Because peers, why when you say people are peers, it means you have to compare people that are apples to apples. If the discrepancy is too wide, it's not what you consider peer analysis again, right? So what I think would have happened is these companies, they are a group of companies. So you need to be able to determine if you are using the right figures for your analysis. Are you using group numbers for Oando and then you're using maybe downstream numbers for Total or for Seplat? Maybe you're using. So you need to know what numbers you are actually using. So that's why I think there's a mismatch in the numbers you use for your comparison. But if you go back to your slide on the peer analysis, you can see the difference in revenue between one and another. So I think there's a mismatch somewhere there. Then the second thing I also wanted to say was when you even did the analysis, the only thing that you used, the only metric you used was just revenue. There was no other metric you used. So I think that limited your analysis because you could have used other matrices to make your analysis more worthwhile. Then the other thing, was that I wanted to hear something around PIA because you really can't talk about what's going on in the industry now. We're talking about the impact of the Petroleum Industry Act and then the emergence of the refinery. But at least something around the PIA would have been very useful for this kind of analysis for the oil and gas industry. The industry is so now a lot of people can't tell the difference between upstream and downstream and midstream. And for companies like Wando, they operate across all of these streams. So it's difficult to really separate their business lines. So if it could have introduced something around the PIA or spoken about it, and now it's shaping the oil and gas industry, that would have helped your presentation. But you guys had a great presentation. I just thought the critical part of your analysis was not as I expected. But just take the feedbacks and then you can note it for future presentations. Thank you.
Thank you
Thank
very much. Thank you very much, Mentor Giwa. And thank you to all the mentors that have um, been here to support us and giving the teams feedback. Well done. Oh, Dr. Yusuf, you have.
Yeah, I just wanted to add to what the mentors already said. The analysis would have been better as well if you probably told us a bit more about the industry, maybe some analysis around the industry, so that we can get to know more about the happenings around the industry. Maybe part of 5 or something. Also, um, there's a lot more to analysis than revenue. I know you've used the revenue for the analysis, but you can look at other areas as well. Maybe the debts, like liquidity, credit risk, operations and all that. It's just something to consider as well. Not just focusing on, and a bit of ratios as well is good. And then something around investor confidence, since they're on the stock exchange. So yeah, that's it.
Thank you very much. Thank you very much, Dr. Yusuf. Well done, Team Vanguard. Do we have Team Elevator here? Elevator. Okay, seems like Team Elevator is not here. So if they do not show up before we finish today, again, that will mean that Team Team Vanguard has got the total 3 marks point allocated to them. Well, fingers crossed. Right. So next up, we have 2 sets of presentation left to go. Next up is this set of presenters analyzing Access Bank, and we have Team Quest and Team Alpha, Bayero Alpha. Team Quest is from OAU, University of OAU. Do we have Team Quest here? Team Quest. Team Quest. Is Team Quest here? All right, Team Alpha, Bayero. Okay, sorry. I think they're the ones requesting to. Okay. 1 minute. Do we have Team Synergy here? Team Synergy. Team Redeemers. What's going on? Where's everyone?
Good evening, ma. Good day, ma.
Good
Team
day.
Quest, we are here, but I think one of us is currently experiencing network issue, but
Right.
others we are presently on the
We're
call.
here. All right. Do we have Alpha Bayero here? Do we have Bayero Alpha here? Just a minute. Okay. Do we have Team Synergy here? Oh God. The last set of presenters, do we have them here? Synergy and Redeemers. Team Synergy, Team Redeemers. Okay, so if we have Team Quest here, let me just see. 1 minute, please. So Team Bayero Alpha, you said you are ready, right? Sorry, Team Quest rather. You said you are ready.
Yes, ma'am.
Okay. All right, you know what? Just start presenting and let's see if Team Bayero Alpha joins you guys after the presentation.
Okay, ma'am.
When
Can
you're
you give us a
ready,
minute to
when
get
you're ready, you
inside?
can share yourself. That's fine.
Good day, distinguished judges, mentors, and my colleagues. Let me begin with a simple question. How many of us made a transfer, paid a bill, or checked our account balance this week, possibly using Access Bank? For most of us, that transaction felt effortless, but in an economy marked by currency instability, strict regulation, and intense competition, such simplicity is not accidental. Behind every successful transfer is a careful executed strategy. That strategy is what we are here to examine today. My name is Olaniyola Banji, and alongside Ayoni Olumide, Bakari Fetia, and Awodele Tosin, we are Team Quest. Together, we will not just present information, we will take you on a clear structured journey through one of the most compelling transformation stories in African banking. Today, we'll show you how Access Bank evolved into a tier one institution, how it competes within Nigeria's banking industry, the external forces shaping its operation, and the strategies that can sustain its future growth. By the end of this presentation, you will understand not just what Access Bank is, but why it matters in today's financial landscape. Let's take a look at the background and evolution of Access Bank PLC. Access Bank started in 1988 as a small Nigerian bank and began full operation in 1989. By 1998, it took a major step forward in becoming a publicly listed company, setting the stage for long-term growth. But the real turning point came in 2002. This was when new leadership led by Aigboje Emukwede and Albert Wigwe. With this leadership came a new vision, a stronger corporate culture, and a clear growth strategy. From that moment, Access Bank didn't just grow, it grew deliberately, combining steady internal growth with strategic acquisitions. Two key moments stand out. In 2012, Access Bank acquired Intercontinental Bank, significantly strengthening its corporate banking strength. Then in 2019, the merger with Diamond Bank transformed Access Bank into one of Nigeria's largest banks by customer base and a major player in retail and digital banking. Today, Access Bank operates across Africa with a presence in Europe, the Middle East, and Asia. So, in summary, Access Bank's success is no accident. It is the success of visionary leadership, smart strategic decisions, and consistent execution over time. Building on this growth, Access Bank restructured under Access Holding PLC. This structure allows the group to diversify beyond traditional banking into payments, pensions, insurance, and investment services, reducing reliance on interest, income alone. It also enables the bank to operate across Africa, Europe, the Middle East, and Asia, as I stated earlier, with offices in strategic markets such as China, India, and UAE. Next slide, please. At the center of this expansion is a clear and ambitious vision to become the world's most respected African bank. This vision explains why Access Bank prioritizes scale, strong governance, international presence, and sustainable practices, not just profitability. To achieve this vision, Access Bank focuses on four key pillars: digital innovation, enhanced customer experiences, sustainability, long-term stakeholder value. These pillars ensure that growth is not just rapid, but only responsible and sustainable, fully aligned with the bank mission. Next slide, please. However, strategy alone does not guarantee success. To fully appreciate bank's performance, it is essential to examine the industry environment in which it operates. This will lead me into the industry overview and competitive position of Access Bank. The Nigerian banking sector is dominated by tier one banks, including Access Bank, UBA, Zenith Bank, GTCO, and FBN Holdings, which we know as First Bank. This sector is highly regulated, intensely competitive, and increasingly shaped by digital transformation. When we compare Access Bank with its key competitors, some clear distinctions emerge. For instance, Zenith Bank is widely recognized for strong profitability and balance sheet efficiency, while GTCO is often associated with technological innovations and premium customer experience. Access Bank, on the other hand, differentiates itself through scale, geographic reach, and strong digital and electronic banking revenue growth. In essence, Access Bank is not competing on a single advantage. Rather, it competes through a combination of size, innovation, and broad customer accessibility, which positions it distinctly within the Tier 1 banking landscape. Beyond internal strategy and industry competition, Access Bank performance is also influenced by a wide range of external factors. This will lead us into the external environmental analysis, which we abbreviated to be called PES2. From a political perspective, government policies promoting financial inclusion and cashless transactions directly affects banking operations and customer behavior. Economically, challenges such as high inflation and foreign exchange volatility increases operating costs and impact borrowers' repayment capacity, thereby affecting asset quality. Socially, Nigeria's young population and rapidly increasing smartphone penetration creates a strong and growing demand for digital banking service, which aligns well with Access Bank digital strategy. From a technological standpoint, the bank investment is mobile banking platforms, data analytics, and artificial intelligence have enhanced service delivery, improved customer experience, and strengthened fraud detection capabilities. Legally, strict compliance with Central Bank of Nigeria regulations ensures financial stability, although it also increases operational and reporting responsibilities for banks. Finally, on the environmental front, Access Bank has positioned itself as a leader in sustainability, particularly throughout green financing and broader ESG initiatives, aligning its operation with global best practice and long-term societal impact. Olumide will be taking us through the business model and revenue structure of Access Bank PLC.
Thank you so much, Banji. Before I proceed, it's important to understand one uncomfortable truth. Growth is easy, but sustainable growth is not. If you go too slowly, you lose relevance. If you go too fast, you lose control. And if you go the wrong direction, you destroy value. What I want to show you now is how Access Bank has tried to walk that tightrope through its business model, its internal operations, and the financial results that followed. Starting with the business model, most banks start with a decision of picking what they are good at and double down. Access Bank deliberately did not do that. Instead of focusing solely on corporate or retail banking, it built a universal banking model with deliberate diversification. Why? Because Nigeria punishes banks that rely on a single revenue stream. They don't succeed easily. So Access Bank decided to spread its exposure across 4 core activities. Next slide, please. The retail banking, corporate and commercial banking, treasury and foreign exchange, cross-border trade facilitation. The retail banking majorly for stable deposits and transaction volume. Corporate and commercial banking for structured and higher ticket income. Treasury and FX services to manage currency volatility, and the cross-border trade facilitation, which is to support regional flows. This mix is about survival. Previous slide, please. Previous slide. This mix is about survival, not ambition. When credit tightens, transaction carry income. When foreign exchange fluctuates, treasury caution earnings. When margin compress, volume keeps the engine running. This model sets the stage, but scale was needed to make it meaningful. So this will bring us to the first decisive moment of Access Bank. The 2019 question, scale or control. By March 2019, the Diamond Bank merger became the test for Access Bank. Just as Banji mentioned while he was introducing the bank to us. Access Bank merged with Diamond Bank. And as shown in the slide, under the core activities. This merger impacted retail and corporate channel. Diamond Bank bought millions of retail customers. And yes, it was that large. But there is a problem. And do you know where that lies? It also brought thinner margins, higher operating intensity, and integration risks. So the question Access Bank asked itself was that, do we go carefully or decisively? They choose decisively. Some things other banks might not have done. And this decision changed the bank activity and scale in such a way that their retail deposits surged, the transaction volume exploded, and even the digital adoption accelerated overnight. We could see that Access Bank was not buying profits. It was buying activity, and activity, when processed digitally at a scale, becomes one of the strongest sources of leverage in modern banking. How then did Access Bank make this merger work? You see, one major problem of merging and acquisition is that if not controlled properly and if the operations are not effective, there's high tendency that the cost will be increasing. Access Bank avoided that trap by monetizing transactions before lending. Transfers were monetized, allowing fee income to go without added credit risks. Cards were leveraged, increasing non-interest revenue without proportional costs. Payments were also expanded, turning high volume activity into sustainable income. Foreign exchange transactions were not left out, providing an additional revenue pillar linked to corporate and retail activities. All this made non-interest income a strategic pillar and not just a side note. And this has allowed Access Bank to achieve a balance in its scale. With scale and structure in place, the next challenge was operation, the place where most strategies actually die. So let's examine the internal operations and capabilities of Access Bank. In 2021, Access Bank accelerated operational digitization. Over 100 processes were redesigned, eliminating inefficiencies and bottlenecks. Robotic process automation, RPA, was also deployed, streamlining settlements, disputes, and reconciliation. Digital transaction processing grew by 39%, allowing more activity without proportional cost increase. And this is one of the main benefits for that. We could see that Access Bank didn't just digital channels. It digitized how work gets done. And this was the backbone of Access Bank. Let's also examine the digital banking. With the introduction of the Access More app, Access Bank recorded over 1.1 billion transactions. And as at 2024, they have over 1.5 million new users on that app. Without this infrastructure, branches would choke, staff would spike, transaction income would leak away. So with this, Access Bank was able to reduce its cost of operations as its scales was increasing. What about the people who actually run this system? Yes, it is important to know that Access Bank has a large workforce and branch network, but the strategy they adopted was not to cut the workforce aggressively, but they retrain, redeploy, and even automate low-value tasks, while also extracting more output per employer. This evolved capacity. So let's move on to the performance aspect. Next slide, please. Examine Access Bank performance and financial analysis. By 2024, Access Bank assets reached 40.8 trillion, reflecting substantial scale and growth. Deposits also hit 31.8 trillion, demonstrating strong funding capacity. Loan expanded to 13.1 trillion, supporting the leading growth aligned with capacity. In the first quarter of 2024, assets grew by 22%. Their pre-tax profits jumped by 148%. This shows that they were not just growing, and also their net interest income, it rose by 189%. This alignment shows growth is controlled and absorbed and not chaotic. Looking at the NPL ratio trend from 2020 to 2024, The NPL remained 2.76, which is a significant and shows a signal that shows that a disciplined credit management and operational controls are holding even under rapid expansion. Cost to income ratios are elevated, and this is not a failure, but a strategic investment. Access Bank choose to build capacity first, then optimize later. This carries risks, but also upside. So, what we see is not growth for growth's sake. It is a calculated bet, using scale, technology, and diversification to build long-term dominance, even at the cost of short-term efficiency. What then are the strategic challenges and implications of this approach? I'll call on Tosin to take us on that. Thank you.
While Access Bank is thriving in many areas, there are certain challenges that are posed against it. One, inflation and economic instability. When we talk about inflation and economic instability as a risk for Access Bank, it is how rising prices and general economic weaknesses in Nigeria and some African markets squeeze both the customers and the bank itself. And in 2024, when inflation was persistently high and it was averaging over 33%, this drives up interest rates, increased cost of living, and made borrowers, especially consumers and small businesses, have less ability to repay loans on time, which raises the bank's credit risks. Two, credit risk and foreign exchange volatility. Credit risk is one of the biggest day-to-day challenges for any bank, and for Access Bank, it is no different. And according to the latest interim results released by Access Holding, it was reported that the net impairment charge on financial assets more than doubled from 144.95 billion to over 300 billion, which signals a rising stress in the loan book and highlights the increased likelihood of borrowers struggling to repay loans. Which was also struggling to repay loans. Three, regulatory pressures. Every banking activities in Nigeria is regulated by the Central Bank of Nigeria and the SEC, Securities and Exchange Committee. And Access Bank has faced significant regulatory penalties, which surround issues like improper handling of government funds, anti-money laundering breach, and other. Four, cybersecurity threats. The second security issue experienced by Access Bank isn't just a technical issue, but also a financial risk. Access Bank has been deepening digital services like mobile transactions and investing a lot in digital transactions. But following a report from Tech Cabal, Access Bank reported 1.64 billion in actual fraud loans in the first half of 2025 alone, which is as a result of forged results and fraudulent transfers. Now, I'll be walking us through the SWOT analysis of Access Bank. Looking at the strength at which Access Bank and the edge of Access Bank over other competitors. The first is its scale and its reach. Access Bank has the biggest Access Bank is currently recognized as the Nigerian largest bank by assets, with over 700 branches and service outlets spanning across 3 continents, over 20 countries, and over 63 million customer base. This scale allows the bank to diversify risks across different economies instead of relying solely on Nigeria. And with that, the bank is able to mobilize large deposits at lower cost, support multinationals and cross-border clients, and also absorb economic shock better than smaller banks. 2. Digital leadership. Access Bank has positioned itself as a technology-driven bank and not just a traditional lender. It was one of the early adopters of the Visa credit card to serve millions of its customers digitally across its market, which has helped to reduce dependence on physical branches, improve transaction speed, and customer experience. 3. The brand value. Access Bank has built a strong brand over time and has consistently ranked amongst Africa's most valuable banking brands and also won numerous awards like the Sustainable Bank of the Year by the CBN, the overall Best Company in Corporate Social Responsibility by Forbes, and has also won the award of the Most Valuable Company in 4 consecutive years by the Brand Finance, which has positioned as a strong bank and strong visibility. Moving on to the weaknesses of Access Bank. Moving on to the weaknesses of Access Bank. The first one is the high operating cost. While Access Bank has scale, which brings strength, it also comes at a lot of cost. And Access Bank has risen in recent years due to inflation and expansion costs, and its operation across many countries has increased its compliance and regulatory expenses, technology and infrastructural spending. Two, regulatory penalties. While regulation is necessary for every bank, but falling into penalties is a signal of operational weaknesses. And over the years, where Access Bank has faced several regulatory sanctions, like in 2024, when it paid 1.2 billion as for a sanction for going against the CBN and the SEC. Three, fraud losses. Fraud losses. Despite several cybersecurity investments, Access Bank still reports fraud losses annually, mainly from electronic and transfer-related frauds. Moving on to the opportunities, digital banking growth is one major and largest opportunities for Access Bank. Africa still have a lot of unbanked and underbanked populations, and with the rise of smartphones and penetration of internet assets, Access Bank can bank on this to onboard new customers digitally, scale their services without physical branch expansion. Two, ESG finance. As Access Bank has been currently involving in sustainability, it is also a very key factor to continue to improve in ESG activities of the bank, as global investors increasingly favors bank with strong ESG credentials, giving Access Bank the access to cheaper international funding and long-term institutional capital. Three, global expansion. Access Bank is no longer just a bank, it is a global African bank. The bank is expanding into Europe and many other countries. Now, moving over to the threat faced by Access Bank. The first one is the microeconomic volatility. Access Bank operates primarily in Nigeria and several other economies, and foreign exchange markets are unstable, while economic growth is also uneven, and this slows the pace of inflation, which relieves consumer spending and weakens low demand. Two, fintech competitions. Fintechs are not just with the rise of fintechs. These fintechs are not just competitors for Access Bank, but they are redefining what customers expect from banks across Africa and especially even in Nigeria. Fintech companies like Kuda, Opay, Paystack have grown rapidly by offering fast digital payment solutions, and this poses threat for checks to Access Bank to improve on their transactions and many other aspects. Now, moving on to the strategic recommendation for Access Bank. Moving on to strategic recommendation for Access Bank. The first recommendation is to strengthen credit risk management. The first strategic recommendation we offer to Access Bank is to strengthen credit risk management. Access Bank should tighten how it grants, monitor, and recover loans to reduce non-performing loans. And what are non-performing loans? Non-performing loans are loans where borrowers have refused to pay the interest or principal as at the agreed time. And this is important because of economic volatility, inflation, and foreign exchange pressure, which have increased default risks, which affect profitability. And Access Bank can implement this by using data-driven credit scoring models for retail and SME loans, conducting frequent loans portfolio review and stress testing. And the expected impact of this is lower non-performing loans, and to also improve asset quality. Another recommendation to Access Bank is to tighten its cybersecurity and fraud control. Access Bank can invest in stronger digital security system to protect customers and bank from fraud and cyber attacks. And this is important because Access Bank is expanding in digital banking, which is also leading to increased fraud. And they can do this by deploying real-time fraud, monitoring and transaction analytics, conduct regular cybersecurity audits and penetration. And lastly, Access Bank can optimize foreign exchange liquidity management by managing foreign exchange exposure by either matching their foreign exchange assets with foreign exchange liability to reduce mismatch risks and diversifying sources, which will help to improve liquidity stability, reduce foreign exchange losses, and stronger capital position. I'm handing over to Fatia, who will be working on through the implementation roadmap for Access Bank.
Who are you handing over to? Your time is, you are behind schedule. So who is taking over? Who is concluding? Oluwatosin, are you guys done? She said she's handing over.
No, ma.
So who is taking?
Fatia is taking it up.
Oh, okay. I don't think Fatia is on the call because she's not taking over. You've handed over, but she's not taking over. Does somebody else want to conclude on behalf of the team? Who is concluding on behalf of the team?
I'll be taking the conclusion.
Okay.
In conclusion, we are going to be presenting an implementation roadmap for Asset Bank, which we have subdivided into 0 to 12 months, 1 to 3 years, and 3 to 5 years. The short-term action plan is to strengthen digital banking services and security, and this will take place within 0 to 12 months. Another short-term implementation plan is to improve customer experience with AI and analytics, and also expand agency banking channels. The implementation from the medium-term action plan is from 1 year to 3 years, and that is to consolidate pan-African network as Access Bank shifting from quick acquisition to deep operational consolidation, ensuring technology processes, risk system, and customer service are standardized across markets. 2, to increase focus on SME lending and sustainable products. And also invest in advanced analytics and AI. The long-term action plan, which will take place within 3 to 5 years, is expanding globally. While Access Bank has expanded into some other African countries, there are still more global reach for Access Bank to. There's still lots more global reach for Access Bank, and also rolling out green banking and ESG products. Now, moving on into the conclusion, Access Bank implementation is grounded in real action, backed by major digital investments, regional acquisitions, and SME commitment. Success depends on strong integration, tech security, and navigating economic pressure, but the bank is strategically positioned to grow from a regional leader to a global financial powerhouse. Thank you.
Thank you very much. Oluwatosin, have you finished?
Yes, ma'am.
Okay, thank you very much. I know you tried to, I don't think that was your part to take, but you tried to cover up for whoever was meant to take it. So good job, well done. All right, we're just going to have the next team present, and that is Team Bairo. Team Bairo, are you ready for us?
Yes, ma'am, we're here.
Excellent. All right. So you can start sharing your slide and then we'll give both teams feedback at the end of the presentation. Yeah. Timbairo, you can project your slides now.
Behind every strong balance sheet is a strategy, and behind every strategy is analysis. This presentation goes beyond figures. It connects financial performances, market dynamics, and strategic direction to provide a clear view of where Access Bank stands and where it is headed. Sit back as we walk you through the story behind the numbers. Good day, distinguished panelists and colleagues. My name is Garba Gidado Kasim, and we are Team Alpha Bayero. Alongside myself are
Hussein Mahmoud
and Yakub Munir.
So we start with the history of the Access Bank development.
Access Bank came with a founding vision. They started as a small Nigerian bank. The vision was always to become a respected Pan-African global bank. The founding years ranged from 1988 to 2001, where they gained their banking license on December 19, 1998, and was incorporated as a privately owned commercial bank on Friday 8, 1989. It commenced operation on May 11, 1989 at Boroma Road, Apapa, Lagos. It became a public limited company on March 24, 1998, and was listed on the NGX in November 1998, as was then known the Nigerian Stock Exchange. It gained its universal banking license in February 2001 and from the Central Bank of Nigeria, allowing it to operate a full range of banking services. In 2002 to 2012, there came its strategic transformation. In March 2002, Mr. Aiboji was appointed managing director with Herbert Wigwe as deputy managing director. Their mandate was to reposition the bank as a leading Nigerian financial institution. The new leadership came with its own transformation agenda. The leadership focused on corporate governance, innovative banking culture, expanding the branch network, and strengthening capital. This led to substantial balance sheet growth and profitability after years of modest performance. The capital growth in 2007. In 2007, the bank undertook a significant capital raising exercise that was oversubscribed by more than 300%, boosting shareholders' funds and expanding its investor base. By the early 2010s, Access Bank had begun expanding beyond Nigeria with branches in Gambia, Sierra Leone, Zambia, Rwanda, and the Democratic Republic of Congo, the DRC. Intercontinental Bank was acquired, which was a major milestone in 2012, which helped cement its position among Nigeria's top banks. The bank successfully issued its first Euro bond, ranging with a initial amount of $350 million in 2012, and achieved a strong credit rating, an indicator of global investor confidence. Access Bank adopted rolling 5-year strategic plans to deepen financial inclusion, expand digital banking, enhance trade finance, and build a Pan-African payment infrastructure. In 2018, Access Bank announced its intention to merge with Diamond Bank, one of Nigeria's leading retail banks with a strong digital customer base. The merger was completed in March 2019, creating one of Africa's largest retail banks by customer base and significantly expanding its branch network and technological platforms. The same year, The bank issued Nigeria's first fully certified corporate green bond, a major sustainability milestone. In 2020 to date, Access Bank expanded aggressively into Kenya, Mozambique, South Africa, Zambia, and other markets, becoming one of the most geographically diversified Nigerian banks. The bank adopted the strategic vision of becoming Africa's gateway to the world, focusing on cross-border trading finance and payment infrastructure. In 2022, Access Bank transitioned into a holding company structure, Access Holdings PLC, to unlock opportunities beyond traditional banking, which includes payments, insurance, and digital financial services. In recent years, the group has expanded its footprint into Europe, and including France, and continues to explore new markets. Today, Access Bank operates over 700 plus branches and service outlets in 24 markets across 3 continents, serving over 60 million customers with a workforce of 28,000 employees. The bank offers retail, business, commercial, corporate, treasury, and digital banking, leveraging a robust technology base and sustainability focus. It is one of Africa's largest bank by assets, customer base, and geographic reach, and continues to invest heavily in sustainable finance and financial inclusion. I'll hand over to my teammates to take us through the investment summary.
Access Holdings PLC remains the largest financial services group in Nigeria by total assets, with a whopping 52.0 trillion naira as of third quarter of 2025. Our buy recommendation is predicted on the group's successful transition from capital-intensive inorganic expansion to an operational consolidation phase aimed at sweating recently acquired assets across Africa and Europe. Some of its key investment highlights are dominant market share and scale, where Access Corp has effectively leveraged its scale to drive top-line growth as gross earnings surged by 14.1% year-on-year out to 3.9 trillion naira in the first 9 months of 2025. This was fueled by a high interest rate environment that boosted interest income by 21% to 2.9 trillion naira. It also had some significant operational efficiency, which was gained through a pivotal shift in 2025, which has been the improvement in the cost-to-income ratio, CIR, which dropped from 60.8% in the 9 months of 2024 to 54.6% in the 9 months of 2025. This reflects the early fruits of the group's shared services integration strategy. They also diversified revenue streams. Non-banking subsidiaries like pensions, payments, and insurance are becoming significant alpha drivers, specifically hydrogen payment services, which saw a 211% year-in-year out increase in transaction value. They also processed 41.1 trillion by the first half of 2025. They also had valuation disconnect. Despite being the industry leader by assets, Access Corp trades at a significant discount to its book value, with a price-to-book ratio of 0.34x and a price-to-earnings ratio of 3.2x. The market is currently pricing in a complexity discount, and that we believe it will narrow at the holdco structure as the holdco structure matures. Our investment thesis is that we anticipate a significant re-rating of the stock in 2026. The temporary suspension of interim dividends in first half of 2025, which was due to a technical shortfall in regulatory paid-up capital, excluding share premiums. It is expected to be resolved via a capital restructuring or the ongoing recapitalization exercise. Once dividend payments resume, the yield, combined with the current 60.8% upside to our fair value estimate of 33 naira, offers a compelling total return profile for value investors. Now my teammates will present to you the industry and competitive analysis. Thank you.
Before recapitalization derivative, the industry has divided into a small group of mega banks and a struggling middle tier. Our macroeconomic content and regulatory tailwinds. Recapitalization milestone. The deadline for the new minimum capital requirement of 500 billion naira for international license is approaching in March 2026. Access Corporation has already crossed the threshold, reaching a paid-up capital of 595 billion naira by mid-2025 through successful rights issues. Monetary tightening. The CBN maintained the monetary policy rate (MPR) at 27.5% throughout March 2025. While this increased the cost of funds, it created a lucrative environment for Tier 1 banks to earn record interest income from government securities and prime lending. Nigeria's economy grew by 3.13% in Q1 2025, primarily driven by a 4.33% expansion in service sectors. Digital banking transaction volume across the industry rose by 38%, favoring banks with superior tech stacks like Access and GTCO. Our competitive positioning. Access Corporation maintains its position as the largest bank by total assets, but it faces stiff competition in efficiency and brand strength from Zenith and GTCO. The competitors of Access Bank. Let's analyze the competitors of Access Banks by using the total assets, net interest margin, cost to income ratio, and NPL ratio. Access Bank has a total net asset of 52.2 trillion naira, a net interest margin of 8.82%, and a cost to income ratio of 54.6%, and an NPL ratio of 2.68%. Zenith Bank has a total asset of 31.2 trillion naira total assets, a net interest margin of 7.90%, a cost to income ratio of 39.5%, and an NPL ratio of 3.54%. UBA has a total asset of 30.9 trillion naira, a net income margin of 6.50%, a cost to income ratio of 48.0%, and an NPL ratio of 3.38%. GTCO has 10.35 trillion naira total assets, net interest margin of 9.20%, and cost to income ratio of 28.5%, and an NPL ratio of 4.07%. Asset quality leadership. Surprisingly, despite its massive loan book, Access Corporation reports the lowest non-performing loan (NPL) ratio among Tier 1 banks at 2.68%, significantly better than the industry average of 5.2%. The efficiency gap between Access leads in scale. GTCO and Zenith remains more efficient in terms of cost to income ratio. Access higher CIR of 54.6% is a byproduct of its heavy physical footprint between 700 plus branches and the cost of integrating 20 plus international subsidiaries. Our SWOT analysis of Access Holding PLC. The strength of Access Bank. Dominant market share in deposits, which amount to 22.9 trillion naira, and assets. Geographical diversity, operates in 20 plus countries, providing a hedge against naira volatility. Digital ecosystem, hydrogen payment and oxygen digital lending are scaling rapidly, with hydrogen processing 41.1 trillion naira in Q1 of 2025 alone. Access Holdings weaknesses. Integration complexity. The aggressive merger and acquisition strategy. The aggressive merger and acquisition strategy has created a complex organizational structure, leading to higher administrative overheads. Our dividend volatility. Temporary pause in dividend payments due to capital restructuring have tested investors' patience compared to dividend kings like Zenith. Opportunities. Consolidating synergy. Shifting from buying to integrating offers significant room for cost reduction in 2026. The African Continental Free Trade Area allows Access to leverage its footprint for cross-border trade settlement. And then lastly, its threat. Regulatory risk. Stricter cash reserve ratio requirements could trap liquidity. Macro volatility. Persistent inflation in Nigeria, approximately 30% plus, threatens to erode real return and increase operating expenses.
Now it's time for the company overview of Access Bank. Access Holdings PLC operates a holdco structure, a strategic pivot initiated in 2022 to diversify income streams beyond traditional commercial banking. By late 2025, the group has evolved into a full-scale financial ecosystem with a presence in over 20 African countries, as well as key hubs in the UK, France, Hong Kong, and the UAE. The group's ecosystem play its design ecosystem play is designed to capture value at every stage of a customer's financial life cycle. It operates through 5 primary verticals. We have the Access Bank PLC, the anchor vertical, contributing approximately 65% of the group's profit before tax as of the first half of 2025. It serves over 60 million customers across 3 continents. We have Hydrogen Payments Services, a super fintech vertical. It focuses on switching and processing, providing the rails for domestic and cross-border African trade. Access ARM Pensions. It was formed via the 2024 merger of Access Pensions and ARM Pensions. It is now one of Nigeria's largest pension fund administrators with over 3 trillion in assets under management. We have Oxygen X, a digital-first consumer lending business launched in the third quarter of 2024 to target the high-margin retail credit market. Then lastly, we have Access Insurance Brokers, a risk management arm providing insurance solutions to group, corporate, and retail clients. We have the geographic footprint, the Pan-African Gateway. Access Holdings is the most geographically diverse Nigerian financial institution. In 2025, non-Nigerian subsidiaries contributed over 50% of consolidated results, acting as a critical hedge against Naira devaluation and Nigerian regulatory shifts. It serves as expansion hubs. Recent entries into Angola and the expansion of Access Bank UK into Hong Kong position the group as a bridge for Asia-Africa trade flows. With operations in 21 African countries, the group is a primary beneficiary of the African Continental Free Trade Area, leveraging its instant pay and hydrogen platforms for intercontinental settlements. The leadership and governance of Access Bank. Following the tragic loss of Dr. Herbert Wigwe in early 2024, the group demonstrated significant institutional stability. In August 2025, Mr. Innocent Ike was appointed as the substantive group managing director, succeeding Ms. Bolaji Agbede, who served as acting CEO for 18 months. Mr. Ike brings over 30 years of experience, including a successful stint at the helm of Polaris Bank. The board is chaired by Mr. Paul Usoro, who is a senior advocate of Nigeria, with Mr. Aigudi, who is a non-executive chairman, providing strategic continuity from the bank's foundational era. Operational statistics in the first half of 2025. The subsidiaries of Access Bank, Access Holdings, we have Access ARM, who contributed over 21 billion naira to revenue, a profit before tax of 13.1 billion naira, and 48.1% return on assets. Hydrogen Payments contributed 41.1 trillion naira, total payment volume, 273% year-on-year growth in its profit before tax, processed 201% more value as compared to 2024. Oxygen X provided 5.4 billion naira revenue, 2.2 billion naira profit before tax, and rapid scale in digital lending. Access Insurance gave us 125% gross written premium growth, 161% increase in its profit before tax, and deepened bank assurance integration. I now hand over to my teammate to carry out the financial analysis.
This section re-evaluates the financial trajectory of Access Holdings PLC using the normalized 5-year data sets within the time frame of 2020 to 2024. The data reveals a bank that has successfully scaled its balance sheet by over 200% in the last 4 years, while undergoing a structural transformation in its efficiency and margin profile. Some of its profitability trends and earnings efficiency stood between 2020 and 2024, during which Access Corp transitioned from a steady growth phase into a period of hyper profitability. The 2023 peak in ROE, return on equity, represents the breakthrough year where the group's expansion strategy began delivering massive bottom line results. While ROE moderated to 17.1% in 2024, this was largely due to a significant expansion in the equity base. Crucially, the net interest margin reached a 5-year high of 3.6%, proving that the bank has successfully leveraged the high interest rate environment to increase the profitability of its core lending activities. The most significant story in the data is the group's move towards operational leanness. Historically, Access Corp struggled with high integration costs following its various acquisitions. The efficiency leap in 2021 and 2022, the cost-to-income ratio hovered between 74% and 75% by 2023. This also plummeted to 44.6%. In 2024, the slight rise to 56.9% reflects the inflationary pressures in the Nigerian economy. Energy costs, personnel adjustments, and the costs associated with the new holdco subsidiary launches like Oxygen X and Hydrogen. Despite this upstick, the bank remains structurally more efficient than it was at the start of the decade. Access Corp has maintained a conservative risk posture even as its balance sheet exploded in size. Its resilience in 2022 spike in the cost of risk 3.9% indicates a proactive cleaning of the loan book. By 2024, the bank returned to a stable 1.9%, showing strong credit control. They also had a liquidity buffer through which a consistent loan to deposit ratio LDR below 60% highlights a liquidity first approach. This provides a massive safety cushion and significant firepower to increase lending if economic conditions improve. The group has achieved mega bank status with its balance sheets reflecting a compounded annual growth rate (CAGR) that outpaces most peers in the Fugas group. The leverage ratio improved to 10.6% in 2024. This move towards higher capitalization is a strategic defense against currency volatility and ensures the bank is ready for the final 2026 recapitalization deadline. I hand over to my teammates who will take you through the strategic outlook and projections within the time frame of 2025 to 2027.
As Access Holding PLC enters the harvesting phase of its 2023 to 2027 strategic cycle, the focus shifts from capital intensive inorganic growth to organizational excellence and margin expansion. Let's look at our financial forecast and key performance indicators. Based on current 2025 performance data and the group's 2027 vision roadmap, we project a steady climb in profitability as the integration of international subsidiaries begin to yield lower cost to income ratios. Let's use the metrics of 2025, 2026, and 2027 to create a forecast. Gross earnings, we are expecting a 5.64 trillion naira gross earnings at 2025 and 5.80 trillion naira as at 2026, and then 7.50 plus trillion naira as at 2027. Our forecast for profit before tax is 1.03 trillion for 2025, 1.14 trillion naira for 2026, and 1.35 plus trillion naira for 2027. Total assets projections are 43.2 trillion naira for 2025, 45.0 trillion naira for 2026, 55.0 plus trillion naira for 2027. And then our return on equity projections are 20.7% for 2025, 16.9% for 2026, and then 20.0 to 28% for 2027. Our cost to income projections are 56.2% for 2025, 58.0% for 2026, and then less than 50% for 2027. Let's look at a year-by-year strategic narrative. The trajectory towards 2027 is defined by the three distinct operational themes. For 2025, it's termed the efficiency pivot. Following the aggressive acquisition of 2023 to 2024, e.g., the Finibanco Angola 2025 is the year of sweating the asset. The bank is prioritizing current and savings account mobilization to lower its cost of funds, which is projected to set to around 9.8% by the year end. 2026 is termed the dividend and capital re-rating. After a technical pause in interim dividend in 2025 due to regulatory paid up capital definition, we expect a full resumption of dividend payments in 2026. This will be supported by capital restructuring that converts share premium into qualifying capital, like triggering a market re-rating of the stock. 2027, which is termed the African Gateway, realized. By the end of the cycle, Access Corporation expects to have a presence in 26 countries, including a fully operation in China DEX and a presence in at least 3 OECD countries, UK, France, and potentially the US. A structural shift. A core component of our projection is the decreasing reliance on the Nigerian commercial banking arm. The goal is to evolve into a diversified financial ecosystem. Revenue mix evolution projected to drop by 82% as at 2022 to 52% of total revenue by 2027. African subsidiaries expected to contribute 30% of revenue, leveraging the Africa continental free trade areas. New vertical, that's the hydrogen and oxygen X, targeted to contribute 80% of group profitability, providing a high margin and asset light income. Our 2027 outlook assumes that Access Corporation will maintain its NPL ratio below 3%, and successfully onboard 125 million customers, up from approximately 60 million to this. The successful execution of the hydrogen payment platform, which processes 41.1 trillion naira in transaction value in Q1 of 2025, is the primary alpha factor. If transaction volumes continue to grow at the current 211%, 211% pace, the payment vertical alone could represent a multi-billion dollar valuation by 2027.
Now we look towards the investment risk of Access Holdings. Despite its dominant market position and robust financial performance, Access Holdings Co. operates a volatile landscape. Investors must weigh the current consolidation phase against several structural and systemic risks. Some of the systemic and macroeconomic risks include currency devaluation. With a presence in over 20 plus countries, Access Corp is highly exposed to currency fluctuations. While its international subsidiaries provide a hedge, a sharp devaluation of the Nigerian naira seen in 2024 can lead to significant FX revaluation gains, but also increase the risk of capital erosion in real terms, whether when converted to USD. We have persistent inflation. With Nigeria's inflation rate hovering near 30% in late 2025, operating expenses remain under pressure. Specifically, energy cost and personnel adjustments contributed to the 6.7 year-on-year rise in operational expenses to 1.2 trillion naira in 3 quarters of operational risk. Recapitalization and dilution. To meet the CBN's 500 billion naira minimum capital requirement, Access Corp has aggressively raised equity, while it has surpassed the requirement, reaching 594 billion naira by the end of the third quarter of 2025. A recent 40 billion naira private placement, as at the end of December 2025, is expected to cost a 3.7% to 4.0%. The holdco complexity discount. The rapid expansion into payments, that's hydrogen. We have pensions, access ARM, and insurance has created a complex legal and operational structure. There is a risk that integration synergies may take longer to materialize, leading to higher administrative cost. Another indication is dividend suspension risk. In the first half of 2025, the group temporarily suspended interim dividends due to a technical shortfall in paid-up capital, which was imposed by the CBN. While management is pursuing a capital restructuring, any delay in resuming dividends could trigger a sell-off by yield-seeking investors. I hand over to my teammate to take us through the ESG consideration.
In modern business, success is no longer measured by profit alone, but by impact, responsibility, and governance. ESG has become a strategic tool for managing risk and sustaining long-term value. Imagine a profitable company with weak governance, poor environmental practices, and little regard for society. Sooner or later, regulatory penalties, reputational damage, and financial losses will follow. ESG exists to prevent this. For banks, the stakes are even higher because every loan and investment they make shapes economic behavior. This is why strong ESG frameworks are central to modern banking. For banks whose decisions influence entire sectors, ESG is not optional, it is fundamental. With this understanding, we now turn to Access Bank's ESG activities. Access Holdings is a recognized leader in environmental, social, and governance integration in Africa, currently holding a top-tier rating among Nigerian financial institutions. It has made great environmental stewardship through green finance, where Access Bank was a pioneer in the Nigerian green bond market. As of 2025, it has financed projects equivalent to protecting 1,400 football fields of land from flooding and taking 154 passenger cars off the road in terms of carbon emissions. In renewable energy, the group has transitioned 350 branches to solar power and operates 3 certified green buildings across Nigeria, Ghana, and Mozambique. Its social impact and financial inclusion has been introduced with the W Initiative, a flagship program focused on women's economic empowerment, providing specialized credit and capacity building for female entrepreneurs. It also has introduced the hydrogen and oxygen digital platforms, which are critical to the group's social mandate, driving financial inclusion. Hydrogen processed over 41 trillion naira in transaction volume by mid-2025, bridging the gap for SMEs in the informal sector. Its board oversight is rated as one of the top 3 strongest performers in governance maturity. In 2025 IPMC ESG ratings report, the board maintains high independence levels and has successfully navigated the leadership transition following the 2024 executive changes. I'll hand over to my teammate for final recommendation and target price.
Finally, based on our multi-stage dividend discounting factor and relative valuation, that's our PB over the return on equity, we maintain a buy rating on Access Holding PLC. With a 12-month target price of 33 naira, current price as of December 2025 of 20 naira 50 kobo, implied upside 60.9%. In summary, the market is currently pricing Access Corporation as a legacy bank rather than a diversified financial ecosystem. At a PB ratio of 0.3x, the stock is significantly undervalued relative to its peer group Zenith at 0.6x and GTCO at 0.9x. As the group enters its optimization phase, that's from 2026 to 2027, and resumes dividend payments, we expect a major re-rating of its share price towards our fair value estimate. In conclusion, Access Holding is a high conviction play value. Its unparalleled skill and diversified revenue streams from non-banking subsidiaries provide a margin of safety that justifies the current entry point. Thank you very much.
Thank you very much, Team Alpha. Wow. Thank you. That was a very long presentation, and I think you went over the time a little bit. Sorry about the background noise. Well done to both teams for delivering that wonderful presentation. Thank you for the intentionality in your presentation. And as we all know, both teams that have presented have got good confidence level and good presentation skills. All right, I'm going to call on the mentors to give the teams feedback for their presentation. Mentor Adetayo, do you have any feedback for the teams?
All right, Dr. Jimmy, thank you very much. Well done to both teams for a very, very good presentation. I'll start with the team Quest, if I'm correct. You guys, thank you for showing up in the first place, because some people will just bolt off without showing. So, but your presentation is a bit disjointed, and it showed a rush walk. But kudos to the team lead. I don't know her name, but she was there trying to make things tick. But it did show that the presentation was a rushed work. So much work needs to be done there. You did presented some details, but it is lacking a bit of it's lacked a bit of consistency all through. You won't finish some part of your presentation, probably because you don't know what to say. You just move on to the next one and leave us hanging. Things like that, they are noticeable in your presentation. But overall, well done. And I hope you guys will learn a lot from this presentation being the final. There is a lot to be learned, and I will give that feedback once I'm done with Bayero. Bayero, well done for a very lengthy presentation. You've done well. You dealt with it to a very reasonable extent. However, your financial analysis could have benefited from a lot of charts. It is criminal in the financial world that you are talking about all those things without any charts to just portray it. I know you have the figures, you have all those things, but one or two charts would have done justice to that. There is no model or framework per se that you brought into your presentation. I can't remember any. Probably I'm mistaken, you can remind me, but I can't remember any of your or any framework being brought into your presentation. The energy also was low. You are lucky because you had a team Quest did not come to the show per se. But if you had presented this same way with another very strong team, I don't think you would have got a good review. your energy was low, the audience engagement was a bit low as well. I don't know, probably you guys need to watch some of the Daytopia final competition in previous years. You should know that there should be more A game brought into this, but I won't overflog it. You guys have done your bit, but please take notes. Audience engagement is very important. None of you were even turning on your camera. It's the final. You're not turning on your camera. You're not engaging the audience. No poll, nothing to just spike it up to show that this is actually a final. But all well, this is not to Alpha Bayero or anything. I'm talking generally to all the things that you need to bring your A game when it comes to the final. I understand probably because of the festive mode, it's like that, but let's just focus on bringing our A game to presentation. What is worth doing is worth doing well. Thank you very much, and I hope that subsequent competition we can take it further. Thank you.
Thank you very much, Mentor Aditayo. To be honest, what you said was what Dr. Yusuf was discussing with me as well, that the presentation, the final presentation for this tournament was way below what we used to have for the Daytopia competition, and even for the last tournament that we did have. I think it was only 2 set of presenters that really brought their A game, but we could see that many people came in just because they just didn't want to not show up, and which is not good. Just like I've said, what is worth doing is worth doing well. It's important that you do. Maybe another thing that impacted on the presentation was the holiday, but it was important that you guys, because it's really hard for us to give you critical feedback, and again, it means that you won't learn as well. I always say this: if you bring a rough draft, you get a rough feedback. So when you put in a lot of work, you get more constructive feedback as well. So it's just important for you to have that at the back of your mind. Dr. Yusuf, you have your answers.
Yes, thank you very much. I think the mentors have said what I've put down as well, because I think both teams did not break their A game. Team Quest, if at some point, both of them didn't have good time management. Maybe it wasn't well rehearsed. I felt like Team Quest was reading a lot. It was like you just reading, and maybe the audience would just grab. And you were not, well, Mentor Julius already said, you were not trying to keep track that are these people even following. I could literally just zone off and come back in, and then you wouldn't even know that I was following or not, right? So it has to be, rather than reading, it has to be like a proper presentation and then carrying your audience along. I think the analysis was also basic. Not a lot of analysis with regards to other areas of the business, like liquidity, efficiency. I didn't like Bayero slides at all, and it was just because, and maybe the person that was moving the slides as well. I mean, I didn't even know you guys were on analysis until I was hearing numbers, and I was like, what's happening? Where are the numbers? But then again, the slides need to be a lot better if you're trying to analyze the company. We can see the previous, I don't need to emphasize because we can see what the previous teams have done, which is something you probably need to go back and watch. But I just felt like both teams didn't really do enough. They didn't do justice to the analysis. It was like basic slides or basic. I think Quest had a better slide, but Quest was more of reading than presenting, even though Bayero was a bit better in that aspect. So it was just here and there. So this is not what is expected when this is the final phase, right? You are supposed to go out with the bang, like, okay, let's put in all our best to make sure that we end with on a high note. But this is not what happened there at all. Well, I mean, well done for coming in.
Right. Thank you very much, mentors, and thank you very much to all the teams that are presented today. Right. So we have one last team, but I've not got any response from their team lead. Just going to call on their names: Team Synergy and Team Redeemers. Do we have you guys here?
Yes, we are here, ma'am.
All right. Wow. Okay. That's good. That's really good, Ariana. Trust me. That's good. That's good. You understand why I said that's good later.
Yes.
All right. Team Redeemers, are you guys here? All right. So we'll start
Yes,
with
ma'am.
this. Oh, you guys are here as well. Wow, that's good. I've been trying to reach you guys. What's going on? All right. Well done. Well done. So we'll start with Team Synergy, and then we'll have Team Redeemers go next. Right. And this set of presenters, sorry, 1 minute, please. Actually, I wasn't. Ooh, nice. Just give me a minute. All right. So this is our final set of presenters, and these teams are presenting on Airtel Nigeria. So please, because we are way behind time, I'm going to be spot on the timing for you guys. So please, it's 15 minutes. Make sure that it's on dot. All right, Airtel Nigeria team Synergy, you can start sharing your slides.
Thank you very much, ma'am. We'll be starting now. In the last 5 years, doing business in Nigeria has not been difficult. It has been an extreme sport. Multinationals exited. The naira lost over 200% of its value. Energy costs exploded. Regulation tightened. For many companies, Nigeria became a graveyard. But one company did not just survive, it engineered its way to thrive. This is Airtel Nigeria. Good evening, everyone. We are Team Synergy, and we have Eniola Oyebode, Emmanuel Ladipo, Aliamin Abdurazak, and Blessing Adekoya. Today, we unpack Airtel's strategic playbook from 2021 to half of 2026, and we go beyond the headline numbers to show how Airtel shifted from chasing subscribers to creating value, how it's protected its balance sheet in the middle of a financial storm, and how data revolution became a profitability engine. Right now, we'll look to the strategic strategic overview and market positioning.
This establishes Airtel Nigeria's identity. Airtel Nigeria operates as a growth engine within the Airtel Africa group, but it has clearly evolved. Instead of chasing raw subscriber numbers, volume game often leads to low margins. The company has shifted to a value play. They are prioritizing network quality, data monetization, and the retention of high-value customers who generate consistent average revenue per user. Operationally, Airtel has transitioned into a digital infrastructure platform. Beyond basic voice services, it now serves as the backbone for 4G and 5G connectivity, delivers complex enterprise solutions, and is aggressively capturing the unbanked markets through Smart Cash PSB. This fintech arm is crucial. It is not just an add-on, it's a moat designed to lock users into the Airtel ecosystem and reduce churn. So structurally, the company adopted an asset-light model by divesting its passive infrastructure. By selling off towers to independent operators, Airtel's freed up capital to invest heavily in active networks. From a financial perspective, this shift was vital. It converted heavy depreciating capex on the balance sheet into manageable OPEX, allowing them to focus strictly on service quality. In the competitive landscape, Nigeria is effectively a near duopoly. MTN and Airtel together control over 85% of industry revenue. While MTN competes on sheer scale and ubiquity, Airtel positions itself as the value challenger. They compete aggressively on data pricing and maintain superior network stability. In key commercial hubs like Lagos, Abuja, and Port Harcourt, where the corporate and high network of users is highest. So now moving to the performance journey of Airtel Nigeria from 2021 to 2025 and early 2026. Okay, in local terms, the performance journey of Airtel Nigeria 2025. The next slide, please.
Continue.
Say you can continue.
Okay. This captures the company's performance paradox. In local currency terms, the business delivered strong operational growth, but this strength was marked in US dollar, reporting due to severe currency devaluation. The journey was shaped by 4 major shocks: the NIN SIM ban, the diesel price hike, the currency devaluation, and eventually the tariff hike.
It's important to understand the nuance here. The NIN SIM ban restricted new user intake, eating top line volume. The diesel hike inflated operating costs, squeezing, and the devaluation decimated reported earnings in USD. Each shock attacked a different part of the P&L, severely testing the company's resilience. Despite these disruptions, FLC recorded 21.1% constant currency revenue growth in 2025, with momentum accelerating forward towards the end of the year. The recovery phase projected in 2026 is significant, showing 49.2% revenue growth and an EBITDA margin expansion to 56.1%. To put that margin in perspective, maintaining a margin above 50% in a high inflation environment like Nigeria proves that their cost optimization are actually working well. The key takeaway here is simple. Demand never collapsed, the Naira did. At this point, the natural question is why Airtel was able to absorb this shock and still recover this strongly. To unpack the drivers behind this resilience, we will move to the great divergence and recovery.
Ladies and gentlemen, talking about the great divergence, it is a moment where perception and reality sharply parted ways. In fiscal year 2024, Airtel Nigeria operated in one of the most volatile macroeconomic environments in its history. A nearly 200% devaluation of the Naira fundamentally distorted financial reporting. When translated into US dollars, Airtel's income statement appeared battered. Revenue declined and EBITDA margin compressed largely due to foreign exchange translation losses. But this headline narrative is misleading. When we strip out currency volatility and assess performance on a constant currency basis, an entirely different story emerges. Revenue grew by over 21%, a clear signal that underlying customer demand remains resilient. Usage did not collapse. Customer did not churn. The business engine was still running strongly. The challenge, therefore, was microeconomic currency driven, not operational. And this distinction is critical. The recovery phase decisively in the H1 fiscal year 2025, catalyzed by regulatory tariff approval. Airtel recalibrated voice and data pricing, deliberately testing market elasticity. The outcome was powerful. Volumes held steadily. This validated Airtel's pricing power in a demand-driven market. When pricing discipline was combined with aggressive cost intervention, EBITDA margin did not just stabilize, they rebounded sharply to approximately 56%. This marked the turning point from divergence to recovery. Which brings us to the central question: how did Airtel bridge the gap? The answer lies in execution, not luck. Now, let's see how Airtel deploy a six-pillar win-win strategy and why all pillars matters. Just three proved decisive in Nigeria's contest, and we are going to go through it. The first is the win-win network. At the height of the crisis, Airtel made a recycle decision. It did not cut back on capital expenditure. Instead, it doubled down on network investment, driving 4G population coverage to 98.5%. This ensured network capacity, service quality, and reliability, key drivers of customers' retention and data monetization. The second one is the win with costs. This is where financial discipline became a strategic weapon. Airtel implemented zero-based budgeting, fundamentally re-engineering its cost structure. Most importantly, it transformed the power energy model, reducing diesel dependency and shifting towards hybrid and green solutions. This move insulated earnings from fuel price volatility and restored margin resilience. And lastly is the third one, which is win with customer. Airtel redefined its route to market strategy by decentralizing sales and expanding to 1.8 million agent touch points. The company stayed physically close to customers, even during disruptions such as NIN SIM registration ban. This proximity preserved market share and sustained customers' engagement when competitors struggled. Now, let's see the data revolution and market shifts.
The data revolution and market shift captures the most significant structural transformation in Airtel Nigeria's history. The data crossover. As at September 2025, smartphone penetration on the Airtel network surged to about 46%. This hardware shift unlocked massive consumption, driving average usage per user to over 11 gigabytes in each month. But here is the headline reviews. In the first half of 2025, data revenue officially surpassed the voice revenue, This is a historic inflection point for African telecoms. We are seeing a migration where users are not just browsing, they are consuming high bandwidth content and increasingly using mobile network as a direct substitute for fixed broadband. The implication for investors is clear. Airtel is no longer a voice utility subject to decline. It has evolved into a data-first business with significantly higher average revenue per user potential and a stickier customer base. Moving on to tariff correction impacts. This explains why pricing power was the missing link in our recovery. For over 11 years, the Nigerian telecom system suffered from a pricing anomaly. Tariffs remained flat while inflation skyrocketed. The sector was effectively subsidizing the economy. The recently approved tariff increase finally corrected this imbalance. We saw voice prices rise about 50% and data prices by roughly 40%. Now, economic theory suggests that when the price goes up, demand comes down. But we saw something different. Although traffic dipped slightly in the immediate aftermath, it stabilized quickly. This proves that demand for connectivity is highly inelastic. In today's data economy, data is no longer a luxury, it's a utility. The financial result was immediate as we see a 49% revenue surge in constant currency, effectively reflecting the sector's unit economics and restoring profitability. Which brings us to addressing the energy cost crisis, which remains the biggest single threat to our profit margin. When diesel price spiked by over 400%, it threatened the viability of over 38,000 network sites. It was an existential operational expenditure crisis. The management responded decisively by restructuring the operating model by renegotiating the tower leases with American Tower Corporation under a long-term partnership. This deal was a strategic financial engineering. We shifted from investment towards solar and hybrid solutions, but more importantly, we converted volatile, unpredictable fuel costs into predictable fixed lease expenses. The outcome speaks for itself. Despite the energy environment remaining hostile, our EBITDA earnings margin recovered to about 56%. This proves that strategy didn't just work on paper, it protected the bottom line. But protecting the profit and loss is only half the battle. In a volatile economy like Nigeria, you must also protect the balance sheet from currency shocks and look honestly at future engines. This brings us to Airtel Nigeria's masterclass in foreign exchange risk management.
Looking at the foreign exchange risk management, one of the Airtel smartest defense move was the liability localization. Airtel faced a classic currency mismatch, that is, revenue in depreciating naira and debt in hard currency. In a devaluation cycle, this can destroy equity over time. So management acted early. They restructured the capital stack so that 98% of opco debt is now denominated in naira. And what is the result? The debt burden did not just balloon, and earnings even remained stable. And Airtel avoided the negative equity crisis that its competitors like MTN. One strategic decision protected shareholders' value exactly when it mattered the most. Okay, so let's look at how the fintech challenges faced and the perfect solution for that. We all know that not everything can be perfect. And Airtel's weakest strategy today is the Smart Cash PSB, which its users adoption is still very low, about 1.7 million users, compared to fintech leaders like Opay with over 10 million users. And structurally, PSBs cannot offer loans, which limits its competitiveness and keeps smart cash as a cost center rather than a profit engine. However, the narration is changing as the smart cash is starting to have deeper integration into the MTN, Airtel my Airtel ecosystem. And the 1.8 million agents network is being leveraged to drive adoption. And also, the company is positioning ahead of the potential Airtel Money IPO in 2026. What is the strategy is there? The strategy is very, very simple, which is turn smart cash from a regulatory compliance product and convert it into a meaningful contributor to valuation and ecosystem stickiness. Looking at the way forward, that is the forward outlook and strategic priorities. Looking ahead, Airtel strategy rests on three pillars, which is number one, data monetization. The goal is no longer just adding subscribers. It is now about moving customers from basic usage to richer digital services like streaming, payments, broadband, and deepening the wallet share. The second one is financial services. This is not about copying the banks. No, they are not copying the banks, but they are embedding strategy. They are embedding transactions seamlessly into everyday mobile behavior, so that smart cash will grow naturally instead of trying to grow artificially. And the third one, we have the balance sheet strength. That is the balance sheet discipline. This has to do with continuing to prioritize local currency debt, preserving liquidity, and staying insulated from future shocks. And this is where Airtel Nigeria stands apart. MTN plays the game of scale, while Airtel plays the game of resilience, discipline, and controlled growth. And in a volatile economy like Nigeria, resilience compounds faster than size. The real question going forward is not how many subscribers can Airtel have. The real question is how much value can it extract from its customers that it serves. Like, how much can it extract safely and sustainably? In conclusion, the last 5 years should have broken Airtel Nigeria. Instead, the company rewrote the script. It didn't just cut costs. It didn't just cut costs. It redesigned its cost structure. It didn't simply just increase its prices. It proved connectivity is an essential utility. And critically, it's localized risk, its localized risk while protecting the balance sheet, while other competitors incurred massive losses. In volatile markets, size is not the real advantage. Discipline is, strategy is, and agility is the real advantage. MTN may be the giant, but Airtel has become the fortress. And in an economy like Nigeria, the difference is everything. Thank you very much.
Thank you very much, Team Synergy. All right, so you get your feedback after the. Okay, Adetayo, you have a feedback.
Yes, please. I just quickly want to ask some few questions. So that
That's fine. That's fine.
The first one is you made mention in one of your slides that there is an integration of financial services, and they've been able to use that effectively more than MTN. Could you please shed more light on that, please? Did you get my question, please? Dr. Jimmy, can you hear me?
Yes, I can hear you. I heard the
Please,
question.
can you repeat the question? Sorry, first off, can you sorry.
Okay, you want me to repeat the question? Let me make it easier. You said in some of your slides, because you didn't make mention of it, you said in some of your slides that they were able to integrate financial service into their business more than MTN, which gives them a kind of a competitive advantage. It was stated on your slide, but you did not explain it. Could you please provide context to that, please? Thank you.
Thank you so much for the question. Okay, so if I get the question well, what you actually ask is that Airtel has been able to integrate financial services more than MTN, and how has that been? Actually, Airtel and MTN actually operate these financial services through the PSB that we were talking about, like the payment service bank licenses and what we have found so far is that MTN actually operates the smart cash, MTN actually operates the smart cash, why MTN operates the Momo. However, the way Airtel has been better is that Airtel actually has publicly positioned its financial services in a way that it has planned for a separate listing. That is, it wants to list its own Airtel Money IPO. Like, there's this plan for them to go beyond what IPO is, like initial public offering. In a way, they want to go public. So, and this actually signal that this division is actually being built. Like, it wants to be, instead of it to be like a support product, it wants to be like the full thing, like a big division, which is better than MTN, because MTN has not yet announced the same path for its own Momo, even though we're not going to lie that it is actually expanding and innovating. But MTN actually shows us that it is trying to build its own financial service, not to just be a support thing, but being the main thing.
So that way, it's investor will see its own financial services as a standalone business that has value, that has measurable value. I don't know if that actually explained it, or if you like me to go deeper than that.
Right. It's all right. It's all right. I'll give general feedback later. Thank you for your time.
You're welcome.
Thank you very much. All right, Team Redimas, you can start your presentation now. Team Redimas, are you guys here?
Yes, ma'am. We're trying to get her
No
slides up, ma'am.
problem. That's fine.
All right, ma'am. Please, can you count me down to when to start?
Yes, you can start now.
We currently live in the most connected time known to mankind. Today, one tap can move money, ideas, identity, and even political power across continents. In Nigeria and across Africa, our shift from exclusion to connectivity was a digital renaissance. Good day, mentors, judges, mentees, and everyone present here today. My name is Usudobi Michael, and with me are Alabi Oluwadamilola and Akinola Mujokwefuluwa, representing Wikimas University. Today, we are not merely here to present a company. We ask a fundamental question. Can a telecom company become the backbone of Africa's digital economy while surviving currency shocks, regulatory friction, and infrastructural decay? To frame this, we introduce the Airtel trilemma: balancing growth, financial stability, and digital inclusion. Most firms attempt to. Excel is able to manage all three and understand how this improbable Dami will take us through Airtel's origin story.
Thank you, Michael. Airtel Nigeria's journey is legendary, not just because. Okay, Airtel's Nigerian journey is legendary.
Michael, mute yourself while she talks.
All right, thank you so much, ma'am. Thank you, Michael. So Airtel's Nigerian journey is legendary, not because it was smooth, but because it survived everything that should have killed it. It began operation. Sorry, I'm echoing. I don't know if you can hear me properly.
Are you using two devices? Using two devices, you can move from there. Or mute one.
Yeah, it's definitely.
All right, thank you. So,
Ma, please, can
Airtel
you start
Nigeria's
please
journey
start
is
again. Don't
legendary,
worry.
not
Let's
because
start again.
it was
Damilola,
smooth,
let's start.
but because it
Dami.
has actually survived everything that should have killed it.
Okay,
It began operation in Nigeria in 2001
Dami, do you guys
as
start
Econet,
again?
evolving through Vodacom, V-Mobile, Citel, and Zain before Bahati Africa, an Indian company acquired in 2010 for 10.7 billion, one of the largest cross-border acquisition in emerging markets history. Each rebranding navigated extreme currency swing, regulatory uncertainty, infrastructural gaps, and fierce competition. Fast forward to today, Airtel Africa operates across 14 African countries, serves approximately 173.8 million subscribers, employ nearly 4,000 people directly, and support an ecosystem of over 1.6 million agents and distributors. Airtel Africa is publicly listed on the Nigerian Stock Exchange and the London Stock Exchange, providing access to both local and international capital markets. Importantly, Airtel model spans across USSD-based rural services, SME data bundles, and high-density urban 4G and 5G consumption. Airtel early exposure to volatility forced it to learn efficiency even before expansion, a lesson that now defines its competitive edge. Michael will now examine how this resilience translates into competitive positioning in today's Nigerian telecom battlefield.
Thank you, Dami. Nigeria's telecom market today is no longer fragmented. It has effectively consolidated into a two-player arena. As of early 2025, the numbers are clear. MTN Nigeria serves approximately 87.5 million subscribers, controlling about 52% of the market. Airtel follows with 57.6 million subscribers, or 34% of the market share. Now, compare that with the rest. Globacom has just over 20 million users, and Nine Mobile has fallen below 3.5 million. This means something important. Competition in Nigeria is now about two giants competing, while the others slowly exit relevance, essentially creating what we call a managed duopoly. But scale alone is not the only story. When we examine revenue, the hierarchy appears, but with deeper meaning. In 2024, MTN generated approximately 3.94 trillion in revenue. Airtel generated about 2.64 trillion. Globacom and Nine Mobile trail far behind. At first glance, that suggests that MTN is dominant, but dominance in revenue does not automatically translate to superior business quality. This is where ARPU, average revenue per user, matters. MTN's ARPU rose sharply to $3.02. Airtel's ARPU increased to roughly $2.10, and this is the distinction. MTN monetizes premium and urban elite users. Airtel monetizes scale and grows strongly from a broader market base. And monetizing scale efficiently is much harder. Now, judges, this is where the analysis will become interesting. Despite lower ARPU and fewer subscribers, Airtel's EBITDA margin expanded to approximately 55.7%. MTN's margin stood at 50.6%. Let that sink in. Airtel is extracting more profit per naira of revenue than the market leader. So what do these numbers actually tell us? Lower ARPU plus higher margins means one thing only: operational efficiency. It means Airtel is running a leaner cost structure, managing energy and tower costs more tightly, and scaling data volumes faster than its expenses. It's not accidental, it is structural. Now, many analysts would misread Airtel's performance because of currency effect. Let me explain. When Naira depreciates, revenue earned locally appears smaller when translated into dollars, even if the company sold more data and served more customers. That is why Airtel reports constant currency growth. And in constant currency terms, Airtel's revenue grew 24.5%, showing that the challenge was currency optics, not even demand destruction. And optics do not kill business. Weak fundamentals do. That distinction sets up this counterfactual that Mushope will now pose.
Thank you so much, Michael. Now, for the counterfactual, what should have killed Airtel? Historically, four forces destroyed telecom firms in emerging markets: foreign currency debt exposure, rising energy costs, regulatory unpredictability, and declining voice revenue. Between 2023 and 2024, these forces subjected Nigeria's telecom industry to severe stress tests. The CBN's exchange rate unification policy pushed the naira from about 460 naira in mid-2023 to nearly 900 naira before a second wave drove it to 1,500 in 2024, which was last year. To appreciate this counterfactual, we compare Airtel with its strongest competitor, MTN Nigeria. MTN dominates in scale and pricing power, but its business model relied heavily on foreign currency obligations. As of end 2023, about 44% of its debt was dollar-dominated, roughly $1 billion alongside dollar-linked tower leases and operating costs. Airtel, by contrast, pursued a structurally conservative strategy. 83% of its operating company debt was already in local currency before the shock, rising to 92% by 2024. It also renegotiated dollar-linked tower lease contracts, significantly reducing balance sheet and operating foreign exchange exposure. As the naira depreciated, MTN recorded 926 billion naira in foreign exchange loss in 2024, consuming nearly 27.5% of revenue. Airtel Africa recorded $549 million in foreign exchange loss, about 11% of its $4.98 billion group revenue, which is significantly lower. And why is this? Airtel built its business for volatility and not stability. And now I'll be walking us through the cost structure operational alpha, and capex efficiency. Between 2024 and 2025, Airtel's Africa's net profits rose from $79 million to $376 million, which is a 375% increase, while MTN reported its first ever loss. This outcome was driven by two forces. First, the strategic debt reset, and second, cost agility. Airtel aggressively renegotiated agreements with infrastructure providers such as IHS Towers and American Tower. Despite inflation and rising energy costs, Airtel's efficiency outperformed peers. It spent 18 cents per dollar of revenue compared to an industry average of 24 cents. Across a 2.9 billion revenue base, that difference amounts to about 174 million in operational alpha. That explains Airtel's positive free cash flow and EBITDA, which is the earning before interest, tax, depreciation, and amortization margin of roughly 55%. Importantly, this margin expansion did not come from consumer expectation. As data volumes increased, the marginal cost of delivering additional gigabytes declined, allowing Airtel to earn more from the same infrastructure. This is the economic logic of scale, and Airtel reached that inflection point earlier before its competitors. Now, Michael, tell us about the consumer experience.
On retail pricing, Airtel positioned itself as a value for money operator. Airtel's 1,500 naira to 2,000 naira bundles offer typically higher gigabyte allocations than MTN equivalents. Airtel dominates night plans, SME bundles, and has flexible validity options. Nine Mobile often offers prices competitively, but it struggles with network depth and reliability. Note, this price strategy only works because of a deeper structural shift in consumer behavior. Mobile data has transitioned from a luxury into a non-negotiable utility. It has a price inelastic demand. Even after the NCC approved a 50% telecom tariff increase in early 2025, Nigerian mobile data demand rose roughly from 893,000 terabytes in February to 1.23 million terabytes by September. Consumers will even cut spending on entertainment and even food before cutting data usage. Airtel is not extracting value from consumers because it is cheaper. It's extracting value because connectivity has now become economically essential. Dami.
In 2025, a historic crossover occurred. Data revenue surpassed voice, and Airtel Money emerged as Airtel's most strategically transformative asset. Airtel Money now serves over 50 million users, generating approximately $623 million in revenue, growing at nearly 30% year-on-year. In 2021, Airtel sold minority stakes in Airtel Money to TPG and MasterCard at an implied valuation of approximately $2.65 billion. This strategic alliance with MasterCard, enabling virtual cards, cross-border payments, international remittance for millions of users without traditional bank access. Applying conservative fintech multiples of 6 to 7 times EBITDA, Airtel Money alone justifies a valuation worth $4 billion, as cited by Bloomberg. This would rival and in some cases exceed the market capitalization of several listed Nigeria financial institutions. To unlock this value, Citigroup has appointed as lead advisor for Airtel Money's planned IPO to be expected around 2026. Airtel Money, however, is a platform business. One built each additional transaction cost almost nothing, yet scales exponentially.
I'll take over from her.
Mobile money is the only segment in Africa telecom that can deliver sustained growth in value, not just revenue from assets. MTN operates a comparable mobile money platform, Momo, with stronger user numbers and transaction volumes. However, the strategic treatment differs. Momo is tightly embedded within MTN telecom operation, and its value is consolidated and absorbed, limiting its standalone valuation potential. Airtel Money, by construct, is explicitly positioned as a separable financial platform. This has been validated by third-party investors like TPG and MasterCard, giving it independent capital access. At this point, Airtel is no longer merely a telecom operator. It is evolving into financial, data, and payment infrastructure. Over to you, Michael.
Airtel is quietly consolidating infrastructure dominance. Through Nextra by Airtel, the company is investing in hyperscale, energy-efficient data centers, including facilities in the Eco Atlantic. Furthermore, Airtel is a key landing partner for the To Africa subsea cable, the largest subsea cable in the world. By controlling the physical pipe through which international internet enters Nigeria, Airtel shifts from being a retailer to a wholesaler of capacity. Airtel will earn from the entire digital ecosystem, not just from its own subscribers. In another strategic step, Airtel has partnered with SpaceX to deploy Starlink satellite connectivity across its 14 markets, becoming the first mobile operator on the continent to bring Starlink's direct-to-call technology to scale by 2026. This partnership reveals a unique solution to the Airtel trilemma we introduced earlier. From a growth perspective, satellite connectivity expands Airtel's addressable market into regions where terrestrial towers are economically inefficient. From a financial stability perspective, it complements rather than overextend Airtel network, reducing reliance on capital-intensive infrastructure. And from a digital inclusive perspective, it brings basic connectivity to populations that would otherwise remain structurally excluded. Moshopa will now take us through the SWOT analysis. Moshopa.
Thank you so much, Michael. Now I'll be taking us through the SWOT analysis. Starting with strengths, Airtel Africa benefits from true Pan-African scale, operating across 14 markets. This diversifies risk and stabilizes earnings. It has also insulated itself from currency volatility, with about 95% of its debt denominated in local currency, as mentioned earlier. In addition, Airtel owns and controls critical digital infrastructure, including its stake in To Africa subsea cable, strengthening long-term data capability and resilience. Now, turning to weaknesses, Airtel remains exposed to high energy costs as dependence on grid and diesel power raises operating expenses. Limited tower coverage in some rural areas also constrains network expansion and service reach. On opportunities, the planned Airtel Money IPO by 2026 could unlock significant fintech growth and a standalone valuation. Alongside this, NXtra's expansion of digital infrastructure positions Airtel to benefit from rising demand for data, cloud, and enterprise services. Now, finally, the threats. Persistent policy unpredictability across telecom and financial sectors poses regulatory risk, while increasing taxation on infrastructure providers could pressure margins. Now, Airtel Africa is not the fastest operator, but it is the most structurally prepared for Africa's realities. This strength is also reflected in how Airtel engages its environment, its people, and its institution. Dami will now show us how.
Thank you, Moshope. Airtel Africa maintains an ESG score of approximately 94%, well above industry average, driven by commitments across environmental, social, and governance dimension. For environmental, the company targets a 62% reduction in emission intensity by 2032, with a roadmap to net zero emission by 2050. For the social dimension, Airtel Touching Lives initiative and the 57 million partnership with UNICEF has connected over 1,200 students across Nigeria, benefiting more than 850,000 students. Women represent 28.5% of the workforce and are increasingly represented in leadership and operational roles, reflecting a commitment to gender and social inclusion. For governance, Airtel leadership combines global oversight and local expertise, with Dinesh Bansin as MD of Airtel Nigeria and Ogo Ofomata as Director of Business. They are sponsored by a strong Nigerian leadership team across business, marketing, customer experience, and network management.
Ladies and gentlemen, Airtel Africa PLC is not just a telecom company. It is infrastructure, it is finance, it is data, and it is resilience. It proves something extraordinary, that a telecommunications company can become the backbone of Africa's digital economy, thriving where others have stumbled under currency shocks, regulatory friction, and infrastructural decay. This is Airtel Africa. This is the future. Thank you. We welcome your questions.
Thank you very much, guys. Thank you. Okay, Mentor Adetayo.
All right, thank you, Dr. Yusuf. I have two questions for you guys, just a quick one. The first one, you mentioned the SWOT analysis. Can you please enlighten me on how Airtel prepare against their threats? That's the first question. And you also mentioned something about data bundle, how Airtel has a lower uh, data bundle price, if I'm not mistaken. And for someone that have used both Airtel and MTN while back in Nigeria, can you please tell me how this translates? You know, sometimes you buy a cheaper data bundle, but it goes quickly, if you understand what I mean. Is there any statistics to back that up, or something that has to do with customer feedback to measure the impact of that low prices of bundle? Those are the two questions I have for you guys. Thank you.
Yes, so do you
All
guys want
right,
to answer that?
I am Michael. I'll be answering your questions, sir. So first, how Airtel prepares against its key threats. One, which was policy unpredictability and regulation. Airtel participates in what I call proactive governance. It separates group oversight from local oversight because Airtel is actually a multinational company. Airtel Africa PLC is quite different from Airtel Nigeria Limited. So what it does is it allows Airtel Nigeria PLC and its management to take proactive decisions to be able to hedge against this unpredictability. And second, the FX volatility and macroeconomic shocks. Like I said, Airtel localized 95% of its local currency debts earlier in late in 2024 in December, and that limited FX transition losses. So when costs are localized, there's your debts, your tower leases, you are safer when the naira depreciates. Then the third one, which was rising energy and infrastructural cost. Like I said in my presentation, Airtel is already investing in energy efficient investments, like in Eco Atlantic City, Eco Atlantic. It's investing in hyperscale and energy efficient data centers. That way, it will be able to reduce its energy costs. Then, as for why the Airtel's data bundles, why they finish earlier, I would say that it is because their network is much better. So you don't know when you've used it finish. It's you are using it and you are enjoying it, and all of a sudden it's finished because there is no stress.
Thank you very much, for that. Mentor Aditayo, is that okay?
I think it's okay. Do you guys have your references? And if you want me to go ahead with the feedback for both teams, I'm ready to do that, Dr. Yusuf.
Yeah, if you can give them feedback, that would be great.
Right, thank you. Well done, both teams. And I think I enjoyed this presentation. It really fascinated me. I was so interested in it, and I was like noting things down. I don't know why, but you guys really, I think Michael Wusu, Toby, did a great job. Damilola or something, also Damilola Victoria, you guys, Mushope, I think you guys were good to be able to catch attention. Well done to both teams. I will start with Team Synergy. Team Synergy, you did a great job. You have confident presenters. Sorry, let me just find where I wrote my stuff. You had good content, you had good chat. However, you could do a bit more by explaining your charts. There are some charts there that I was waiting to see how you're going to analyze it, like the Airtel and OPay chart. You brought out Airtel and OPay chart, and there was nothing said about it. You breezed through most of your content on your slide. You had so much content on those slides, which you just breezed through. Yeah, I'll wait. I will give you a chance to talk in your live if you want to. That's fine. You also did you breezed through some of your content, just like I've said, like, for example, the regulatory hindrances, which the other team redeemers did a good job on. Also, you could have improved your presentation with a framework for comparative analysis. We didn't see any of that in your presentation, so that could be improved on. For redeemers, you provided context to the type of market structure. I like that. The fact that you started with a duopoly, that could be argued. Some might say it's an oligopoly, some might say it's a duopoly, but at least you make an attempt on the market structure, which I really enjoyed. You talked about the operational efficiency, which is some of your framework, which I liked, but you could have explored more to make it make sense. I was asking a question from the Synergy group. I was expecting them to say something about the TPG and MasterCard thingy, but they didn't. But you guys, redeemers, you were able to answer that, and you unlocked that part of the fintech aspect of Airtel, which is very, very interesting. The only thing you also need to improve on is that some of your slides, you had just one slide and you spoke for too long. So you might work on that slide by moving the slide. Even if it's that same slide, the animation can be made to be different steps so that it takes on and on. It looks different. You're not talking all the way and we're just looking at one slide. So this slide could be better and the framework could be better as well. I think that's the feedback from me. And Eniola, you raised up your hand if you want to clarify some of the things that might have.
Okay, thank you very much, sir. Thank you so much for the feedback. Before I say anything, I just want to thank my teammates for like a wonderful job done. And this is because I kind of went home, so I was literally unreachable, no electricity and all, but they were able to come up with something despite my absence, and I really thank them for that. Okay, so concerning the chat concerning OPEC. Okay, so the chart concerning OPay and MTN, yeah, it's not like we brushed through. It's just that we didn't just pinpoint. I actually talked about it when I was trying to compare that in the fintech challenges and solutions, in the sense that Ethel is not perfect with everything. That is Ethel Smart Cash PSB actually has 1.7 million users, while OPay has 10 million users. We're actually pinpointing at that particular chats. I guess maybe we were just not clear enough. And most of our chats, that's just how we do most of them, which I think we should have done better with. We actually talked about them. We just didn't really kind of pinpoint it that, oh, this is exactly what I'm talking about. So even though the chat is there for like the visual and all, but the main thing is just what we are saying, and I think we should have just done a better work to pinpoint that, oh, we are talking about this chart, this is the chart we are talking about and all. So that's just what I want to say. And I also want to say something that we focused more on Ethel Nigeria instead of like Ethel Africa. So our presentation is more on is limited to just Ethel Nigeria. So yeah, thank you.
All right, thank you for your clarification. And I hope other mentors will also have some feedback for you so that I don't take over all the thing. Thank you. Michael, you wanted to say something?
Yes, I wanted to thank you for your feedback and then give you something as a bonus. I know the presentation is over, but because of time, we had to remove that from our presentation. So we know this will not count as our presentation, but I just want to tell you that Airtel Group does not present data on Airtel Nigeria specifically. Rather, it consolidates its financial statements. That's one. And then two, in the issue of Smart Cash, Momo, and Airtel Money, these telecom related fintechs, they actually were conceived very much earlier than this OPay, Kuda, and Pampe. But due to licensing and regulatory delays, they had to wait. They have been conceived as far back as, I think, 2018 from my research. So I just wanted to note that too, that competition with competition is not only with Momo or ATM or MTN's fintech space. It's actually with banks like OPay, Kuda, and Pampe. Thank you.
All right. Thank you. Oh, sorry. Go on, Mentor.
No, I just want to thank him for clarifying that and for making mention of the regulatory function, because I also noted it down here, but I don't know how I skipped it. The regulatory function and how it affects the external environment of business, how it affects their decision and all that, the bureaucracy and the Nigeria political politics when it comes to all those things. So thank you for mentioning that.
All right. Thank you very much, guys. So is there any other mentor that wants to give a feedback? We've now come to the end of the Daytopia University tournament. So I want you to tell everyone to join for acknowledgement, appreciations, prizes, and then the final result, because we are going to do it here. So we are not going to be posting, we are going to be doing it here. We'll then post afterwards. So please tell everyone to join in, and I want every team to be able to at least say something, a thing or two about their their teams, their team members, appreciations, acknowledgements, and then we talk about the prizes, and then we talk about the final result. So please call everyone to join into this call now. Mentor Giwa, do you have any further feedback? Mentor Celestine, Mentor Paul, is there any other mentor that has a feedback for them before we go on to the next?
Also, Mentor Teniola, do you have any final feedback for our mentees? Mentor Giwa, you have your hands raised.
Yes, thank you for the video. Sorry, I'm still munching my chicken. So, what I was going to say is, and this is for everyone on the call. For the essence of the competition is not to ridicule anyone. It's just to encourage us and help us in different aspects